So hello all my dearest students of CA Final and Direct Tax. I hope you all are doing good. So today we are going to start with our amendment session which will be applicable for our May 24 exams and also for the November 2024 new course exams. Now let me start this discussion with a very straightforward disclaimer, and the disclaimer is this session is only applicable for those students who have given their exams for November 2023 or who have not given their exams in November 2023. And unfortunately, all those who have given their exams, they were not able to clear their exams in November 23. And now if they wish to give their exams in May 24 and November 24, then this amendment is a bridge from November 23 to 2024 May or November 24. It's a bridge program from November 23 to May 24 or November 24. This will include all the amendments which are relevant for your exams. This will also include certain topics which are added by the ICAI in the new course which was not there in the old course, like tax audit report which was there in audit earlier. Now it is a part of what? Now it is a part of your direct tax. Like black money law which was part of earlier elective paper international tax. Now it is a part of direct tax, and one small extra topic is there, theory topic is there. So 3 topics they have added. So this program, this discussion will also include that without any cost. Don't worry about it. I will upload everything on the YouTube. Third thing, there are 2 topics which are dropped by the ICAI in the new course, and that is salary and house property, which was anyways you are not doing. So topic which you are not doing, they have removed that. Anyways, it will not reduce any burden on you. Anyways, you are leaving those topics in CA final exams. Okay. So this is only for those people. Okay. What about all those who have already enrolled for my May 24 paper, for my May 24 batches? So all those students who have already enrolled for my May 24 batches, or whether it is a regular batch or whether it is a fast track batch, it doesn't matter. So if you have already enrolled to my batches, then you don't have to see all these things. All these things are absolutely done already with you all in your respective batches. This is the disclaimer with which I would like to start. Okay. So without wasting any further time, let us start with our first amendment, which is in the chapter of business and profession, and which is in the discussion of charging section. Now we all know that in the charging section, pay attention please all of you, that there are 2 types of charging section. One is general charge and one is special charge. If you do not come under general charge, then you can come under special charge also under section 28. And one of the special charging says that value of any benefit or perquisite arising from any business and profession, whether convertible into money or not, will be chargeable as what? PGBP income. So if you give me any benefit, if you give me any perquisite, whether convertible into money or not, in business and profession. So in business, if I am getting any benefit or perquisite, that is taxable as PGBP income. Now the question which was raised over here was whether the benefit which you are giving me should be in kind or should be in cash or should be partly in kind or partly in cash. So that was the doubt which was raised in front of the assessing officer. So this matter is resolved. This matter is clarified by Finance Act 2023. And Finance Act 2023 says that the benefit or the perquisite which is given over here, it may be in cash, it may be in kind, it may be partly in cash, it may be partly in kind, it doesn't matter. It can be in any of the form. Okay. So this is what the first amendment is all about. So the benefit and the perquisite which you are getting in business and profession, it may be in cash, it may be in kind, it may be partly in cash, it may be partly in kind. It doesn't matter. In all the circumstances, your income will be chargeable under the head PGBP. I hope it is clear to all of you. Just go through it, then we'll move on to the second amendment. Okay. Now the next amendment is in section 35D, and it is in the definition of preliminary expenses. What all items will come in preliminary expense? There is a small clarification over here in this particular definition. Now pay attention. Preliminary expenses includes a lot of things, like preliminary expenses include preparation of feasibility report expense, preparation of project report expense, preparation of market survey expenses, engineering services. I am highlighting few of them. Okay. This point number A, feasibility study, project report, market survey expenses, engineering services. These 3 points. Now, there is an amendment in these 3 points. Now, what is that amendment? Pay attention. Earlier, what used to be the position? I will tell you that first and then I will tell you the amendment. Earlier, the position was, if you want the deduction of these expenses, then these expenses should be done by the assessee himself, or it should be done by an approved concern. It should be done by the assessee himself, or it should be conducted, it should be carried out by an approved concern. And who is an approved concern? An approved concern will be approved by CBDT. So now CBDT does not have time to approve each and every concern every time, yeah. So they have removed this concept of getting approval from a concern. They have removed this concept of that you should get your expenses done through an approved concern. And they have brought a new concept. Now, what is the new concept? The new concept says that you don't have to get your expenses done through an approved concern. You just have to file a statement and you have to give it to the prescribed income tax authority within prescribed time and in prescribed form. So you have to give it, you have to give a declaration, a statement in prescribed form to prescribed income tax authority in prescribed time. There is no need to get your expenses done through an approved concern anymore from Finance Act 2023. Check it please. Earlier, expenses mentioned in A to C need to be carried out either by the assessee himself or itself or by a concern which is approved by the board. Now, Finance Act 2023 removed the condition of the activity in connection with these expenses to be carried out by concern approved by the board. Instead, the assessee shall be required to furnish a statement. Assessee will be required to furnish a statement containing the particular of these expenditure within the prescribed time. So you have to give a statement within a prescribed time to a prescribed authority in prescribed form. Check it please. It is as simple as this now. Okay. Now the next amendment is a corresponding amendment in 2 sections, which is in 43B also and which is in 43D also. I'll speak about both of them here itself. Now in 43B, first of all, I will speak and then I will also speak about 43D. In 43B, there is an amendment over here that if you take a loan from an NBFC, then that interest is also covered in 43B. But the classification of NBFC is changed now. Earlier, the classification of NBFC was, it has to be a systematically important non-deposit taking NBFC or the deposit taking NBFCs. These were the 2 classification of NBFCs which were covered earlier, which were covered in 43B. So if I have to take a loan, if I take a loan from a systematically important non-deposit taking NBFC or deposit taking NBFC, then it is covered in 43B. Now this classification is no more relevant for as per the RBI regulations. RBI regulations change over the time and therefore this classification is also no more relevant. Therefore, mentioning this classification under income tax law is a waste of time. It's a mismatch with different laws. It's a mismatch with RBI regulation. Therefore, now the CBDT has mentioned that such class of NBFCs which will be notified by the central government. That's it. So central government will notify the class of NBFCs which will be covered in what? Which will be covered in 43B. Now, there is nothing like systematically important non-deposit taking NBFCs and all. Okay. Now, a similar amendment is also there in 43D. You can check over here, page number 8.1, 43D. Similar amendment is there over here. Such class of NBFCs as may be notified by central government in the official gazette. See, even here, instead of systematically important non-deposit taking NBFC, they have removed that clause and they have put an NBFC which is notified by central government. Check it please, then we'll move ahead with the next amendment. Okay, which is in again 43B only. The next amendment is in 43B and it's a big one. Check it please. Okay. Now, the last thing which is here over here is the amendment made by Finance Act 2023. Pay attention please. Very important amendment. Very important amendment. The amendment is any person purchasing some items from micro enterprise or small enterprise under the MSME Act. So any person purchasing some goods from a micro enterprise or small enterprise under the MSME Act, okay, will be allowed deduction on payment basis. Now here the type of payment is something else. I will not say will be allowed deduction on payment basis. There are some restrictions over here. So if I purchase any goods from a micro enterprise, or if I take any service from a micro enterprise or a small enterprise, then provisions of 43B will be applicable. Now this provision is slightly different from what we have done so far. Here the date of payment is slightly different. It is not till the due date of filing of return. It is slightly different. That's the reason I have not mixed this up with the above provision. But before that, we need to see what is a micro company, what is a small company. Okay, let's see. First of all, that meaning of micro and small enterprise, we need to see that. Okay, who is a micro enterprise? Micro enterprise means, and in case of an industrial undertaking, if the other person is an industrial undertaking, means the other person is a manufacturer. And if the plant and machinery, investment in plant and machinery does not exceed 25 lakhs, then it is what? It is a micro enterprise. Okay. Now, in case of assessee, if the other person is engaged in providing services, then the value of equipment does not exceed 10 lakh rupees. Okay. Then you can call yourself as a micro enterprise. What is a small enterprise? The small enterprise starts from where micro ends. If the other person is doing industrial undertaking, it should exceed 25 lakh rupees. And plant and machinery investment should exceed 25 lakhs, but up to 5 crores. Okay. And if the other person is providing services, then about 10 lakhs and up to 2 crore. If the investment is in equipment is there, it will be called as what? It will be called as what? You can say a small enterprise. Now, what does the law says? Now pay attention, please. Before knowing the provision, we need to also know the due dates of payment under MSME Act. Due dates of payment. Due date of payment as per what? As per MSME Act. Because the law say that you have to pay as per MSME Act. The provision of 43B does not say that you have to pay as per till the due date of filing of return. No. It says that you have to pay as per the MSME Act. So we need to find out the provision as per the MSME Act. What is the due date as per the MSME Act? Okay. Now pay attention. In MSME Act, you need to see two things first of all. Is there an agreement? If agreement is there between whom? Between buyer and seller. Okay. If no agreement is there, then the due date is different. Okay. If agreement is there, then the due date is different. If agreement is not there, then the due date is different. If agreement is there, then you have maximum 45 days time to pay. 45 days or actual credit period, whichever is earlier. Okay. For example, in the agreement, if it is written that you have to pay by 30 days, then you have to pay in 30 days. In the agreement, it is written that you have to pay by 60 days, then you have to pay by 45 days. Okay. So the maximum 45 days time or actual credit period, whichever is earlier. If there is no agreement, then maximum 15 days. That's it. This is the due date as per the MSME Act to make the payment. Okay. So to understand the provisions of 43B, you need to understand the due date as per MSME Act. You can take a photograph. I will also make you read this. Okay. You can take a photograph. Now read. When any person purchases goods from micro small enterprise, the payment shall be made before the date agreed upon between him and supplier in writing. Okay. So you have to make the payment before the date agreed upon between the two. Point number 1. In no case the period agreed between the supplier and the buyer shall exceed 45 days. Point number 2. So maximum how much period is allowed? You both can agree, but maximum 45 days. If it is more than 45 days, you have to restrict to 45 days. Third point, if there is no agreement, then maximum time will be 15 days. Check. Okay. I hope it is clear to all of you, right? Now, in which year I will get the deduction of my expense? See, the law says two things. First, if you make the payment within the time limit, if you make the payment what? Within time limit. then such payment will be deductible on accrual basis. Now listen carefully. On what basis? Accrual basis. Okay. So if you make the payment within the time limit which I have told you just now, 45 days or lesser than that, or 15 days if there is no agreement, then you will get the deduction in the year of accrual. That is in the year in which the expense pertains to. But if you make the payment beyond the time limit, then it will be allowed on payment basis. Okay, it will be allowed on what basis? Payment basis. So just keep it in one thing in mind, that if you make the payment within what? Within the due date, then it will be allowed to you on accrual basis. If you make the payment after the due date, then it will be allowed to you on payment basis. Now for that, let's take an example. Suppose the goods are sold on 1st March 2023. Okay, this is the date on which the goods are sold and you have purchased the goods. Now there is an agreement between you and buyer that you will make the payment by 5th of April. By which date? By 5th of April. So is it within 40 days, 45 days? Yes. 1st March to 5th April, it is within 45 days. So 5th April is okay. Okay. Now in this case, suppose you paid on 3rd of April. Are you paying on time? Yes, I am paying on time. See, what you are supposed to see, first of all, is there an agreement? Yes, there is an agreement. Second thing, you have to see the due date is within 45 days or not. If it is beyond 45 days, then you have to restrict to 45 days. Now, this date is within 45 days. Then third thing which you have to see is the assessee making the payment on time. Yes, 5th April is the due date, assessee is paying on 3rd April. So, is the assessee paying within the time limit mentioned in MSME? Yes. So, it will be allowed on accrual basis. Accrual basis means in which year? It will be allowed in 23-24. Check please. Is it clear? I hope it is clear. Now, suppose if it is paid on 7th of April, on which date? 7th of April, then it is late payment. And if it is late payment, then it is allowed on payment basis. Therefore, it will be allowed in the next year, 24-25, even though in this case, see how this is different from the remaining 6-7 points. Even though in this case, you are making the payment of 7th on April, which is far before the due date of filing of return. Can you see this? But here the question is, in this case, the due date of filing of return is not a benchmark to decide whether the expense will be allowed or not. The benchmark is whether you are making the payment as per MSME Act. Here the due date is MSME Act and not the Income Tax Law 139(1). So therefore, here you are making the payment of 7th of April, but which is after the due date of MSME. Because as per MSME, it was 5th April. You are making the payment on 7th April. Because it was agreed between both of them that the due date will be 5th April. And now you are paying on 7th of April. So it is late as per MSME. And if it is late as per MSME, it will be allowed in the year of payment. So year of payment is which year in this case? In case 2. It is 24-25. Check it please. So this is how you are supposed to what? Understand this particular concept. Okay. You can take a photograph of this, all of you, if you want. Is it clear? I hope it is. Now after 43B big amendment, let's move on to some small amendments now. In 44AA, there is a small amendment. 44AA, which talks about maintenance of books of accounts. Generally, we know that if we do not maintain the books of accounts, if we are liable to maintain books of accounts, and if we do not maintain the books of accounts, there is a penalty under 271A of 25,000 rupees. Now, earlier this penalty used to be imposed by either AO or CIT appeal, but now this penalty will also be imposed by JC appeal. Check it please. Okay. So this penalty will now also be imposed by whom? Joint Commissioner appeal. Okay. This is a small amendment which is there in this particular provision. Now coming to some very big amendments and very important amendments in presumptive section in 44AD also and in 44ADA also. Okay. Now we all know that the limit under 44AD for the turnover is 2 crore rupees and the limit under 44ADA for the gross receipt is 50 lakh rupees. We all know that. Okay. Now this limit is increased by some amount to both the category of people. You can say the limit is increased by 50%. It means 2 crore has become 3 crore and 50 lakh has become 75 lakhs for few people. Okay. Now who are those few people that I am telling you? Okay. Now pay attention please. Who are those few people? Pay attention. Say in 44AD, pay attention. And in 44ADA, in both the section, the limit is increased to 3 crore. And here it is increased to 75 lakhs. For whom? Not for everybody. If your cash receipt is less than equal to 5% of turnover. Here also if your cash receipt is less than equal to 5% of your gross receipt or turnover, whatever you say. So you have to compare your cash receipt with your turnover. You have to compare your cash receipt with your turnover or gross receipt. And if it is within that limit, then your limit for 44 AD will be not 2 crore but 3 crore. And here it will be not 50 lakhs, 75 lakhs. Sir, what about if it is exceeding 5%? Then the limit will be 2 crore and 50 lakhs. So there are two limits now. You have to be very careful about it. Okay. So for whom it is 3 crore? If your cash receipt does not exceed 5% of the turnover. Now you have to compare your cash receipt with what? With your turnover. Okay. You are not supposed to compare your cash receipt with your total receipts. No, no, no. That you have to check in 44AB. In 44AB also there is a limit now, 1 crore, and for 10 crore you have to compare 5%, right? Here you have to check cash receipt compared to all receipts, total receipts in 44AB. That is a very minute point I am telling you. Please be very careful and keep it in your mind. But in 4480, you have to compare your cash receipt with what? You have to compare your cash receipt with your only and only and only what? Tell me, all of you. With only and only and only what? With your total receipt. I hope it is clear to all of you, right? I hope it is clear. Sorry, in 44AB you will compare with total receipt. In this 44AD you will compare with what? Turnover. Even in 44ADA you will compare your cash receipt with your total turnover or gross receipt and not with your all the total receipts. Okay, be very careful. Now pay attention. So there are two limits now. If you are within the limit of cash, you can enjoy 44AD up to 3 crore. But if you are exceeding the limit of cash, then you can enjoy the benefits of 44AD up to 2 crore only. Now cash will include what? Cash will not only include cash, it will include hard cash. Along with hard cash, it will also include bearer check. Bearer check is as good as cash, and it will also include cross check because it is written in the law check. The receipt by a check or draft, which is not account pay, it will be deemed to be cash only. So if your check is not account pay check, it is as good as cash. If your check is not account pay check, we will consider that to be cash only. If your check has to be an account pay check, if it is a bearer check, it is cash. If it is a cross check, it is cash. Be very careful about it. Okay. I hope it is clear to all of you, right? So similar amendments are made at both the places, here also and here also. You can check it over here in 44 ADA also, up to 75 lakhs, up to 50 lakhs. If you are within the limits, then you can enjoy up to 75 lakhs. If you are crossing the limit, then you cannot enjoy up to 75, then you can enjoy only up to 50 lakhs. Okay. Just go through it once and then we'll move ahead with the next amendment. Okay. Now, the next amendment is on page number 12.3, which is in the chapter of income tax return filing provisions. And what is the next amendment? It is in section 139.3. We all know that as per section 139.3, if you want to carry forward a PGBP loss or if you want to carry forward a capital gain loss, then you have to file the return on time and on time. Now, because of some genuine reason, if I am not able to file the return on time, is there any way I can get an extension? Is there any way I can get what? An extension of the time? And the answer is yes. In two cases, you can get an extension of the time in case of loss, and in case of refunds. But you have to make an application to certain authorities prescribed by CBDT. For that, CBDT has issued a circular in 2015. Now, the 2015 circular is replaced now by a 2023 circular. They have issued a new circular and they have changed the limits and they have also changed the authorities over here. So, they have changed two things. First, they have changed the limits. Second, they have changed the authorities also. So, be very careful about it. What is the first thing they have changed over here? Check it, please. Let's see the limit. If your claim is up to 50 lakhs, then you have to make an application to CIT or principal CIT. So, up to 50 lakhs, you can make an application to CIT or principal CIT. If your claim exceeds 50 lakhs, but not more than 2 crore, okay, it exceeds 50 lakhs, but it is up to 2 crore rupees, then you have to make an application to chief CIT. Earlier, the limits were slightly lesser. If the claim exceeds 2 crore, but not more than 3 crore, then you have to make an application to principal chief CIT. Okay, you have to make an application to principal chief CIT. And if your claim exceeds 3 crore also, then you have to make an application to what? CBDT. Check it, please. So these are the 4 layers. Earlier, there were only 3 layers for making an application. Now there are 4 layers for making an application. So you can check it, please. You have to remember these limits. This might be important because this is a recent circular which I guess which came in May 2023. Okay. Now the next amendment is on page number 13.1, which is in the section of special audit. Now we all know that earlier what used to happen, let me tell you first of all. If the AO is of the opinion that the books of accounts are complex, blah, 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 are not proper, are voluminous, doubts about the correctness, multiplicity of transaction, he can direct the assessee to get the books of accounts audited. Okay. And from whom the assessee will get the audit done? The audit will be done through a chartered accountant, which is nominated by a commissioner. Who will nominate the chartered accountant? A commissioner. Okay. This everybody knows. Now there is an addition in this section. What is an addition? Now you as an assessing officer can not only tell the assessee to get the special audit done for books of accounts, now you can also direct the assessee for inventory valuation. So now you can also direct for what? Inventory valuation, and assessee will get the inventory valuation done from a cost accountant. So earlier only audit of books of accounts was possible. Now even inventory valuation is possible. So if the AO doubts about the inventory valuation, he can tell the assessee to get the inventory valued, and then the assessee will go to commissioner. Commissioner will nominate a cost accountant, and then the cost accountant will do the inventory valuation. So wherever the word audit is coming in this section, at that place the word inventory valuation will also come, and whenever the word chartered accountant is coming, there the word cost accountant will also come. Everything else is same only. Everything else is same. Procedure and all will remain same only. It is just that the power is enhanced in this section for the assessing officer. Okay. Now the next amendment is in the chapter of search and seizure. There are few small amendments which are made over here. The very first amendment, which is there on page number 15.2, keynote number 1. Now what is the amendment? We all know that if we want to go for a search and seizure, then the authorized officer can take the help of a police officer. The authorized officer can also take the help of, during the search and seizure, he can take the help of a police officer. He can also take the help of a officer which is recognized by central government. Central government officer can also assist him in search and seizure. Now there is an amendment. Obviously, a police officer will assist, an officer of central government will assist, but apart from that, the government has said that we are going to prescribe few people more. That is, any person or entity might assist you, which is approved by principal chief commissioner, principal director general, or director general. So there might be some more people, there might be some more persons, there might be some more entities which might come for your help during the search and seizure. This is what this paragraph wants to tell you. Apart from police officer, apart from central government officer, there might be some entities now, some big entities government is trying to make, which will help you to do what? Search and seizure. There are some more additional persons which the government is trying to make, which will be approved by what? Chief commissioner, principal chief commissioner, principal director general, as the case may be. So they will help you to complete your search and seizure operations with ease. Okay. Now, a similar amendment is made on the next page, that is under section 132(9)(d). Check here, please. What is this amendment? We all know that during search and seizure, there are a lot of assets which are found, which are undisclosed. Now, the AO wish to value them. So, he can go to valuation officer, okay, as per section 142A, which is there in the previous chapters. So, you can go to the valuation officer, and the valuation officer will value that, and accordingly, you can complete your search and seizure proceeding. Now, the question over here is, here also a similar amendment is made, which was made in the above provision. Here also the CBDT is saying that we are going to prescribe few more persons and few more entity or any other valuer registered by or under any law. So we are apart from the valuation officer which is mentioned in 142A, we are going to prescribe few more persons, few more entity, few more registered valuer, which will be approved by what? The same four authorities. You can check it, please. Same four authorities. So the scope of this section is going to further increase now from Finance Act 2023. But this will actually increase whenever the government will actually prescribe the relevant rules. Okay, till then it is of no use. Okay. Now the third amendment over here in this chapter and the last amendment in this chapter is a clarificatory amendment. When can I say the search and seizure is completed? Now in case of normal search, there are two types in which you can complete the search and seizure. First, go, do the raid, complete the search. In that case, it will be said that on the date on which the Panchnama is drawn, because when the search is completed, the department has to file a report that the search is completed, and that can be called as a Panchnama. Panchnama is the date of completion of the search. But there is one more way to do a seizure, and that is by requisitioning other officers of other laws. Do you remember that I have told you in class? Sometimes the department wants to do the search, but they are not able to do the search because some other authorities have already done the search. So in that case, when can I say that the search is completed? In that case, you can say the search is completed the day on which you receive the books of account from the other authority, or the day on which you receive the assets from the other authority. So whenever the authorized officer will receive the books of accounts or will receive the asset from the other authority, on that day you can say that the search and seizure is completed. This is what this paragraph wants to tell us. It is just a clarificatory paragraph to explain us when can it be officially said that the search is completed. Okay. So in normal case, on the date of Panchanama, in case of requisition, it can be considered as the date on which you receive what? The books of accounts or the relevant asset from the other authorities. Okay. So this is what this paragraph wants to tell you. Now, apart from this, there is no other amendment in this chapter. So let's move on to the next chapter. There are multiple amendments over here. The first amendment over here is in section 148. So in income escaping assessment, the very first amendment is a very important amendment. We all know that what is 148. What is 148? 148 is a notice which is served to the assessee to file the ITR. So if the AO has information in his possession that you have escaped income, etc., then he will serve you a notice that he will tell you to file an ITR. Within how much time? So earlier there was no time limit. So it was written in the law that within a specified period. So how much is the specified period? That was not written in the law. That AO will decide based on case to case. But now the law has defined the time period. That whenever the AO will issue you the notice under 148, you will file the return within a specified time which is mentioned in the law now. Earlier it was not mentioned in the law. So what is the time? Check. 148 has been amended to provide that a return in response to a notice under 148 shall be furnished within 3 months from the end of the month in which such notice is issued. So if the notice is issued in December 23, then it has to be filed by 31st of March 2024. Within 3 months from the end of the month in which the notice is issued. Can I get an extension? Yes, you can get an extension. Yes, you can get an extension. Sir, what if I file a return beyond this time? If you file a return beyond this time, then the AO will not give you any scrutiny notice. He will do your best judgment. In such case, best judgment is the only option that the assessing officer is going to do against you. So by default, whenever the notice is issued, you have to file the return within 3 months from the end of that month. If you don't file the return within the 3 months, can I get an extension? Yes, you can get an extension. You can request the assessing officer. Now, if you don't file the return within 3 months from the end of that month or within the extended period, then the AO will not send you any scrutiny notice for further questioning. He will do the best judgment assessment against you. Okay. So this is what this very important amendment is all about. Just go through it and then we'll move ahead with the next amendment. Now, there are some dangerous amendments made by Finance Act 2023. Dangerous. Once you read this amendment, you will not understand anything in this world. Okay. I want you to read it once. Experience that, please. This first amendment, which is in green. Have you read? Now, what you understood out of this? Nothing. I understood everything. Now, let me read it once. Time limit under 148, 149 for issue of reassessment notice. Third proviso to 149(1). Where a search under 132 is initiated or search for which last authorization is executed or acquisition is made after 15th March of any financial year. Okay. Okay. A period of 15 days shall be excluded for the purpose of computing the period of limitation for issuance of notice under 148. The notice so issued shall be deemed to have been issued on 31st March of such financial year. Now, what do I mean by this? Listen. This is a very special case. Amendment made by Finance Act 2023. Section 149 subsection 1. Amendment number 1, analysis. Shall I? Suppose this is previous year 1920. Assessment year 2021. Okay. And this is the normal case. Please tell me, in normal case, the department should send you notice by which date? 3 years from the 3 years from the end of the grant. As per normal case, department should send notice. Department should send till which date? Till 3 years, that is till 31st March 2024, right? Yes, sir. Correct or not, Palani? Sir, this provision has come from 1/4/2021, sir. Even earlier it was same only. Okay, don't worry. Okay, sir. Done. Okay, let's not get into that from when this provision came. Okay. Done, sir. Now, pay attention, please. We are ignoring when this provision came. We are trying to understand this new amendment today. Yes. Okay. Now, tell me, please. I would like to read it once again. Under section 140. Time limit under section 149 for where a search under 132 is initiated after 15th March of any financial year. Okay, pay attention. Try to understand the problem first. You will understand the amendment. Shall I? Now, suppose the search initiated on 18th March 2024. Okay. Now, 18th March 2024 is obviously after 15th March 2024, correct? Now, suppose if search is initiated after 15th March 2024, listen carefully. Yeah? Just try to understand the problem which the department used to face, so that they brought this amendment. Otherwise, you will not understand the amendment. Now, tell me, we have learned little bit process of assessment under 147. After search is initiated, tell me, is there any need to send an inquiry notice? Is there any need to send inquiry notice? Step by step, tell me. There is no need to send inquiry notice under section 148A, correct? Second, but is the department supposed to send the notice under 148 to file the ROI? Yes, 148 notice is supposed to be sent or not? Yes, sir. But notice under section 148 to file what? ROI is to be sent. Is supposed to be sent. Till which date? Till 3 years from the end of the... Can I say till 31st March 2024? Yes, now, because search has just completed, is it possible or not? Suppose if the search is conducted, say on 29th of March. On which date? Let's not take 18th of March. Let's take 29th of March. You will understand more realistically. Just try to understand if the search is initiated on 29th of March. Okay? Now, the department is in lot of chaos. What chaos? They are in lot of hurry. They will be in lot of hurry to complete the search. And then they will be in lot of hurry that, come on, let's go to department fast. We have to send the notice by 31st of March. Otherwise, if we don't send the notice by 31st of March, then the entire notice will be invalid or not? Please tell me now. Especially if the search is happening in the last 2 weeks of the year, right? So search is a long process. Search can go for few days, and after that the department have to work out few things. Then they have to send a proper notice, etc. Right? So it will take some time or not? Tell me now. So in this case, the government has done an amendment. Now what is the amendment? Listen. The amendment says that the AO will get what? Will get extra what? 15 days. That is till which date? Now, there are two possibilities. First, if he sends notice till what? Then it is a valid notice. Then it will be deemed that notice is sent on 31st March 2024 only. Read, that is the line which is given in the law. Check.
Yes, sir.
Can you understand that?
Yes, sir.
But if he sends the notice, what? After 15th April 2024, then it will be a late notice. That is invalid. Is it clear, Palani? Now you can read the paragraph. You will understand everything properly. Now, shall I relate with that provision?
Sir.
Read with me, Palani. Where a search under 132 is initiated. Is the search initiated under 132 in our example?
28th March. Yes, sir.
Is it after 15th March of any financial year? Tell me now. A period of 15 days shall be excluded for the purpose of computing the period of limitation for issuance of notice under 148. Okay? 15 days will be excluded means you will get 15 days extra. That's it. The notice so issued shall be deemed to have been issued on what? 31st March. You just write down in this bracket over here. This provision is applicable if time limit is expiring in current year. Expiring in what? Current year. Now, obviously, if time limit is not expiring in the current year, there is no need for this provision now. Yes. Suppose this search is conducted in 23. Then is there any need to do all these things? Then you always have one more year now to send the notice. So just write down this point over here, please. That is very important. This time limit, this provision is applicable if time limit is expiring in the current year. Is it clear? Now I want you to what? Write down this with your hand. Don't just take a photograph. Write down this with your hand. That you will remember. Otherwise you will not remember. This is an amendment. Important it is. So now there is one more amendment which has come over here, which is made by Finance Act 2023. The amendment, the first amendment which was made, we have seen this particular thing. I hope you have noted down also this particular example, right? That if the search is happening after what?
After 15th March 20.
After 15th of March of a financial year. And there is no need to send any inquiry notice in case of search, we all know, right? Right? But the notice under 148 to file the ROI is supposed to be sent till 31st of March. So as per normal case, the department should send it 31st March 2024.
Yes, sir. 3 years from
But the AO will get extra 15 days. Okay?
Yes, sir.
That is, he can send till 15th of April. If he sends till 15th of April, it is valid. If he sends after 15th of April, it is an invalid notice, right?
Yes, sir. Yes, sir.
Now, we'll talk about the second amendment. Amendment made by Finance Act 2023 once again. Again, the second one also required some kind of analysis from our side. Shall we read? Let's read it once. The time limit under section 149 for issue of reassessment notice, where the information deemed to be with the AO emanates from a statement. Listen carefully. Again, it's a very dangerous paragraph. Now, please tell me, should the AO require an information or not? To start with 147, please tell me.
Yes, sir. He needs proof.
He needs proof, right? Now the proof. Yes, except in few cases. But the proofs can be in various forms, right? It can come from various forms. So where the information deemed to be with AO emanates means it originates. Just write down over here. It originates from a statement recorded or documents impounded under summon or survey as the case may be. So the information is coming from where? It is coming from a summon or survey, right? It is coming from a statement recorded under summon or documents impounded under survey as the case may be on or before 31st March of a financial year. In consequence of a search initiated or last authorization executed under 132 or acquisition made under 132A, after 15th March of such financial year, a period of 15 days shall be excluded for the purpose of computing the limitation under 139. In such a case, show cause notice issued under 148AB shall be deemed to have been issued on 31st of March of such financial year. Now, what do I mean by this paragraph? Again, this paragraph is a dangerous paragraph. I want you also to read it once and then we'll have a discussion. Just read it once. Okay. Now, what do I mean by this? Analysis of amendment number 2. What is happening? Pay attention, please. Suppose this is previous year 23-24, which is assessment year. Sorry. Now, income is escaped in this year. So, if income is escaped in this year, so by when the department can send you the notice normally?
3 years from the end of the calendar year. So
Yes, they can send you notice.
148 up to
Notice under section
48.
148 shall be sent till 31st March 2028 in what? Normal case, right?
Yes, sir. Normal case.
Now, to send this notice, should the department have information or not?
Yes, sir. Information or proof.
Now, AO got information from someone under section 131, right? That's what it is written, right?
Summon or survey. Yes, sir.
Or survey under section 133A. He got information from there, right?
Sir.
Now, please tell me in case of summon or in case of survey, if he gets please see here, please, if he gets information from summon, if he gets information from survey, okay, is he supposed to send you an inquiry notice under 148A? First tell me that. If his source of information is summon or survey, is he supposed to send you an inquiry notice? The answer is yes. Inquiry notice is not required in case of what? In case of search. Do you remember that? In some cases, there is no need to send inquiry notice.
Yes, sir.
Right? In case of search and in case of faceless in collection of information 135A. Right? But in case the information comes from summon, in case information comes from where? Summon. Or if information comes from where? A survey. The AO is supposed to what? Send a inquiry notice. Now, this got completed. Suppose this was received on. This was received in January or February 2028. Okay, see the dates are properly. This happened when? In February 2028. Now, after that, the department did a search. Search and what? Seizure. Is it possible? They can also do search and seizure after that?
Sir.
Tell me now, please.
Yes, sir.
Yes, they did search and seizure on 25th of March 2028. Okay. Okay.
Okay, sir.
So, in this case, what shall I follow? Okay. Search has just happened on 25th of March 2028. Okay.
Clear, sir. Clear.
An officer has got information of escaped income from where? Please tell me.
2020.
From someone and from survey. So in this case also, the information has not got from search. The information has originally got from where? Tell me. Summon or survey. In fact, non-compliance of summon itself is called as what? Is subject to what? Search and seizure. You all know that, right? So in this case, what the department says, now let's see. Now we will appreciate the provision. Where the information deemed to be with the AO originates from where? From a statement recorded or documents impounded under summon or survey, as the case may be, on or before 31st March of a financial year, comma, in consequence of, comma, a search. So because of this information, you have started with what? Tell me. Because in consequence of, you have started with what? A search. Because of what you have started? You have started the search because you have issued a summon earlier. You have issued what? A survey. You have done a survey earlier. So now you are doing what? You are doing search. A period of 15 days shall be excluded for the purpose of computing the period of limitation under section what? 139. Okay. So in this case also, you will get what? 15 days. What? Relaxation. So the same thing which is written over here. AO will get 15 days extra. Correct?
Yes, sir.
That is valid up to
15th April 2028.
or invalid
It is after 15th April 2028.
after 15th April 2028. Now, one more question that I would like to ask you. Please tell me how this amendment is different from the previous one. How? Otherwise, both of them are looking same only, na? In this previous amendment, what was the source of your information? Search. And do you know that I have told you in the last lecture? We have given a lot of time. Please try to recall it. It's not easy, I understand. It's a very difficult concept. But do you remember that if search is conducted, then there is no need for information? Do you remember that?
Yes, sir.
Deemed information. Secondly, if search is the source, there is no need to do any inquiry also. Do you remember that?
Yes, sir.
That's the reason in this amendment, we are directly sending what? Notice under 148. There is no need to do inquiry under 148A, right?
Yes, sir.
Yes or no? But here, what is the source of information?
Summon or survey.
Summon and survey. And in case of summon and survey, you need to send what? Please tell me. An inquiry under 148A, right? So the year also there is one more amendment which the government has said that if, let's read the last line. There is a need for a survey, there is a need for an inquiry notice over here. In such a case, a show cause notice issued under 148B shall be deemed to have been issued on 31st March of such financial year. So, whenever you send the notice, okay, obviously you will send the notice before this only, na? Before this only, na? If you want to do a valid assessment? Yes or no?
Yes, sir.
So, the show cause notice under section 148A shall be what? Shall be deemed to be
Sent on 31st March 2028.
issued on 31st March 2028. Is it clear? Okay. Because they also have to send an inquiry notice, na? Yes or no? Yes. So just take a photograph of this, please. I don't think so. It's very important for exam. I don't think so personally. But nevertheless, it's an amendment. Maybe it's important. Okay. Now let's go ahead with the next point. Now there are some less important points. Let me tell you very clearly, not relevant for exams. What used to happen before 2021 that I have told you if you remember.
Two sections, 147, 138.
Don't focus much on that. In anyways, that is given in your book also, but don't focus much on that. That is not relevant for exams. Now there is one last thing which I would like to tell you. Okay. And I will also give you an example on the same. Pay attention on the board, please. All of you, please see here. Now there is this last point which is also relevant for us. Pay attention, please. Again, for this also, I'll give you some example. Example on time limits. Pay attention, please. Suppose this is previous year 23-24. Assessment year 24-25. Now, suppose the AO has sent a enquiry notice. Under section 148A. Issued on, pay attention please. Issued on, say 15th of March 2025. Sorry, 2028. Okay. Now, how much time I can give in inquiry notice? I gave around 25 days. Can I give 25 days to the assessee to reply?
Less than 7 days up to
Less than 7 days up to, not less than 7 days, but not more than 30 days, right?
Yes, sir.
So, last date to reply is what? Last date to reply by assessee is what?
25 days now.
25 days means it is 9th of April
9th of April
28. Okay.
Yes, sir.
Now, assessee replied on what? 9th of April 2028, for example. Okay.
Okay.
Now, assessee, after receiving the assessee's reply. Okay. Should the department pass an order after that? Do you remember that the department has to pass an order? Whether it is a case which is fit for 147 or not, right?
Yes, sir.
So, the AO passed an order. AO
Passed an order.
passed order under section what?
48A subsection 5.
148A clause D. Okay. Till when he can pass the order? 1 month from the end of the month in which the reply is received. See here, leave it.
Yes, sir.
1 month from the end of the month in which the reply is what? Received. What is the last date?
31st May 28.
31st May 2028 is the last date. Now please tell me after that, the AO will what? Notice under section what? 148, right? To file what?
To file ROI.
Now please tell me whether this notice will be late or not. It will be late or not. It will be beyond time limit or not. First of all, tell me by when the notice should have been sent. It should have been sent within 3 years from the end of the relevant AY.
Yes, sir. Yes, sir.
So by that logic, it should have been sent till 31st March 2028, right?
Yes, sir.
Now you are sending what? After May?
Yes, sir.
So is it late or not?
And invalid notice.
It's an invalid notice, right?
Sir.
So the government tells you that, listen, there is some extension which is given by the government. Check here. For the computing the period of limitation for issue of notice under 148, the time or extended time allowed to the assessee. In what? In providing opportunity of being heard, or the period during which such proceedings before the issuance of notice under 148 are stayed by court or the injunction of any court shall be excluded. Shall be excluded. So whatever time is allowed to the assessee in providing what? Tell me. Opportunity of being heard. That much time will be what? Excluded. It means the AO will get what? Tell me. Extra time. What is the original time that the AO should have got? Tell me.
31st March 2028.
Original time. AO should have got is what? 31st March 2028. In that, he will get what? Extension.
Yes, sir. Extension to the extent of the time allowed to us.
How much time was allowed to the assessee?
25 days.
25 days. So with that logic, the last date to issue should be 25th of what? April 2028. He cannot issue beyond this date. Is it clear? He could have issued till this date. Okay? Is it clear?
Yes, sir.
Now, let me read it once again. The provision. Let me go ahead. If after excluding the period, the time available to the AO for passing the order about fitness of a case of a notice under section 148 does not exceed 7 days, the remaining period shall be extended by 7 days. Now pay attention, please. Now what do I mean by this? Pay absolute attention. See here, please. There is one example which I am trying to show you now on the textbook, which will help us to understand this example in a better manner. Shall I? Which is on page number 17.5. On February 20th, 2024, the AO issues a show cause notice under 148B to X Limited as to why a notice under 148 should not be issued. On the basis of what? Tell me. Information which suggests that rupees 40 lakh chargeable to tax has escaped assessment for AY 2021. So if it is AY 2021 and if the escaped income is 40 lakhs, for how many years you can send the notice?
3 years from the end of the return.
3 years. That is till 31st March 2028. You can send 148 notice, right?
Yes, sir.
Now the AO has sent you an inquiry notice on 20th Feb 2024. Okay. Now X Limited has to reply within 10 days. It means X Limited has to reply by, say, for example, say within 10 days, whatever it comes to. After considering the reply of X Limited, AO passes an order indicated that it is a fit case to issue notice under 148. After recording his reason, the AO issues a notice on April 6, 2024. On which date AO passes an order? On April 6. By default, it is late or not? Yes, because it should have been sent by 31st of March. So X wants to know whether or not the notice under 148 is issued within a time. Now see, what is the original time? Plus, will the AO get 10 days extension in this? Tell me. Yes. So after extension, the time limit is coming to what? April 10, 2024. When the AO has issued the notice? Therefore, it is a, say, it's a valid notice. Is it clear? You have to just add the extension period and then you have to check what? After the extension, whatever date is coming, are we sending the notice before that or not? Is it clear? That's it. You don't have to check anything else. Okay?
Yes, sir.
Now, pay attention, please. Now, what is this line of 7 days? I will come to that after some time. In some other provision, I will be discussing this. This 7 days point, I will be talking later on. Right now, I am not talking about that 7 days period as of now. If after excluding the period, time available to the AO for passing the order about fitness of a case for the issue of notice does not exceed 7 days, then the remaining time shall be extended to 7 days. We'll talk about that in some other provision. It will definitely come. Don't worry. Okay. So I'll be dealing with that along with 2 provisions together only. Right now, I am not saying. Anyway, this is a small provision, not very important again for the exam. Yes, these can be important because these are what? These are some important amendments made by Finance Act 2023. Now, let's go ahead with the last few things. Before that, if you want, you can take a photograph of this. Okay. Okay. Now, we have been saying one thing from the very first time from this section, that, pay attention please, that you have to take some approval from higher authority, right? If you want to send notice and all, correct? Yes, if you want to send notice under 148, you need to take some approval from higher authority. Now, who are those higher authority? Shall we see that? So now there are 2 categories to issue notice. One is up to 3 years. Another is up to how many years? Up to 10 years. So if you are sending notice for 3 years or less, okay, that is the cases which are less than 50 lakhs cases, right? Then you have to take approval from whom? Principal Chief Commissioner of Income Tax, Principal Director of Income Tax, Commissioner of Income Tax, or Director of Income Tax. Is it clear? You have to take approval from them. If it is more than 3 years, then Principal Chief Commissioner of Income Tax, Principal Director General of Income Tax, and these lines are striked off by Finance Act 2023. Okay. Earlier it was where there is no Principal Chief Commissioner or Director General, there is no line like this now. There's nothing like that. Now directly the third authority is what? Chief Commissioner of Income Tax or Director General of Income Tax. Okay, is it clear?
Yes, sir.
Further, they have said that for the purpose of provided that the period of 3 years for the purpose of clause 1 shall be computed after taking into account the period of limitation as excluded by third, fourth and fifth proviso or extended by sixth proviso to section 139(1). Now, what do I mean by this sentence? Listen, please. This sentence tells us that whatever time you will compute, okay, you should compute after giving all these relevant extensions. Can you see this extensions? This is an extension now or what? Yes, right? Third proviso, fourth proviso, right? So after considering all this extension, you have to send what? Notice. Okay, it just wants to tell us that. Is it clear?
The extensions are only for 3 years, not for 10 years.
It's not for 10-year category. Okay. Is it clear?
Yes, sir.
So the provided that the period of 3 years for the purpose of clause 1 shall be computed after taking in account the period of limitation as excluded by third, fourth or fifth proviso or extended by the sixth proviso to section 149(1). Is it clear? So in short, it wants to tell you whatever extension you wants to give, you give it. Okay. There's no harm in that. You have to compute the time limit after giving extension. That's it. So today we are going to start with what? Our second remedy, as we have done the first remedy in the last class. Okay. So what is the second remedy, which is the biggest out of all three and the most important also, we can say? That is appeals. Okay. Now there has been a drastic change in the appeals from Finance Act 2023 onwards. So pay absolute attention, please, all of you. Okay. There is an AO who is passing an order. If assessee is what? Agreed with this order. Assessee can go for what? Please tell me.
Can go for appeal.
Can go for appeal to CIT appeal. Okay.
Yes, sir.
If the matter is not won over there, then you can go for what? ITAT. If the matter is not closed there also, you can go for what? And if the matter is not closed over there also, you can go where? The Supreme Court. And then that is the last appellate authority which is possible for us to go. For anybody in this country, the last appellate authority is the Supreme Court of India. Now pay absolute attention, please, all of you. So AO has passed the order. You are aggrieved. Go to CIT appeal. Now there has been a drastic change over here. Drastic change over here. Please be careful with what I am trying to say now. There has been huge amount of pressure on CIT appeal over the years. There has been plethora of cases which are pending in front of CIT appeal. And CIT appeal is not able to what? Discharge and finish off so many cases. So Finance Act 2023 has made a very big amendment. Very big amendment, and has said that below CIT appeal,
Below CIT appeal.
we are creating one more authority, that is JC appeal. That is what?
JC appeal.
JC appeal. And some orders will be appealable to JC and some orders will be appealable to whom?
CIT appeal.
CIT appeal. We are not going to appeal all of them to what? CIT appeal. Because CIT appeal does not have that much power, that much time, that much resources to complete the cases at their end. Therefore, they have made an alternate authority which is below CIT appeal. So earlier, all AO's order used to be appealed to CIT appeal. But now some orders will be appealed to JC appeal, some of them will be appealed to what? CIT appeal. So first of all, we have to see that which orders will be appealed to whom?
CIT, which should
which will go to CIT appeal and which AO's order will go to JC appeal. We have to see that first. So for that purpose, I have made a box over here. Chapter number 18, please, all of you in your color book.
Yes, sir.
So if an order is passed by AO, passed by whom? Below the rank of JC. Below the what? So if the order is passed by AO below the rank of, is JC also an assessing officer? First of all, tell me that. Yes, in some cases, JC is also what? An assessing officer. So if an order is passed by an AO, which AO? Which is below the rank of JC. Is JC, again I am asking, is JC also an assessing officer or not? Palani?
Yes, sir. JC, DC.
Yes, they are all assessing officer, right?
Yes, sir.
So if the order is passed by whom? Repeat.
Assessing officer below
Below the rank of joint commissioner, then you will appeal to joint commissioner. Okay, it's very obvious now. If an AO itself is joint commissioner, AO himself is what?
joint commissioner.
Then you cannot appeal to joint commissioner, na?
Yes, sir. Logical.
You have to. It's at the same level, na?
Yes, sir.
It's at the same level. So if the AO is below whom? Joint commissioner. Then you will appeal to whom? Joint commissioner appeal. There are some examples of some order which are mentioned over here. Out of that, some of the orders we know. 143.1 we know. Processing of return. You will appeal to whom? Joint commissioner. Okay. 143.3, 144, 147, 200A1. What is 200A1? Tedious intimation. Do you remember that?
Yes, sir. Remember.
What is 206CB subsection 1? That is TCS intimation. Rest of the provisions we don't know. What is 154? Rectification orders, right?
Yes, sir.
So if the officer is below JC, then you can go to JC. If the officer is what? Below JC, then you appeal to JC. There is something more written over here. No appeal, however, can however be filed before the Joint Commission appeal where an order has given beside is passed by or with the approval of an income tax authority above the rank of deputy commissioner. So who comes above deputy commissioner? It is JC only. Yes? Above deputy commissioner is who? JC only, na?
Yes, sir.
Assistant commissioner, deputy commissioner, who comes just above them? It is JC.
JC.
Now, similarly, if the assessing officer himself is what? Assessing officer himself is a joint commissioner, then he will appeal to whom? Tell me. Then he will appeal to CIT appeal. Is it clear? Yes, please.
You told that generally in case of majority case joint commission will not handle most. Then what
Right.
is the use of
Yes, I have told you that majority of the cases will not be handled by joint commissioner. I agree. That's the reason we don't want to put much pressure on what? CIT appeal. Majority of the cases will not be handled by JC. I agree. Very few cases will be handled by JC. And we want only those few cases to go for what? For an appeal to CIT appeal. We don't want to put much pressure on CIT appeal. We want to delegate maximum work to whom?
joint
To the joint commissioner appeal. Okay.
Yes, sir.
Now, this is the first thing that they have done. So just keep this thing in mind. Once again, tell me please, all of you. Who will appeal to JC? Which orders will be appealable to JC?
Officers who are below the rank of joint
Assessing officers order below the rank of JC will be appealable to JC. And whose order will be appealable to CIT appeal?
assessing officer who is a joint commissioner.
Assessing officer who is a joint commissioner, his order will be appealable to CIT appeal. Correct?
Correct.
Now, just wait. Just wait, see here. Don't, just wait. Palani, see here. Now, this is what which is going to happen in future. Okay? This is what which is going to happen in what? Future. Right? Right or not?
Yes, sir.
Now, what about the pending cases? Can there be already pending cases which are there in front of CIT appeal?
That is what he did. Pending is
Who's pending cases? Listen carefully. There might be some pending cases. What has to be done with pending cases? Let's see. Transfer of appeal pending with CIT appeal. To whom?
joint commissioner appeal.
So if the appeal is pending, So till last year, all appeals were pending with whom?
CIT appeal.
CIT appeal. So we have to transfer those appeals to whom? Tell me.
Joint commission appeal.
Which appeals? Will you transfer those appeals to Joint Commissioner which are in respect to JC's order?
No.
No. Which are in respect of what? Order below JC. Below the rank of JC. Is it clear? So let's see. Where any appeal filed against an order as given above is pending before CIT appeal, the board or an authorized income tax authority may transfer such appeal to JC appeal. After such transfer, the JC may proceed with such appeal or matter from where? From the stage at which it was before it was so transferred. Okay. Where an appeal is transferred under the aforesaid provisions, obviously the appellant shall be given what? Please tell me the opportunity of being heard. So please tell me, it's a very simple and self-explanatory paragraph. From where you are transferring the appeal, from where to where?
CIT appeals to
We are transferring all that matter from CIT appeal to whom? Please tell me.
JC appeal.
To JC appeal. Once it is transferred, from where the JC appeal will continue? Will JC appeal will restart the proceeding?
No. From the
No.
stage where he left it.
So from the place, from the stage where the CIT appeal has left the proceeding, the JC appeal will continue the proceeding. Is it clear?
Clear.
Next. Now, transfer of pending appeals with JC appeal to CIT appeal. Now, what do I mean by this? Okay. Transfer of what?
JC appeals to CIT appeal.
Pending appeals with what? It's a vice versa case of this. It's a what? Let us read and then we will understand what is this exactly. Okay. Just wait. Notwithstanding anything contained in 246.1, 246.2, the board or authorized income tax authority may transfer any appeal which is pending before JC appeal to CIT appeal, who may proceed with such appeal or matter from the stage at which it was before it was so transferred. Where an appeal is transferred under the aforesaid provisions, the appellant shall be provided an opportunity of being heard. The board may specify the provision of 246.1 shall not apply to any case or any class of case. Now, obviously, there will be a doubt which will come to our mind that how this is what?
How this is there?
How this is
Possible.
possible, right?
Yes, sir.
Now, what is possible? Pay attention on the board. CIT appeal might have what? Might have lot of cases pending. Therefore, the government brought what? JC appeal to transfer few cases here. Right? But how the other way around is possible? Right or not?
Yes, sir.
How other way around is possible if, listen carefully, is there a possibility that there might be too much pressure on JC appeal in future?
Yes, sir. Possible.
Because all the orders, majority of the orders are passed by below JC AO only, right?
Yes, sir.
If majority of the orders are passed by AO below JC, there is a quite possibility that there is too much pressure on JC appeals, right? So that's the reason this provision has been made. That if required, what? The department can transfer the case from whom to whom? Please tell me. JC appeal to whom? Please tell me.
CIT appeal.
To CIT appeal. Is it clear to everyone? Please tell me.
Yes, sir.
Is everyone clear?
Clear, sir.
Yes. So what we understood so far, let me recap it once again because it's an amendment which is very important for exams. We have started with our second remedy appeal. So in appeal now there are, the first appellate authority has two authority, right? In appeal there are total 4 authorities. First of all, CIT and JC appeal. Second is ITAT. Third is High Court. Fourth is Supreme Court. Now the first one is split into 2 parts. CIT appeal, JC appeal. Who will go to JC appeal? Where the AO's order is below the rank of JC. Okay? Those will go to JC appeal. Who will go to CIT appeal? Where the AO himself is what? Is a joint commissioner. You will go to whom? You will go to CIT appeal. Now the question is, what will happen with the pending cases with CIT appeal? Those will be transferred to JC appeal. In future, if there is too much pressure on JC, then we can transfer back the case to whom? Please tell me. CIT appeal. Is it clear?
Clear.
Now, when you transfer the case from one CIT to JC or JC to CIT, you have to give opportunity of being heard to the SSC. Is it clear?
Option B is a reheard.
I hope you are clear with this. Correct? Now the next amendment is on page number 18.3, which is in the second appellate authority, that is ITAT. In ITAT, they have inserted certain sections, certain orders now which you can appeal to ITAT, which were not earlier possible to appeal to ITAT, like an order which is passed by CIT and which is passed under 271 AAB, 271 AAC, 271 AAD. What are these orders, sir? I'll tell you one by one. These are penalty orders. 271 AAB is the penalty for search and seizure which is passed by CIT appeal. 271 AAC is a order where you have some undisclosed income on which 78% tax is already imposed. Remember or not? 10% further penalty is imposed under 271 AAC. This is that order. And 271 AAD is penalty for fake invoice. That is also passed by CIT appeal. So these orders which are passed by CIT appeal, earlier it was not appealable to ITAT because it was not mentioned in the appealable order. So now they have mentioned those orders in the appealable order. So you can appeal to the ITAT now. Okay. That is the first thing. Second thing. We all know that JC is a new authority which has come now. Okay, JC appeal. Just now we have seen that the government has divided all the work between JC appeal and CIT appeal. So now if there is an order which is passed by JC appeal under 154, that is rectification, under 250, that is appeal, under 270A, that is penalty, that is 271 penalty, 271A penalty, AAC penalty, AAD penalty, 271J penalty. In all these sections, JC appeal has been mentioned now. So now if in all these sections JC appeal has been mentioned, then definitely you have to make a relevant provision for an appeal also now. So now all these orders which are passed by JC appeal, now it can be appealed to whom? If you are not happy with this order, you can appeal to ITAT. Okay. Then an order which is passed under 263, that is revisionary order, or 272A, that is again a penalty order, which is passed by Principal Chief Commissioner, Principal Director General, Principal Director of Income Tax, Director of Income Tax. Earlier this was not appealable, so now you can appeal it. Okay. This was not appealable earlier. So now you can appeal these orders also. And one last thing over here. Order which is passed by Commissioner, PCIT, Principal Commissioner or Commissioner, under 12AA or 12AB. What are these orders, sir? These are orders which are passed under 12AA, 12AB with respect to trust. Trust, for cancellation of trust. Remember or not? ATG, that is for granting a registration under ATG or cancellation or registration under ATG. 263, revisionary order. All these things are earlier there. So here they have mentioned what? These two authorities. Earlier these two authorities were not mentioned over here. Okay. So these are some of the amendments. This is not very important for exam because this is just a insertion of certain new sections which were not present earlier. Okay. Now, one more amendment is made over here with respect to memorandum of cross objection. We know that what is memorandum of cross objection under ITAT. See, if I file an appeal, if assessee file an appeal in ITAT, then the department has to file a memorandum of cross objection within 30 days, if you remember, in form number 36A. So the respondent has to file a memorandum of cross objection. If assessee files an appeal, department will file a memorandum of cross objection. If department files an appeal, assessee will file a memorandum of cross objection within 30 days in form 36A, if you remember. So this is what memorandum of cross objection is all about. But what is the amendment here? The amendment is earlier memorandum of cross objection was supposed to be filed by selected class of people. Not everybody was to file. Only few class of assessees and few class of department people were supposed to file memorandum of objection. But now the amendment is made that all classes of cases, in all cases you have to file memorandum of cross objection. Check it please. So this is a small amendment. Now the next amendment is in the chapter of profit link deduction, page number 20.2, completes 80 IAC. Now what is this amendment all about? It's a regular amendment which has been made since last 5 years every year. See, 80 IAC, which is the deduction for eligible startup. Here the government has again increased the time limit from April 23 to April 24. Check please. So they are increasing this time limit since 2019. 2019 to it happened 20, then 21, then 22, then 23, now 24. Every year they are increasing this time limit by 1 year. Check it please. Now there are some small amendments which are there in AMT. And what is that amendment? The AMT provision says that if you are exercising any optional scheme, any new regime, if you are exercising any new regime under 115 BAC or under 115 BAD, which is for cooperative society. 115 BAE is also for cooperative society. 115 BAC subsection is also for cooperative society. If you are exercising for any of the new regimes where the rate of tax is what? Lower, then there is no need to follow what? AMT. There is no need to follow AMT. I will be speaking about these things in the respective regimes also whenever I will be speaking about the amendment. Okay. Like 115 BAE I will be speaking. So at that time also I will say that there is no need to pay any AMT. 115 BAC subsection 1 I am going to speak. That time also I will say there is no need to pay what? Any kind of AMT to anybody. Okay. So don't worry about it. So if you are following a new regime, then you don't have to pay any kind of AMT in that case. That is what this provision wants to tell you. Check it please. Now the next amendment is in the chapter of penalty. Now wherever the word CIT appeal will come now, at least 99% of the cases the word JC appeal will also come. CIT appeal, JC appeal, CIT appeal, JC appeal, CIT appeal, everywhere, almost everywhere except one or two places. Wherever it will not come now, that also I have mentioned. I'll show you. Just wait. Like in this section 271 AAD, CIT appeal, JC appeal, CIT appeal, JC appeal. Okay. Now, but there are few places where it is not there. Okay, I'll tell you where. See, in 271 AAB, that is penalty in case of search and seizure. Here, CIT appeal is there, but JC appeal is not there. That also I mentioned. Don't worry. Don't worry, for your ease of reference. So in this section, there is no mention of JC appeal. This power is not extended to JC appeal of imposing penalty in case of search and seizure. That is only with CIT appeal. Be very careful. So in the chapter of penalty, there are not much amendments. There are hardly one or two amendments which I am going to deal with you now. At maximum places, it is only the same amendment CIT appeal along with JC appeal. Okay. Now, the first amendment which is in 269 SS and also a similar amendment which is there in 269 T. Now, what is the amendment? Pay attention, please. What is 269 SS? 269 SS very clearly says that you cannot take a loan, deposit or specified sum of 20,000 or more from any person if you receive by other than account pay check, account pay draft, ECS and such other electronic mode. So, if you receive that in other than these four modes, then you have to pay penalty. Now, the limit of 20,000 is increased to 2 lakh rupees to few cooperative societies, not to everybody. So, if a certain cooperative societies are taking loan or deposits, then the limit is increased to 2 lakh rupees to them. Now, who are those fortunate cooperative societies? First, primary agriculture credit society, point number 1, or primary cooperative agriculture land and rural development bank, point number 2. So, primary agriculture credit society, primary cooperative agriculture and rural development bank. If these are the two cooperative societies, they can take cash loan less than 2 lakh rupees also. So, for them, this section is only applicable if they receive cash of more than or equal to 2 lakh rupees or bearer check of more than or equal to 2 lakh rupees. Otherwise, for these people, this section is not applicable. Similarly, under 269T also a similar amendment is made. You can check it over here. Okay. Similar amendment is made in 269T also. I hope it is clear. Okay. Now, one last amendment is there over here in this chapter of penalty, which is under 276A, and this is a sunset provision. Sunset provision means, sir, there is some imprisonment provision which was there. The government is removing there. So, what is the imprisonment provision? For example, I am a liquidator of a company. So, as a liquidator of company, I have to give a notice to the assessing officer that I am the liquidator of the company, that I am appointed as a liquidator of a company. If I fail to give the notice to the officer, then the officer can impose prosecution on me for 2 years. He can put me in jail for 2 years for not informing him. What are you saying, sir? Yes. For not informing him, he can put me in jail for 2 years. For 2 years, he'll put you in jail for not informing. Yes. But this provision of putting in jail for not informing the officer is removed now from 1st of April 2023. Check. A sunset clause on the section with effect from March 23. Consequently, no fresh proceeding shall be launched on or after 1st April 2023. But The earlier prosecution will continue. All the old prosecutions will what? Will continue as it is. Check it please. Now, the next amendment is on page number 25.4, which is in section 79. A small amendment is there with respect to certain startups. So, in startup, there is one small amendment that earlier year it was written 7 years. So, they have removed 7 and they have put 10 years. Just this is the small amendment, nothing great as such. Check it please. Okay. So, instead of 7, you will find out now here it is 10 years. Okay. Now, the next amendment is in AIF, that is investment fund category 1, category 2 AIF. There is an amendment in the definition of AIF now. Earlier AIFs were the fund which were registered as per the SEBI laws, but now the fund can also be registered as per the IFSC law. Check please. So, the fund now can be registered either under SEBI law or they can also be registered under the International Financial Services Center Authority Regulations 2022 under the International Financial Services Authority Act 2019. Okay. Now let's move on to some very important amendment from TDS chapter. The very first amendment which is there in TDS chapter is there in section 192A, which is TDS on Provident Fund. Generally, in case of Provident Fund, if the payee does not give a PAN, then you have to deduct TDS at 42.744%, that is MMR. Remember, this was just an exception. Generally, though, if the other person does not give a PAN, you deduct TDS of 20%. But here it was 42.744%. But that 42.744% is no more relevant now. So, Finance Act 23 has made an amendment to make this at par with what the other provisions of non-deduction of TDS. So, just like in the other provisions, we do not have to deduct, we have to deduct TDS maximum at 20% if the PAN is not given. So, here also you have to deduct TDS at maximum 20% if the PAN is not given. Okay. Now, the next amendment in the chapter of TDS is in section 193 itself, the very next section. In 193, there were certain exclusions in which we were not supposed to deduct TDS, and one amongst them was if your security is listed and demat. If your security is listed and demat, there is no need to deduct any TDS in that case. But now this is removed. What do I mean by this? It means now you have to deduct TDS if the security is listed and demat. So listed plus demat, there is no need to deduct TDS. That criteria is no more relevant now. So in this case also you have to what? You can write down here deduct TDS after Finance Act 2023. Okay. I hope it is clear to all of you. One more amendment which is a clarificatory amendment which says that if any interest is payable by SPV to business trust, do you remember? If SPV pays an interest to business trust, then that is exempt under 1023 FC. And the question is, if that is exempt under 1023 FC, the question of TDS does not arise only, but it was not written in the law. So, Finance Act 2023 has written that in the law that if the SPV is paying interest on security to the what? To the business trust, then that interest will not be subject to what? TDS. Check it please. Now there are multiple amendments which are made over here. In 194B, there are 3 amendments which are made, and in 194BB, there is 1 amendment which is made, 1, and 3 amendments in 194BB, and there is a new section also which is inserted here. So there are multiple things over here. You have to pay attention absolutely. First, what are the 3 amendments which are there in 194B? First, earlier in 194B, betting and gambling was not covered. Now even betting and gambling is covered along with winnings. So winning from card game, lottery, puzzle, KBC, etc. All those things are already covered, but now even betting and gambling is covered in 194B, first amendment. Second amendment. Earlier, the limit was 10,000. Now also it is 10,000 to deduct TDS, but the word aggregate was missing earlier. So now they have inserted the word aggregate. So there was a doubt in the people's mind that when should we deduct TDS? When the individual payment 10,000 or the aggregate payment in the entire year exceeds 10,000. So the government has put the word aggregate over here. Now this same aggregate amendment is also there in 194 BB. In BB, as I have told you, there is only one amendment, and that amendment is the word aggregate only. Okay. So the word aggregate is put under 194 BB also and 194 B also. Now the third amendment in 194 B is from this section, that is from 194 B, the government has excluded online games. Winning from online games are not going to be covered under this section. For winning from online games, the government has made a separate section with effect from 1st April 2023. Okay, so there are three amendments as I have told you. The first amendment in 194B was betting and gambling was inserted. Second amendment, the word aggregate was inserted. Third amendment, winning from online games is removed from here and a separate section is made over here. What is the need of this separate section? Now, there are multiple reasons for the separate sections. There are two main reasons why this separate section has been made. First, the threshold has been removed for this particular online games. For online games, there is no threshold of 10,000 rupees now. For that, they have made a separate section. Second, the timing of deduction in the previous section was date of payment. Generally, we deduct TDS on credit or payment, whichever is earlier. In some cases, we deduct TDS on payment basis. But here, the timing of deduction is what? It is payment. Sorry, the timing of deduction is changed. Sorry, it is changed. So how it is changed? It is written over here. At what time the tax should be deducted? Now, to understand this, there are two things that we need to understand. I am just explaining you casually today. In detail, I will explain you through a separate CBDT circular. A very big circular has come of CBDT, for which I will be putting a separate amendment lecture at the end after maybe 8 to 10 days. Not now. Till then, you watch the remaining amendments. Okay. Because I have to go through that circular once, and then I have to also make some examples on that circular so that I can put that for you all. But today I am just explaining the gist of the provision. Suppose you are Mr. A and you are playing some online games. Online games means what, sir? Say Dream 11, you are making some cricket team in Dream 11. Fantasy League cricket team you are making, and you are depositing some money in the wallet. You have deposited say 1000 rupees. Okay, and you won. Say 50,000 rupees you won. Now, after you won 50,000 rupees, say on 15th of December 2023, you withdrawn 30,000. So you have withdrawn 30,000. The moment you have withdrawn 30,000 now, so at that time, the TDS will be deducted. What about the balance? Balance 20,000. Balance 20,000 is balance on 31st of March 2024. Okay. So the law says that now whatever is the balance on that also you have to deduct TDS. So TDS has to be deducted on two cases. First, when the person will withdraw, deduct at that time. Second, on 31st March, if there is a balance in his wallet, on that also TDS should be deducted as per this new section 194BA. So 194BA is charging tax, is deducting tax on your wallet balance also on 31st of March. If you want to take a photograph of this, you can take it and you can read this provision if you want. You can pause the lecture and take a photograph. Okay. So this is what it is written over here, but there is some twist and turns over here for which we will be looking at the CBDT circular. Don't worry. Okay. I'll be dealing with that circular with you all. Okay. I hope it is clear to all of you. Now, what is the next amendment, sir? Let me search. Just wait. Now, the next amendment is in 194N. There is some change of limit. There is some increase in limit for TDS on cash withdrawal for cooperative societies. So, generally what happens if you go and withdraw more than 1 crore rupees from a bank, then the bank will deduct TDS at the rate of 2% on excess amount. And if you have not filed the return of last 3 years, remember, then the bank will deduct TDS above 20 lakhs 2% and above 1 crores 5%. Now the limit has been increased for cooperative society. The 1 crore limit has been increased to 3 crore. Okay, for cooperative society. It means if a cooperative society goes to a bank or a post office or a cooperative bank to withdraw money, Their TDS will be deducted if they withdraw more than 3 crore. For them, 1 crore limit is not applicable. Secondly, if the cooperative society has not filed the return of last 3 years, okay, then their TDS will be deducted above 20 lakhs up to 3 crore, it is just 2%. And above 3 crore, it is 5%. Okay. So just remember that 1 crore has become 3 crore for cooperative society. That's it. So this is the limit which is enhanced for cooperative society, and this is the limit for other assessees. Okay. I hope it is clear to all of you. Now, the next amendment is in 194R, which is similar to what is written in section 28 also. Section 28 amendment was there, remember? That the benefit or perquisite might be in cash, might be in kind, might be partly in cash, partly in kind. So, if they made an amendment in section 28, they have to make a similar amendment in section 194R also, because 194R and section 28 are related to each other. So, here also they have made a similar amendment. Check it, please. Check it. Same amendment they have made over here. Check. Now, the next amendment is on page number 28.28, that is in section 206AB. You might be knowing that just 1 or 2 years back, the government has brought a provision whereby if the other person, that is the payee, is a non-filer of return, he has not filed the return of the last year, and if his TDS and TCS is 50,000 or more, you have to deduct the TDS at twice the rate or 5%, whichever is higher. So TDS also you have to twice the rate, and for TCS also there is a similar provision 206 CCA. Same provision for TCS also. I am not going to repeat for TCS. Now there are some exclusions over here. In some cases you are not going to deduct twice the rate. What are those exclusions? First exclusion was if the payee is a non-resident, and he does not have a PE in India, he does not have a permanent establishment in India, then do not double. Double. Okay. So this was the first exclusion. Okay. So here the government has inserted one more exclusion. Not only in this section, but also for TCS, they have inserted a similar exclusion. Okay. That what if the other person is not liable to file the return and he is also notified by central government? The other person is not required to furnish the return of income for the assessment year. That is for the last year. And he is notified by central government. Then why will he file? Why will he file the return? CBDT has the power now. The central government has the power to notify anybody that you do not file the return. Okay. So if the person is not required to file the return and is notified by central government, then in that case also, do not deduct double TDS. Deduct TDS as per the normal rates only. Okay. You will not deduct what? Double TDS in that case. Check it please. Okay. Read it. Now the next amendment, I don't think so. It's very important amendment. For understanding the next amendment, you need to understand further few sections first of all. First of all, 271C. What is 271C? 271C talks about if you do not deduct TDS, you will be liable for a penalty. Okay. And if you also do not ensure that the other person has paid the tax, then also you will be liable for penalty. Do you remember that in case of winning in kind, suppose if I am giving somebody a car, winning in kind, I cannot deduct TDS. In that case, I have to ensure that the other person has paid the tax, he has to give me the proof, and that is my sufficient compliance. So if I don't do that, then also I am liable for penalty under 271C. Then if I do not pay the tax, then I am liable for prosecution under 276B. Now, the concept of winning in kind is not only in 194B, it is also there in other sections, like it is there in 194BA also. It is there in 194R also. It is there in 194S also. But in the mention of these three sections are not there in these two penalized sections. 271C has a mention of 194B. 276B has a mention of 194B. It does not have a mention of 194BA. Even though there also, in 194BA also, in 194R also, 194S also. What is 194BA? That online games. What is 194R? Where you give benefit or perquisite in business and profession to somebody. What is 194S? Where you give virtual digital asset, where you purchase virtual digital asset and you make the payment in kind. So here also there is a concept of kind payment. But the related penalties mentioned are not, the related penalty and prosecution provision does not have a mention about these sections. So the amendment over here is that only. So in 271C and in 276B, they have made the mention about these provisions also, along with what? Along with 194B. That's it. This is what this small provision is all about. Check it, please. Now the next amendment is a big one with a big CBDT FAQ also. First of all, we will see the provision 206C 1G has been drastically changed. 206C subsection 1G is drastically changed from Finance Act 2023, but from the middle of the year. That is the problem. It has been changed from 1st of October 2023 till 30th September. It was same, but from 1st October the limits are changed, the percentages are changed. They have become more harsh now. How it has changed? What was the provision earlier? 206C 1G talks about when you send any money outside India, then you have to collect TCS. The authorized dealer will collect TCS from you. Or if you go for a foreign tour, overseas tour package and program, then there is a TCS at the rate of 5% without any limit also. So the limits have changed over here. The percentages have changed from 1st October. Check here, please. So I have made all the situations into 4 category. First, if you are remitting outside India, if you are remitting outside India for education out of a loan from a financial institution in India, so you are taking a loan from a financial institution and you are remitting outside India. Okay. Then up to 7 lakh, no TDS, no TCS earlier also, now also. And above 7 lakh, 0.5% TCS, above 7 lakh, 0.5% TCS. So this provision is exactly same as it was earlier. You all might be knowing that we have done it in class, that if you send money out of India by taking a loan from a financial institution in India for education purpose, then 7 lakh exempt, above 7 lakh only 0.5%. We have done it in class earlier. Second category, this was first category. Second category is you are sending money out of India for education other than given above. Other than given above means what? Means you are not sending money out of loan. It means you are sending out of your savings. Okay. So you are sending money out of your savings, or you are sending money out of India for medical purpose. So if you are sending money out of India for savings, out of savings or for medical purpose, then up to 7 lakh it is nil. Up to 7 lakh nil. Above 7 lakh it is 5%. It is 5%. So if you are sending 10 lakh rupees, 7 lakh nil, only on 3 lakh rupees 5% TCS will be collected. So this is also same. This was same earlier also. Okay, there is nothing different in this. The difference will start now. If you are sending for overseas tour package program, up there is no threshold first of all. Remember, for overseas tour package program there is no threshold, 5% directly. Directly 5%. What was there earlier? 5%. Now what is there? Now up to 7 lakh it is 5%, above 7 lakh it is 20%. Check it please. So if you are sending 10 lakh rupees out of India for what? Overseas tour package program, up to 7 lakh 5%, and on the remaining 3 lakh you have to pay 20% TCS. Check it please. This is the dangerous provision over here. And one last thing is any other case. Any other case means you are not sending money out of loan for education, you are not sending money for out of saving for education, you are not sending money for medical, you are not sending money for overseas tour package program. Say you are sending money out of India for buying some assets. Then up to 7 lakh nil. Above 7 lakh 5%. It was there earlier, but now there has been drastic increase. Up to 7 lakh nil, above 7 lakh directly 20%. Check. Directly 20% TCS will be collected audit. Check it please. Very dangerous provision. Very dangerous. Sir, what about if we go to foreign country and use our international credit card, whether the TCS will be collected in that case? No TCS. They have announced that in the finance bill, but later on they have withdrawn that. In the finance bill, they announced 20% TCS on international credit card swiping, but then they withdrawn that particular amendment. Okay. Now, just go through this limits. Remember these limits very carefully, and then there are a lot of doubts which will come to your mind. For that, we will go through this entire CBDT circular in detail. Okay. There are around 7 questions over here which we need to answer one by one. Okay. 7 questions. Okay. So just go through these limits. Remember these new limits, old limits both. for your exams. Both are relevant for exams. Okay, check it please. So now we have to see this CBDT guideline. They have given a very detailed guideline explaining lot of small things here. Yaar. Shall we see one by one? They will ask you same thing in the exam. Same they will copy from here and they will put in the exam. So you have to be very careful. You have to by heart each and everything logically. Let's read question number 1. Whether the threshold of 7 lakh, whether the for TCS to become applicable on LRS applies separately for various purpose like education, health treatment and others. Okay. There is a limit of 7 lakh now. Up to 7 lakh there is what? No TCS, right? So is the 7 lakh separately applicable for education, health and other purpose? Let's see. For example, if the remittance of 7 lakh under LRS is made in a financial year for education purpose and other remittance in the same financial year for 7 lakh is made for medical treatment. So 7 lakh you are making for what? Education. Okay. Next 7 lakh you are making for what? Other remittances. Okay. I am again reading. For example, if the remittance of 7 lakh under LRS is made in a financial year for education purpose and other remittance in the same financial year of 7 lakh is made for medical treatment. And third, another 7 lakh for what? Tell me. For other purpose, other than medical and what? Health. Clear? Then whether the exemption limit of 7 lakh shall be given to what? Each of the three separately. First of all, we need to understand the question raised by CBDT. Is the question raised by CBDT clear? Please tell me. They are talking about what you know. Be very careful. See here. Listen to me very carefully. Otherwise, you will make a 100% mistake in the exam. They are talking about this and this. Just wait. Sorry. They are talking about this A plus this B. Just write down over there. This covers this point number A, which I am writing beside what? Education and medical. That covers medical and education, right? And last point, the fourth category covers what? Any other case, right? So it is talking about this and this. Okay? See here, please. Understand the question. Whether the 7 lakh is applicable, what? Individually for medical, then health, and then for what other purpose, or it is collectively. Let's see the answer by CBDT. It is clarified that the threshold of 7 lakh for LRS is what? Tell me. Combined threshold for applicability of what? TCS on LRS, irrespective of the purpose of the remittance. Thus, in the example given, up to 7 lakh what? Remittance under LRS during a financial year shall not be liable for TCS. However, subsequent 14 lakh remittance under LRS shall be what? Tell me. Liable for TCS in accordance with TCS rates for such remittance. Now wait. Okay. Now wait. There are a lot of doubts over here. That's the reason. I told you it's very dangerous. Are you listening, Palani? With full attention, are you ready for my bomb, which I'm going to put on you all now? Okay. I'm going to put a bomb on you all. You have to defend yourself. Okay.
Okay, sir.
My question is, CBDT clarification. Question 1. Okay. 7 lakh threshold is what? Combined for education plus plus
other purpose.
other purposes. Right?
Yes, sir. Right, sir.
So what the law says?
It is combined. Combined.
This is 7 lakhs, this is 7 lakhs, this is 7 lakhs. Right? Total
21 lakhs.
So for first 7 lakh remittance.
7 lakhs. No tax.
Remittance, tell me,
No tax. Not
no tax. And the balance
14 lakhs.
14 lakhs.
No tax.
TCS is
This is applicable.
applicable. Now the question is how much?
It's applicable for such different.
The question is how much? The law has clarified that the limit is combined, right? That we have combined together, right? We have taken combined together and we have taken a threshold of 7 lakh rupees exempt, right? Now the remaining 14 lakh at what rate I should collect TCS? That depends. That depends upon nature also and that depends upon the timing also. Correct? If it is for education, if it is for
Education.
or health, then it is always 5%. But if it is for
Other purpose.
other purpose and we have
Before
remitted this up to 30th September, then it is 5%.
5%.
And after 1st October, then it is 20%. Did you understand this point or not? Please tell me. Tell me, please, Palani. Because your yes sir does not have any voice, powerful voice.
Yes, sir.
The rates will change or not from 1st October if you remit after 1st October. Please tell me for other purpose. So this is the catch which is given in this circular in the first question. Shall we read that?
Yes, sir.
For example, if the remittance under the LRS are made in the current year at what? Tell me, read with me. At what? Different point of time. The TCS rates for the remittance of 14 lakhs remittance under the LRS would depend on the time of the remittance. As TCS rate changes from what? Tell me.
1st October 2020.
TCS rates would be applicable as under first 7 lakh remittance under LRS during the financial year for education purpose or for that matter any purpose. No TCS. Is everyone clear? 100% till here, step by step will go, point by point will go. Is this clear? First 7 lakh is exempt only, correct? The doubt is about the next 14 lakhs, right? Remittances beyond 7 lakh under LRS during the financial year 23-24. If on or before 30th September, if then TCS at the rate of 5% irrespective of the purpose unless it is for what? Tell me. Education purpose financed by loan from what? Financial institution at the rate of 0.5%, right? That loan category is 0.5%, now that we know, right? Now, what about the remittances beyond what? 7 lakh under the LRS during the financial year 23-24. If on or after 1st April, October, then 0.5%. If it is for education purpose financed by loan from a financial institution, 5% if it is for education or medical purpose, and 20% if it is for what? Tell me. Other purpose. So we'll just mention one more point over here. That is what? This was 0. Education loan was? Wait. Here we can write 5% or what? 0.5% for what? Loan plus education. Correct? Is this question number 1 100% clear to everyone? Please tell me.
100%.
Okay, just take a photograph of this if you want. Like this, we have to clarify all of them. Very recently, they have wrote. I don't know whether ICI will include this notification in the book or not, but generally they do include. Okay, so we have to do it. Generally, they do include such notifications in the syllabus. But they should include or not? What do you feel? They should include. It's a very practical notification. Without this, the importance of the section will be of no use. Yes or no? So, did you understand the clarification given in the first question? So, here the threshold is actually A plus B. Okay. We have done this. Okay. Now, coming to question number 2 now. Okay. Shall we read the question number 2? Since there are different TCS rates on LRS. Now, this you can answer very easily. You will only answer. Don't see the answer and you try to give your answer. Become CBDT and you will become correct CBDT. You will give correct answer. Think logically, you will give correct answer. Since there are different TCS rates on LRS for first 6 months and next 6 months of the financial year 23-24, whether the threshold of 7 lakh for TCS to become applicable on LRS applies separately for each 6 months, what do you feel? Whether you will get 2 thresholds during the year, for first 6 months separate 7 lakhs and for next 6 months second, obviously no. Check please. Check please. No. The threshold of 7 lakh for TCS to become applicable on LRS applies to what? Underline. Applies to what? Full financial year. If this threshold has already been exhausted, all subsequent remittance under LRS, whether in the first half or in the second half, would be liable for TCS at what? Tell me. Applicable rate. Is it clear, Palani? Question number 2, 100% clear?
Yes, sir. We take it for full financial year.
Full finance. If you have used the threshold of 7 lakhs, say in the month of April, May and June, okay, then can you enjoy the threshold further in the next after October? You cannot enjoy. Is it clear? So that was an easy question or not? Now this is a very surprising question. Huh? Even I was surprised after reading this question. I was not aware that it is done like this. Let me accept my mistake. See here. Don't read. What this question wants to tell. There is an authorized dealer over here. ICICI Bank. Okay. There is Mr. A, who is a customer. And this is financial year 23-24. Now remember that except overseas tour package program, everywhere you get an exemption of 7 lakh. Agreed?
Yes, sir.
Agreed or not? Except overseas tour program, you get except that package where you go to Rome, you get 7 lakh exemption everywhere. You can check. Okay. Now, just listen carefully. Suppose I went to ICICI Bank and I remitted 5 lakh rupees on 15th of June 2023. Will ICICI Bank collect TCS? Remitted for other purpose.
No, sir.
Will it collect TCS?
No, sir.
Why? Up to 7 lakh?
No TCS, sir.
There is no TCS. Correct? Are you 100% sure?
100% sure.
100% sure.
Yes, sir.
You should not back out with your answers. 100% sure? Yes, you are 100% correct. Don't worry. Okay? You are correct. Now listen to me. 5 lakh remitted through ICICI Bank. Okay? Now on 15th of July 2023, I went to what? HDFC Bank. For another purpose. Again other purpose. I went to HDFC Bank and I said, HDFC Bank, I want to what? Remit? What? 5 lakh rupees. Now what do you feel? Whether HDFC Bank will collect TCS or not? The question over here is, listen, the limit of 7 lakh should be counted from customer's point of view or from dealer's point of view. Did you understand the question? Hare, did you understand the question? First of all, everywhere we need to understand question. Answer is very simple. Question. Whether the limit of 7 lakh should be counted from whose perspective? Customer's perspective. If it is to be counted, then the limit of 7 lakh is crossed. Because customer has already remitted 5 lakh rupees out of India. But if it is to be counted from the perspective of dealer, then this dealer has not crossed 7 lakh rupees with you, na? Did you understand the question? What do you feel? It has to be from whose perspective? Customer's perspective. Then how HDFC will come to know that how much you have remitted earlier? Tell me practically how HDFC will come to know so far you have been to how many dealers and how you have transferred the money outside India? Yes, excellent point. What the entire industry were aware till last year, that it has to be from dealer's perspective. It has to be from dealer's perspective. But the answer is no. The CBDT has clarified now. It is not from dealer's perspective. It is from customer's perspective. If the customer has remitted more than 7 lakh rupees already from any dealer, from HDFC has to collect TCS. Now the practical question is, how will HDFC come to know that last month you have been to ICICI Bank? Yes or no? So for that purpose, the department is saying that the CBDT is the RBI is making a real-time system. What they are making? Whereby if you put the PAN of a particular person, you will get the details of how much he has remitted from which bank outside India. Okay. They are making that real-time system, but as of now, that is not in working. That is in progress. That is in progress. The moment that will be implemented, then HDFC will get your details in one click. That till 15th of July, through how much you have remitted outside India. Are you clear? But the system is not ready. As of now, it's in process. RBI is saying that we are working on that system. It will be coming very soon. Okay. So till then, what shall we do? Till then, HDFC can take a declaration from Mr. A. Can take a declaration from whom? Mr. A. That till today, how much you have remitted outside India, please give a declaration. Alright, did you understand what I said? It means the limit of 7 lakh is to be counted from whose perspective? Customer's perspective and not dealer's perspective. I hope everyone is 100% clear with this particular issue. Shall I read? Whether the threshold of 7 lakh for TCS to become applicable on LRS applies separately for each remittance through different authorized dealers? What do you feel? No. If not, how will the authorized dealer know? How will the authorized dealer know about the earlier remittance by that remitter? Right? Yes, sir. Through some other authorized dealer. Is everyone 100% clear with the question, Palani? So it is clarified that the threshold of 7 lakh for LRS is qua remitter. Qua remitter means from the perspective of remitter, and not qua authorized dealer, not from the perspective of dealer. Okay, is it clear? Yes, sir. It is from the perspective of remitter. Since the facility to provide real-time update of remittance under the LRS by remitter is still under development by RBI, it is clarified that the details of the earlier remittance under LRS by the remitter during the financial year may be taken by authorized dealer underlined through an undertaking at the time of remittance. Okay. Now please tell me, see here. Please see here. Can remitter give me a wrong detail? Then who will be under default? I will be under default or remitter will be under default? Remitter. Why will I be under default, right? If the authorized dealer correctly collects the tax at source based on the information given by in this undertaking, he will not be treated as assessee in default. However, for any false information in the undertaking, appropriate action may be taken against what? Tell me. The remitter under the act. Okay. It is further clarified that the same methodology of taking undertaking from buyer of overseas tour package program may be followed by the seller of the such package. Please tell me why in case of overseas tour package program also you have to take the undertaking. Why? Because the rate changes from 1st October. Yes or no? So we need to see. We need to see from earlier from some other package program. Have you been to what? Outside India. And how much you have exhausted so far? Yes. If you have already exhausted 7 lakh rupees through some other package, then this person will collect how much directly from you? Tell me. 20%. Are you clear or not? Please tell me. So beautiful clarifications. Sometimes I feel that such clarifications are made to ask a question only in CA final exams. Okay. They look like a potential questions or not of CA final. Tell me. Shall we go ahead? Question number 4. There is a threshold of 7 lakh for remittance under LRS for TCS to become applicable. While there is a threshold of 7 lakh for purchase of what? Overseas tour package program where reduced rate of 5% applies, right? Whether these two thresholds apply independently? Yes, obviously. Yes or no? Read the question properly. Array, one threshold is for giving exemption and one threshold is for reduced rates, right? I will explain you. I am Mr. A. Okay. I am a customer. This is which question? Question number 4. Now on 15th of October 2023, I remitted 10 lakh rupees. I remitted 10 lakhs outside India. Under what? LRS. This is ICICI Bank. Okay. An authorized dealer. Will ICICI Bank collect TCS?
Yes, sir.
How much?
On 3 lakhs, 5%.
For how 5% I am remitting outside India under LRS? I'm not saying I'm not saying I'm doing for education or health. I'll write other purpose. Chalo, I'll mention it well.
20%, sir.
How much percentage? 20% on how much?
20%.
On 3 lakhs. It means are you getting 7 lakh exemption?
Yes, sir.
7 lakh exemption availed, right?
Yes, sir.
Now listen carefully. There is overseas tour package program person, tour operator. Okay.
Yes, sir.
And now you are going for what? Tour. There you are paying how much? 10 lakh rupees. Okay. So here also you will get a relief for up to 7 lakhs. Up to 7 lakh how much? 5%. It's not that this 7 lakh will be merged with this 10 lakhs. Are you able to understand? It's not that once you have exhausted this 7 lakh over here, then the entire 10 lakh will be subject to 20%. This 7 lakh and this 7 lakh is separate. Did you understand what I said? So now you will be liable for 7 lakh 5% and 7 lakh above 7 lakh 3 lakh how much? So please tell me, are you getting 7 lakh separately for remittance outside India and then 7 lakh 5% benefit for overseas tour package program separately or not? This is what that question wants to say. Read please. Now you will understand. Is it clear? So next year if something like this come, who will interpret all these things? You will come to me. Huh? Why? Array, if next year something like this, some new provisions will come like this, every year something new will come, na? Who will interpret?
Oh, okay.
You will come to me for help. YouTube video you will watch, okay. But you will not interpret yourself. Okay, fine. taken the photograph? Now, shall we read ahead?
Yes, sir.
Shall I read the next question?
Yes, sir.
Question number 5. Shall I read, Palani?
Yes, sir.
Question 5. A resident individual spends 3 lakh for what?
Purchase of
Overseas tour program package from a foreign tour operator and remits the money, which is classified as what?
LRS.
LRS. There is no other remittance under the LRS or the purchase of overseas tour program package during the financial year, whether TCS is applicable. Listen here, see here. What SSC is trying to say, you know? That if I am remitting outside India for tour purpose, I am remitting outside India for what purpose?
Tour purpose.
Tour purpose. Then which TCS will be applicable? The tour wala or the normal wala? Did you understand the question?
Yes,
I am remitting outside India. I am remitting to Singapore. Okay? I am remitting where?
sir.
I am not buying from a local tour operator. I am buying from a Singapore tour operator. Okay? So I am remitting to Singapore tour operator. Okay? I am remitting outside India, correct?
Yes, sir.
Okay. So, but for what purpose I am remitting? Overseas tour, na? Then the government says that the provisions of overseas tour only will apply to you. Check. And you will not get any exemption of 7 lakh for that purpose. Okay? Getting my point or not? You have to get my point. You don't have any other option, na, Palani? Okay? So, even if you are transferring money outside India for tour purpose, then the TCS rate of tour will only be applicable on you. In case of a purchase of overseas tour package program, which is classified as LRS, TCS provision for purchase of overseas tour program package shall apply and not TCS provision for remittance under what? LRS. Since for purchase of overseas tour program package, the threshold of 7 lakh for applicability of TCS does not apply. TCS is applicable and tax is required to be collected by seller. In this case, the tax shall be required to be collected at 5% since the total amount spent on the purchase is what? Less than 7 lakh. Is it clear?
Yes, sir.
The TCS should be made by the seller. Okay? Is this clear till question number 5? Everything is clear? Shall I go ahead with question number 6?
Yes, sir.
Now, question number 6 defines scope of certain items. See here, please, all of you. Alani, see here. Leave the book. See here. Question 6 defines the scope of two things. What do we mean by education? What do you mean by?
Education.
And what do you mean by health? What do you mean by? Health. So, they are trying to define these two things. Let's see. As per the RBI clarification and CBDT clarification. There are different rates for remittance under what? LRS for medical treatment or education purpose and for other purpose, correct?
Yes, sir. Yes, sir.
For other purpose it is 20%, right?
Yes, sir.
And for education it is 0.5 and 5%.
5%.
And for medical it is 5%. For education there are two rates, right?
Yes, sir.
What is the scope of the remittance under LRS for medical treatment or education purpose? Let's see. As per the clarification by RBI, remittance for the purpose of medical treatment shall include what? What all remittance will include? Shall we see?
Yes, sir.
When I say I am remitting the money for what purpose?
Medical purpose.
Medical treatment. Say the correct word, please. When we are remitting the money for what purpose? Medical treatment. With what it will include? What all remittance it will include? See. Remittance for what? Underline purchase of tickets of the person to be treated medically overseas. Underline and his attendant. So it will include what? Tell me. Ticket and the ticket of the person and his attendant for commuting between India and the overseas destination. Okay. So first of all, ticket cost. Okay. That will be subject to what? TCS at lower rate of 5%, right? Because that will be treated as medical treatment purpose, right?
Yes, sir.
Otherwise, if you are remitting for other than these purpose, then how much TCS they will collect? 20%. That's the catch. Why we are classifying the expense into medical treatment? Because if your expense is treated as medical treatment, it will be subject to only how much percentage? 5. And balance money will be treated as what? Other purpose 20%. Second, for medical expense. For and other day-to-day expense required for such purpose. Other what? Say for the there they have to travel there, right? From one place to another, they need to eat food, etc. Right? All those basic expenses. Now they are doing shopping over there. They are buying Armani and Gucci bags. Okay. You can do all those things. Remit the money, collect TCS 20%. Correct? Now, further, as per RBI, medical treatment includes transactions which are related to what? Now we are defining what you know. What do I mean by medical treatment? What all things will include in medical treatment? Which all medical treatment? Okay. Health services. Transactions which are related to health services acquired by the residents traveling abroad for medical reasons, which includes what? Medical services, other healthcare, food, accommodation, local transportation, transactions. Okay. All these things will be covered under the medical treatment charges. Okay. Because when we say medical expenses, which all things will be included? They have said all these things will be included. Further, it covers transactions for what? Health services rendered remotely or on site, that is no travels by service recipient is involved. So what does it include? Read it properly. Further, it covers what? Transactions for health services rendered remotely or on site, that is no travel by service recipient is involved. Yes, online consultation. This covers services from hospitals, doctors, nurses, paramedical and similar services, etc. The TCS provisions for the purpose of medical treatment would apply when the remittance is made in what? In the above cases. So this is just a general list and this is not a list given by CBDT. In fact, it's a list as per what? RBI. Okay, it's a clarification by RBI that for what all purpose you can remit outside India. Similarly, for education purpose. Again, for education purpose, if you are remitting money outside India, what can be the possible expenses that you can incur? Please tell me. Again, you can what? Now purchase what? Please say tickets. Now you don't need attendant. Huh? Don't ask attendant. Don't ask your mummy to come to a UK to drop you. Please. If your mummy is coming, na, then pay 20%. Are you able to understand or not? With a medically unfit person, you can have an attendant, right? With a person who is going for education, well grown up man or woman, whomsoever he or she is, they should not need an attendant here, please. Even if they want, they can pay 20% for the tickets. Okay. Remittance for purchase of tickets of the person undertaking study overseas for commuting between India and overseas. The tuition fee and other fees to be paid to the education institution. You have to pay the fees to the institution or not? Tell me.
Yes, sir. Yes, sir.
And other day-to-day expenses required for undertaking such education. Again, the same things are mentioned below. You can just check it once. Okay, nothing great. Okay. Now, one last question is there over here. See, that will complete this clarification. Very, very important. Institute is going to include all these things in your study material. Definitely they will include. Shall I go ahead? Last question is very simple. Sir, overseas tour package program package, whatever it is, that is giving trouble to us. Sir, 5% TCS, customers are not ready to bear. Customers are not ready to bear. And above 7 lakh to 20%, nobody is ready to bear, sir. Is there any way? There is only one way. Tell the customer not to book a package. Okay. Tell the customer not to book a package. So if the customer book ticket separately, room separately, then no TCS, no TCS, check. Because then it cannot be called as a package. But that would cost him more, right? In package, it costs less. The choice is customers, whatever he wish to do. Check. Whether the purchase of international travel ticket or hotel accommodation on stand-alone basis is purchase of overseas tour package program. It is clarified that purchase of only international travel ticket or purchase of only hotel accommodation by in itself is not covered within the definition of what? Overseas tour program package. To qualify as overseas tour program package, the package should include at least two of the followings: ticket with hotel or any other expenditure. Okay. At least ticket with hotel or hotel with scene guide, guide scening, etc. Some services, right?
Yes, sir.
There has to be at least more than one item na in a package. One item cannot be called as a package na.
Yes, sir.
So this is what this clarification is all about. Is it clear to all of you? Please tell me. Now let's go ahead with some capital gain amendments one by one. Pay attention please. There are some small amendments which are made in capital gains. There are some big amendments also which are made in capital gains. One by one we'll see all of them. Okay, pay attention please all of you first of all. The first amendment is made in section 48, which is your computation mechanism. Okay, now what does this amendment says? This amendment says that if you have taken a house property on loan, okay, on which you have paid some interest earlier, and that interest was claimed as deduction earlier either under section 24 or under chapter 6A. Under section 24 you have claimed as an house property interest, or under chapter 6A you have claimed as a deduction under 80EE. Remember, EE is there, 80EEA is there. In 80EE you get 50,000 additional interest deduction. 80EEA you get additional 1.5 lakh deduction. So the provision says that if you have already claimed deduction under section 24 or under chapter 6A, then you cannot claim that interest as a cost of acquisition. You cannot say that I have paid in this much interest so far, so this is also my cost. You cannot claim that as a cost of acquisition. This is what this provision wants to tell you. Please check, so that there is no dual benefit. There are some high courts which were allowing that as a deduction. A proviso has been inserted in section 48 to provide that the cost of acquisition or the cost of improvement shall not include the amount of interest claimed as deduction under section 24 or under chapter 6A. So whatever is claimed earlier as a deduction under section 24 or chapter 6A cannot be claimed as cost of acquisition or cost of improvement for the purpose of capital gains. I hope it is clear to all of you. Correct? Now another amendment is in the discussion of definition of cost of acquisition. Okay, in section 55. We all know that in section 55 there are a lot of intangible assets like goodwill of a business and profession, patent, copyright, trademark, license, etc., etc. If these are self-generated, then the cost of acquisition is zero, right? And if these are purchased from someone, then the cost of acquisition is what? It is purchase price. But there are only limited intangible assets which are mentioned over here, like goodwill of a business and profession, like trademark, like brand name associated with business and profession, like tenancy rights, stage carriage permits, LUMARs. Only limited assets are there. The list is not exhaustive. But Finance Act 23 has made the list exhaustive by saying that any other intangible asset or right, check it please. Any kind of intangible asset or right, we are not interested in now listing down the assets. We are fed up with that. All kind of intangible assets, all kind of rights, okay, that can be covered over here. Now even license can come, even trademark is already there, even copyright can come, even your franchise can come. Every kind of asset will come. If it is self-generated, it is nil. If it is purchased from someone, then it is purchase price. Check it please. It has become very, very, very exhaustive now. Okay. Now the next amendment is on page number 31.6, which is with respect to joint development agreement. What happens in joint development agreement? You give your piece of land or you give a piece of building, and then the builder will demolish that, will make his own building, and builder will give you some money, and builder will give you some share in the flat. Now there was some clarification which was required with respect to the money received. What was written in the law is the assessee will receive cash. The word cash was written. And the assessee will also receive a share in the flat, share in the new property. So what do I mean by cash? Cash will only include cash or what? Hard cash? No, no, no. So the Finance Act 23 has made an amendment, clarified that cash will not only include cash, but will also include check, will also include draft, will also include any other mode of online payment, etc. So earlier only cash was there. These are the words which are added by Finance Act 2023 just for the sake of clarification. Check it please. So the consideration received in cash, only cash was written. What about check? Check was not written. What about draft? Draft was not written. What about other online modes? Not written. So they have written all of them now. Check it, please. Is it clear? Now, after ULIP, we are going to talk about now what? Tell me.
Insurance.
The normal insurance policy which is received. Correct?
Yes, sir.
Shall I say?
Yes, sir.
Pay attention, please. Treatment of
Normal life insurance.
amount received from normal insurance policy. Is it clear?
Yes, sir.
Other than, listen carefully, other than, shall I say? Other than death, other than ULIP. What? And Cayman insurance policy. And
Insurance policy.
because do we know the treatment of these three things now?
Yes, sir.
Death is exempt.
ULIP.
ULIP we already did. Are did or not?
Yes, sir.
And Cayman insurance policy also we have already done in PGBP. It is taxable
Yes, sir.
as PGBP or as IFOS or as salary. Yes or no?
Yes, sir. Yes, sir. Who receives
We
it?
are not interested in that. We are interested in what?
Normal life insurance.
Normal life insurance policy. Okay. So pay absolute attention now. Shall I start?
Yes, sir.
Seer Palani. Palani, Seer. If policy is issued up to 31st March 2023, then the provision is different. And if what?
Policy is issued after 31st March 23.
On or after
1st April.
1st April 2023, then the provision is different. Is it clear?
Yes, sir.
Is it clear? Tell me please.
Yes, sir.
Palani is not there in this world only today. I want your interaction, Palani.
Yes, sir. Sir. Yes, sir.
What is the cutoff date over here?
31/3/23, sir.
This is an amendment made by
Finance Act.
Finance Act 23. Okay.
Yes, sir.
Now I am not repeating unnecessary things. Point number 1. If percentage criteria is fulfilled. What is the percentage criteria?
10%.
Same which was there in ULIP. Remember or not? Shall I write once again?
Sir.
Shall I write once again? Shall I write same as ULIP? Just write just like this over here.
Yes, sir.
Then what? Tell me.
It is exempt.
Under section what?
10.
1010D. Is it clear?
Yes, sir.
Now what will happen if the percentage criteria is not fulfilled? Okay.
Not.
If Percentage criteria is
not fulfilled.
not fulfilled. Then, shall I say, Palani? Then it is taxable under, shall I say, IFOS. Under what?
IFOS.
Under section 56(2)(13). Okay. Where it is taxable, please tell me.
IFOS.
IFOS. Sir, how it is taxable? That I will tell you. Okay, 56(2)(13) is a new section. This section is what?
New section.
Added by Finance Act 23. Is it clear? Sir, how much will be taxable? What? How much? Wait, that I will tell you. That is my duty to tell you. Okay? Is it clear? Shall I go ahead? So till here everything is comfortable. If the policy is issued before 2023, up to 2023, you just have to check percentage criteria, right? Now, if the policy is issued on or after what?
1/4/23.
1/4/23. Okay. Then you have to fulfill what? How many conditions?
2.
What is the first condition?
What's the percentage condition?
Percentage condition. Same, everything is same. You have to just recap with me. Fulfill what?
Percentage condition.
Fulfill percentage limit. First, fulfill percentage limit. Okay.
Yes, sir.
If percentage limit is, say,
Fulfilled.
not fulfilled.
IFOS 56/218.
Yes. Then taxable under what?
IFOS
Under section what?
56/218.
13 it is, not 18. It is 56(2)(13). Okay.
Yes, sir.
Added by
Finance Act 23.
Finance Act 23. Is it clear, Palani?
Yes, clear, sir.
But only fulfilling condition 1 is now
No.
not sufficient. You also have to fulfill what?
No criteria.
The amount criteria. Is it clear?
Clear, sir.
Shall I say?
Yes, sir.
Now, what was the amount criteria above?
1 lakh.
The annual premium. The annual should not what? Rupees 5 lakhs in any what? Previous year. Is it clear? Please tell me. So that big policy holders are what? Please tell me. Are made to pay tax. They are not benefited out of this provision. Is it clear? Say Amitabh Bachchan is buying an insurance policy of 200 crore rupees and paying an annual premium of 10 crore rupees. Yes or no? Should we make the policy exempt for Amitabh Bachchan? Tell me. Till last year it was exempt. But now if somebody purchases, it will be taxable. Is it clear? If the amount criteria is not fulfilled, shall I say?
Yes, sir.
Then taxable under what?
120.
IFOS under section 56 to 13. Here everything is IFOS. Check. Here also IFOS, here also IFOS, here also IFOS. Check. Why, sir? Why not capital gains? But because here you do not have any asset. Here you do not hold any units. Are you able to understand? In ULIP, you are holding what? Tell me. Units. So the ULIP taxability was covered under what? Under capital gains. Here the taxability is not of what? Transfer of what? You are not transferring any what? Any units. Your policy is getting what? Mature. Yes or no? So that's the reason here the taxability is under which head? Please tell me. IFOS. Is it clear to everyone? Please tell me. Now tell me again what people will do to avoid this particular provision. Please tell me.
Take a 4 lakh policy 3 times.
They will take 3 policies of 4 lakh each, right?
Yes, sir.
So shall I write this provision here also? Copy this provision.
Yes, sir.
I am just copying this provision. I am not interested in writing that once again here. Okay?
Yes, sir.
I am putting an asterisk over here. Where there are 2 or more ULIPs, now instead of ULIP, what will I do?
Life insurance policy.
LIP. Then the assessee shall select those life insurance policies to make it exempt whose aggregate premium is not greater than what?
5 lakhs.
5 lakhs. Is it clear to all of you? Please tell me.
Yes, sir.
Now, the most important point over here is, listen. The most important point over here is, shall I say?
Yes, sir.
How much amount is taxable under what?
56.
IFOS under section what?
56 to 13.
56 to 13. Right?
Yes, sir.
Now for that I have to read the provision. Shall I read?
Yes, sir.
Please give me permission. Shall I read, Palani? Mr. Palani, your permission is very important for me. You cannot go ahead without your permission. Okay. How much amount is taxable under 56 to 13? So now I am reading that provision. Shall I? Mode of computation. What?
Mode of computation.
Apart from the cases given above, these are exempt cases. Shall we just see those exempt cases also once? Shall we read it once? Please tell me.
Yes, sir.
Yes, 56 to 13 is applicable from AY 24-25. It provides mode of computation of taxable income pertaining to what? Sum received under a life insurance policy, unit linked insurance policy, keyman insurance policy. Can I say this provision is not applicable to these 2 items?
Yes, sir.
Tell me fast, yaar.
Yes, sir.
This provision is not applicable to ULIP and KIP, correct?
Sir.
Now, further, 56 to 13 is not applicable if the income is exempt under 1010D, correct?
Sir.
Under 1010D, sum received under a life insurance policy is exempt in the following case. First, what is the first case? Between 2003 to 2012, it does not exceed 20%, then it is exempt, correct?
Yes, sir.
Please give me confirmation. Second, at that time, if the policy, listen na. If the policy is issued between this period, are we supposed to check the amount criteria?
No. No, sir.
No. If the policy is issued between this, are we supposed to check the amount criteria after 2012?
No.
No. If the policy is issued after 2013, are we supposed to check the amount criteria?
No.
No. We are supposed to check amount criteria if the policy is issued what? After 1/4/2023, correct? And even after 1/4/2003, if the amount is not exceeding 5 lakhs, it is exempt now. Yes or no? Even today, today is after 2023 only or not? Even if today I issue a policy whose percentage is also less than the 10% and the amount is also less than 5 lakhs, then it is not taxable now. And on death of a person, it is always exempt. Is it clear to everyone? It means then when it is taxable? Please, either the percentage criteria has to cross or the amount criteria has to cross, correct or not? Then it is taxable. The question over here is, how much will be taxable? That is the question, right? The question over here is, in IFOS, how much will be taxable? Let's see. Apart from the cases given above, the cases given above are exempt, right? Where any sum is received, including bonus, at any time during the previous year under a life insurance policy. Are you listening to me? It's a dangerous line, huh? What have you received? Any sum received under life insurance policy, including bonus, right? The sum so received. What is the sum received by you? The amount received from the life insurance company, including the bonus, right? As exceeds the aggregate premium paid during the... Don't read ahead. Don't read ahead. What will you compare? Whatever you have received, including the bonus. From that, reduce what? The premium which is paid under LIC, right? Which you have paid under over the years for the last 10 to 20 years, you would have paid, right? In the bracket, there is something very important. Not claimed as deduction under any other provision. What is written? It means amount received from the company, correct? Minus premium paid, correct? But you can write over here only that premium paid, which is what? Not allowed as deduction in earlier years. Now, please tell me, when you make a payment for LIC, do you claim deduction under ATC or not? Tell me now, you claim deduction under ATC or not? Now, suppose you paid 2.5 lakhs. How much? So, how much you have claimed as deduction under ATC earlier? 1.5 lakh. That you cannot reduce from here. Are you able to understand or not? Because for that you have already claimed deduction benefit under income tax law or not. Why will we give you the double benefit to you? I don't understand whether you understood or not.
Understood, sir.
I will explain you with the help of example. Let me read it once again. Okay. As exceeds the aggregate premium paid during the term of policy and not claimed as deduction under any provision shall be taxable with effect from what? 56 to 13 under AY 24-25. Let me give you an example. How much is taxable? Tell me.
Amount received including bonus.
Amount received
From insurance company including bonus.
including bonus.
Minus
From whom?
insurance company.
From insurance company. Minus what?
Premium paid, not payment as a deduction earlier.
Premium paid over the years. But in the bracket, what will I write?
Not claimed as a deduction earlier.
Not claimed as
Deduction earlier.
deduction earlier. That much amount will be considered as what? Taxable. Is it clear? Why the government has put this line? Because then you will take dual benefit.
Dual benefit.
Once you have already taken in ATC or not earlier?
Yes, sir.
Tell me na yaar. Once you have taken in ATC, now why we will allow you to deduct again from your policy amount?
Yes, sir.
Yes?
Yes, sir.
If you want to make it exempt, okay, don't cross the thresholds, right?
Yes, sir.
Don't cross the percentage criteria, don't cross the
Amount criteria.
nothing will be taxed. Is 100% clear to everyone?
Yes, sir.
Now I have framed some questions from my side. Shall I show you?
Yes, sir.
Shall I show you?
Yes, sir.
Will you be able to answer that?
Ready, sir.
Now I have made some questions which you will be getting in the question bank also. Okay.
Yes, sir.
Question number 3 in your book. You will help me to get the answer. Will you?
Yes, sir.
Shall I read?
Yes, sir.
I will read. You will help me to answer. Okay.
Yes, sir.
I know that you will answer all of them. Don't worry. Just pay attention properly. X, Y, Z and A. You will say this is question number 3. Then when is question number 1 and 2? Question number 1 and 2 we have already done earlier if you remember. With MSME discussion. I have discussed with you all. Don't worry. You can go and check the recordings if you want once again. Okay. As and when any amendment is coming, I am putting the questions in the question bank. Okay. You can go and check. We have done it. Now coming to this amendment question on LIC. See on the board, please, all of you. Palani, Vignesh, are you ready?
Yes, sir.
Palani, are you ready?
Ready, sir.
XYZA takes a life insurance policy on April 10, 2023. Please tell me, what will happen because of this?
10%.
Are we supposed to fulfill both the conditions or not? Tell me fast.
Sir.
Yes. Information pertaining to sum assured and annual insurance premium is given in table infra. They want to know whether or not the exemption will be available under 1010D. At the time of what? Maturity of the insurance policy. Okay?
Yes, sir.
Palani, are you ready? Now, they do not have any other policy and do not intend to take any other insurance policy in future. Okay? This is just to tell you that the aggregate premium is only this one. There is no other policy. Okay? Now, these are 4 different persons. These are 4. We need to answer for all of them one by one. Let's talk about X first. Okay? We'll talk about all of them individually. Let's talk about X first.
Yes, sir.
Yes or no? Sum assured 40 lakhs. Read the provision situation carefully first. Annual premium 3.9 lakhs. Tenure of policy 10 years. Amount payable at the time of maturity. Sum assured plus bonus, that is 10% of sum assured, whatever it is, 44 lakhs you are going to get on maturity. Okay? Okay?
Yes, sir.
So what you are going to get on maturity is sum assured plus 10%. So sum assured plus 10% comes to 44 lakhs, correct?
Yes, sir.
And your amount contributed to PPF. What is this? This is eligible for ATC. This will be useful later on. I will come to that discussion sometime later. Okay? In next 10 minutes.
Yes, sir.
First of all, you have to check what? Please tell me.
10% of the sum assured.
First, with what condition you will check, Palani? Is he fulfilling the percentage criteria?
Yes, sir.
Is he fulfilling the percentage criteria?
Yes, sir.
Yes. Is the annual premium less than 10% of the sum assured?
Yes.
Perfect. Clear?
Clear.
Is he fulfilling the amount criteria? Check the second point. Yes. If both the criteria are fulfilled, can I say nothing will be taxable in his hands? Check please. 100% clear. Tell me honestly. And if nothing is taxable, can I say even TDS under 194 DA will not be applicable? Because TDS under 194 DA is applicable if it is taxable. If it is exempt, then it is not applicable, correct? So today we are also going to link with the provision of TDS. Shall I read the second one, Mr. Y? Is Mr. Y fulfilling the percentage criteria?
No. No. No, sir.
No. Will it be taxable?
Yes, sir.
Check. How much taxable? That will compute. Separate statement will make. Okay? Are tell me fast, Palani. 100% clear, crystal clear. Third one. Is Mr. Z fulfilling the percentage criteria? Again, not fulfilling, taxable. 56 to 13. Clear? Is Mr. A fulfilling the percentage criteria?
Yes, sir.
Is he fulfilling the amount criteria?
No, sir.
So will he be taxable?
Yes, sir. Yes, sir.
Yes. So except X, all three of them are taxable. Clear? Now, if they are taxable, how they are taxable? They are taxable by this formula.
Yes, sir.
Now, how to use this formula intelligently? Let me explain you. See here. Should we compute the taxable amount of Y, Z and A?
Yes, sir.
Tell me now.
Yes, sir.
So let's compute the taxable amount of Y, Z and A. Shall I?
Yes, sir.
See what I am doing. Listen on the board. What is the amount payable at the time of maturity? Shall I write that first?
Yes, sir.
Now, what is the amount payable at maturity? 44 lakhs, 66 lakhs and 66 lakhs. Is it clear? 44, 66, 66. Okay.
Yes, sir.
Then I am writing annual insurance premium. How much they have paid as an insurance premium every year? 4.5, 6.1, 5.9. Clear?
Yes, sir. Yes, sir.
So I am writing this 4.5, 6.1, 5.9. Clear? Now see what I am thinking. Listen carefully now. Now what logic I am applying? See now. Can I say for Mr. Y, he has already used the ATC limit of 1.5 lakhs. Has he used the ATC limit of 1.5 lakhs or not? Therefore, can I say that Mr. Y has not claimed the deduction of premium in earlier years? Can I say that or not? Mr. Y has not claimed the deduction of premium. Therefore, he will get the deduction on maturity or not? Please tell me. For Y, for Z, can I say for Z, he has paid a premium of 6.1 every year? Can I say out of this, he has claimed 1.5 lakhs every year as an ATC deduction? Therefore, for him, how much he has not claimed as deduction? Please tell me. So, how much 4.6 I can claim or not on maturity as a deduction? Alright, did you understand? This is how you are going to arrive the limit. Are you clear? Can you say for the third point? Yes. 1.4 ATC and 10,000 you will claim for insurance premium.
Yes, sir.
And remaining 5.8 you have not claimed earlier. Are you clear? So let's see now. Step by step we'll go. Amount of PPF contribution 1.5, nil and 1.4. Is it clear? Are you clear or not? Tell me now.
Clear.
I'm just writing in a proper format now. I have to write it in a proper format, right?
Yes, sir.
Now, amount of deduction under ATC. In ATC, I will get 1.5 lakhs for all three of them. Now, therefore, deduction under ATC pertaining to insurance premium is how much? Can I say in first case nil? Because PPF is sufficient now, 1.5 lakhs. Arey, tell me now, please. In second case, how much we are using from insurance premium for ATC? 1.5 lakhs we are using, right? Or we are using now 1.5 lakhs from ATC. And in third case, we are only using 10,000 from ATC, right? Therefore, balance is what? Tell me. Not claimed as deduction in earlier year, correct? I will multiply all of them with 10 years, right? Because I have to reduce the premium of 10 years now. So I will multiply all of them with 10 years. So I will get 45, 46 and 58. Is everyone clear till here? Now, what is the formula for income? Amount received minus insurance. So therefore, the first one will be nil. Arey, yes or no? Because the amount received is less and the premium is more. In second case, the amount received is 66 lakhs and the premium is 20. Sorry, premium is 46. Therefore, the taxable amount will come to how much?
20.
Are you 100% understanding? Sure, na?
Sure.
And third case, 66 lakh you received and the premium is how much? Now, please, I would like to ask you one question. Sorry to ask that again. What is this premium? This is which premium? Which is not claimed as a deduction earlier. Clear or not? Yes.
Yes, sir.
And therefore, whatever amount will come on that, 5% TDS will be deducted by the company. Yes or no? Check please. Because do you remember that in 194 DA, the company deducts TDS on net income? Do you remember that? So they will deduct TDS on this much amount. Is 100% clear to everyone? Please tell me. Sure, na? So shall we go ahead with the next question then? Shall we? Now this one person itself has 4 policies. One person itself has what? Chalo, let's see. Will you answer?
Yes, sir.
Now the first policy was issued in 21. Therefore, this is amendment is not covered, na?
Not applicable.
Here you will only check what?
Percentage.
So is the percentage criteria fulfilled for policy 1?
Yes, sir. Yes, sir.
This is exempt. Can I directly say it is fulfilling the percentage criteria? Tell me now, please.
Exempt, sir.
Second policy also amendment is not applicable, correct?
Yes, sir.
Therefore, directly you will check what?
Percentage.
Is percentage criteria fulfilled?
No, sir.
No. Therefore, can I say this is directly taxable?
Yes, sir.
Right?
Yes, sir.
This is directly taxable. Forget about it. Okay.
Yes, sir.
Now the third and the fourth policy. Can you claim exemption? First of all, check whether the percentage criteria is fulfilled or not. Is the percentage criteria fulfilled?
Yes, sir.
Yes. Is the percentage criteria fulfilled?
Yes, sir.
Yes. Both of them are escape from percentage, right? But I cannot claim, is the individually both of them exceeding 5 lakh rupees? Individually they are not exceeding 5 lakh, but I cannot claim both of them not together. Tell me now, please. I have to take a call. If I make policy 3 exempt, then 4 will be taxable. If I make policy 4 exempt, then 3 will be taxable. Are you clear? I cannot make both of them what? Exempt, because the aggregate premium should not exceed how much? 5 lakh if the policy is issued on or after 1/4/2023. Is it clear? Please read the answers if you want. It's a beautiful provision or not? 100% clear now. I have a lot of doubt because I am scared while teaching this provision. Policy 1, exempt, only percentage applicable. Policy 2, exemption not applicable. Okay, taxable. Now policy 3 and 4, you have 2 options, right? Make 3 exempt, 4 taxable, make 4 exempt, 3 taxable, whatever you are more comfortable. Okay, you just see where there is what? More tax benefit. Okay.
More tax benefit, sir.
So today's lecture, I told you, very critical lecture. Absolutely important. Now, is the ICI interested in bringing the new study material or not? I am not able to understand the scope of new topics, yaar. Like black money law, what they will cover, yaar. That's the reason I am not able to issue book 2 to you all. Is it clear?
Yes, sir.
Now, question number 5. Suppose in the above case, assume that the policy for a sum assured is 42 lakhs. So let's assume that the policy for sum assured is how much?
42.
42 lakhs. Then what will happen?
Exceeds percentage.
It exceeds percentage criteria, correct? Then you can close your eyes and say it is taxable. Then this will be exempt, right? Then there is no other option. Now you have to make policy 3 exempt. Check. 100% clear to all of you. So now you can take what? The photograph of this, and then we'll end the lecture. Okay? Obviously, we will end now. Done?
Done, sir. It's done.
Now there is a CBDT circular on this, which came on 16th of August. Don't worry, it doesn't explain anything great. I will do that circular with you all in the question bank later on, in which they have given 7-8 illustrations to explain how the permutations and combinations will be worked out. Okay? Now, copy this. This is the most important point, not claimed as deduction earlier. Okay? Now pay attention, please, all of you. Now we are going to do some very important discussion now, which is absolutely important for exam. And that is a new section is inserted by the government in Finance Act 2023 50 AA. Absolutely new section. Okay. Added by what? Now this section is applicable for 2 items. For how many items? 2 items. One is specified mutual funds. One is, and second is market linked debentures. What?
Market-linked debentures.
Market linked debentures. Okay. How capital gains will be computed in these 2 items? That is said by section 50 AA. Okay. So now let's see the provision of 50 AA. Come to page number 32.2, all of you. First of all, we need to understand the definition of these 2 terms. Which 2 terms? Specified mutual funds and market linked debenture. Clear?
Sir.
Special provision for computation of capital gains in case of specified mutual fund or market linked debenture. Section 50 AA has been inserted with effect from AY 24-25. It covers computation of capital gains on transfer of a unit of a specified mutual fund or what? Or market linked debentures. So what do I mean by specified mutual fund? Shall I read? Specified mutual fund means a mutual fund which satisfies the following 2 conditions. So if 2 conditions are fulfilled, a mutual fund will be called as what? Tell me. Specified mutual fund. Okay. First, the mutual fund has invested, underline, not more than 35% of its total proceeds in the equity shares of domestic company. So the mutual fund is what? Not investing more than what? Tell me. 35% of its total corpus in what? In equity shares of domestic company. So you can write down over here, it is nothing but a, write down over here. Write down over here, it is nothing but a debt oriented mutual fund. What it is? Debt oriented mutual fund it is. Which mutual fund it is? It means this mutual fund invest more than 65% of its money in what? Debt securities, not in equity shares. Correct? Tell me, Palani. And the assessee has acquired the units of the aforesaid specified unit on or after what? 1st April 2023. Otherwise, this section is not applicable. Okay. So the if you have acquired before, then this section is not applicable. Okay. Now pay attention, please, all of you. Shall I say? So what kind of mutual fund it is? So the government has almost now, when you will read the provision, you will come to know. We have not done the provision. The government has discouraged debt-oriented mutual fund like anything. You'll come to know this is a very discouraging section. Once we read the provision, we have not read the provision so far. We are just doing the meaning, right? We have not done the computation. Once you read the computation, you will come to know the government has discouraged debt-oriented mutual fund like anything. Before that, we will also read what? The definition of market-linked debentures, okay? Now, the definition of market-linked debenture under income tax law is given here. Check. But before that, I have given some analysis from my side, okay? That what market-linked debenture is exactly, okay? Then we'll read the law definition. Is it clear? Is it clear, Palani? We'll read the definition of law after we read our general definition, okay? First, we need to understand the concept. The law definition is very technical. Market-linked debentures, underline first of all, is non-convertible debenture. These are non-convertible. This cannot be converted into equity shares. Okay? Is it clear? Second, the returns on such debentures, underline, are not fixed. Returns are not fixed, unlike other debentures where returns are always what? Fixed. But here the returns are not fixed. Then how will I get the return? The returns are linked to performance of certain markets. Like see here, please. See here. The returns are linked to performance of the market. Like what they will say? They will tell you that if you purchase market linked debenture now, and if you invest 1 lakh with us, then we will give you this much interest if the Nifty goes beyond 20,000. Or we will give you this much interest if the Sensex goes beyond 70,000. So it is linked to performance of what? Tell me. Market. The returns are not fixed. Check please. The market index could be indexes like NSE Nifty, Sensex, government security, etc. These are structured fixed income security with what? No periodic payout except maturity. You will get the money only on maturity. You will not get monthly interest. Okay. No monthly interest. Is it clear? It will be cumulative. Okay. And nothing will be chargeable under IFOS. Everything will be charged at the time of maturity under what? Under capital gains. Okay. The returns are determined on the basis of performance of underlying index. So how the returns are determined? Based on index. And consequently, these are known as what? Market linked debentures. There is no fixed tenure also, but generally it is 12 months to 60 months. Okay. So these are non-convertible. There is no fixed return. They are linked to market. There are no periodic payment. Right? You'll get everything on maturity. There is no fixed tenure also. Is it clear? Is it clear? Now let's see the definition of this as per the income tax law. It means a security which has an underlying principal component in the form of debt security and where the returns are linked to market returns on other underlying securities or indices. Okay. It includes any security classified or regulated as market linked debenture by whom? Tell me. By SEBI. So in exam you are not supposed to identify that what is market linked debenture, what is not. Nobody is going to ask you that. Because even income tax law does not know. It depends upon the SEBI classification. Okay. SEBI will give the criteria for what? Market linked debentures. Is it clear? So I have given you some of the hints which SEBI says. This is not complete guideline. Complete guideline is very long of SEBI on market linked debenture, which is not there in your syllabus. Okay. So now what things are covered in this new section? Specified mutual fund. Those are generally debt oriented mutual funds in which up to 35% might be equity shares. Okay. In domestic company, and rest of the investment will be in debt. Okay. And second is market linked debenture. Now what is going to happen in this case? Listen. How will you compute the capital gains? See here, all of you on the board. The capital gains will be computed in the normal way. The first thing which you will write is what? Tell me. which you will receive on transfer or redemption or maturity. Okay? Or if you sell, then it is transfer. If you don't sell, if you wait, then it can be a redemption or maturity, right?
Yes, sir.
Then cost of acquisition will be reduced. Okay?
Yes, sir.
Expenses on transfer will be reduced. Okay?
Yes, sir. Yes, sir.
The catch and the only catch in this section is whatever the answer will come, whatever the unfortunately that will always be short-term capital gains. That will always be short-term capital gains. It means no indexation and you will always be charged at higher rate. So they are discouraging which market? Dead market. Dead market is gone. Dead mutual fund scope is gone now. Better than this would be a fixed deposit now. Okay. Yes. Anyways, both are hopeless only. Forget it. There are few additional points which are there is nothing great in those points. I have clarified all of them. 50 AA makes the following deeming provisions pertaining to market linked debentures or units of specified mutual fund. In the hands of investor, market linked debentures or units of specified mutual fund will always be treated as what? Tell me.
Short-term capital asset.
Irrespective of the period of holding. Okay. So we are not interested in period of holding now. Okay. It's always short term. It's even after 10 years, it is short term. Okay. Even after 20 years, if you sell short term. Gain or loss will always be treated as short term capital gain or loss. Okay. Deduction of STT will not be allowed. That we already know. Okay. In capital gains, we do not get deduction of what? STT. Okay. So this is what this small provision, very simple, nothing great as such. Okay. But a new provision, it can come in exam. ICI will deliberately give you what?
Equity oriented mutual.
They will deliberately give you the data of this and they will give you what? Indexation. Deliberately they will give you indexation in the question. Okay? You will say, I don't want. Okay? I don't want it. Keep it with yourself only. They will deliberately tell you that this was purchased in 21 or 23 and it is sold in 29. So after 6 years, they will emphasize after 6 years, after 6 years, after 6 years. They will emphasize on that point. You say, I don't want. It is always short term. Okay? If it is sold after 6 years or 60 years, it is short term only. Is it clear?
Clear.
So they will test you on these points definitely. You can check it. They mark my words, please. Just go through it once and then we'll go ahead with our most important provision of the entire capital gains. Okay. Just go through this provision once and then we'll go ahead with that. But today I would like to start with the very first clause in exempt transfer with the Finance Act 2023 amendment. So there is one Finance Act 2023 amendment which has been placed over here. Pay attention please all of you. Suppose, pay attention on the board. Suppose I am Mr. A and I purchased physical gold of rupees 10 lakhs in financial year 2005-2006. Okay. Now in the current year, I want to convert this into what? I want to convert this gold into a
Stock input, sir.
no, not stock in trade. Palani, listen. I want to convert this gold into electronic gold receipts. What?
Electronic gold receipt.
Electronic gold receipt. In short, I want to convert my physical gold into electronic gold. Okay. I want to convert that into an electronic gold. Now, where can I do that? You can go to a bank.
Government bank.
Okay. You can go over there and you can convert it. Okay.
Yes, sir.
At the same time, you can also do vice versa. That if you have electronic gold receipt, you can convert that also into what? A physical gold.
Gold.
So whether you have gold or receipt, you can convert either of them into the other thing. Okay. Now, while doing so, listen carefully. If I am giving gold and in exchange I am getting what? Electronic gold receipt. It's an exchange of capital asset. Right? It's a transfer of capital asset. Yes or no? Please tell me.
What transfer?
Exchange is a transfer. Therefore, this is also a transfer. But the government has exempt such transfer under section 47. Okay. And the government has said that such transfer will not be subject to what? Will not be subject to tax. It is exempt under section what? 47.
47.
So conversion of a physical gold into an electronic gold receipt or conversion of an electronic gold receipt into a physical gold is exempt under section 47. Is it clear? Please tell me. Now listen carefully. Now pay attention on the board, please. Say in the previous year 5-6, I purchased physical gold of rupees how much? Of rupees 10 lakhs. Okay. Then in the previous year 23-24, I converted that into what? Tell me.
E-gold. Electronic gold.
Electronic gold receipts. So this conversion is what?
Exempt.
Under section 47. Now, suppose later on, in previous year 28-29, I want to sell the EGR. I want to.
Sell the ETR.
So there are two questions which will come in picture. First is what will be the.
Cost of acquisition.
So the law has defined the cost as the cost of EGR will be same as the cost of acquisition of what?
The physical gold.
The physical gold. They have defined that. Okay.
Okay.
The first thing is this. Second thing, from where I am going to count the period of holding. Okay. So for that, the government has made amendment in section 242A. That is the definition of what? Short-term capital asset, and this says that you have to count period of holding from year till year. That is, period of holding will be counted from 2005-2006. That is the date from which you have purchased what? You have purchased a physical gold. Okay. And this is exactly going to be the situation in vice versa case. Okay. In vice versa case also it will work like this only. That is, first you had what? EGR, then you converted that into what? Physical gold, exempt. Okay. Later on you sold what?
Physical gold.
What will be the cost of that physical gold? The cost of EGR and the period of holding shall be clubbed. Okay. So this is a very simple concept. Vignesh, here there is some disturbance from your end. Maybe because of the earphone. Now, you can come to page number 34.2, please. You will get all these provisions over here. This is absolutely a new section. I'll just show you the provision one by one. See here, please. First, I'll show you section 47. Conversion of gold into EGR or vice versa. That conversion of gold into EGR or EGR into gold shall not be regarded as transfer. Capital gain is exempt. Okay.
Yes, sir. Okay, sir.
Next, what will be the cost of acquisition? The cost of acquisition of EGR will be same as the cost of gold. Okay. And the cost of gold will also be same as what? The cost of EGR. Okay.
Yes, sir.
The period of holding shall also be what? Tell me.
Based on the first original acquisition of cost of gold each year.
Yes, the period of acquisition will be counted from the original acquisition. Okay. And not from the date of conversion. Is it clear? So, it's a simple provision, nothing great as such. Okay. Now, listen carefully. What do I mean by disinvestment over here? Okay. Disinvestment means what? Okay. Disinvestment means over here the government has said that the government will reduce its shareholding to 51%, below 51% rather. Okay. The government will do what? Tell me. Will reduce its shareholding below 51% and will also transfer the control to whom? Tell me. The buyer. It will be transferred to the buyer. So, the government has to do two things. They also have to sell 51% of their shares. In fact, more than 51% of the shares. Correct?
Yes, sir.
And they also have to control what? Tell me. Transfer the control to whom? To the buyer, to Tata's. So this entire point in fact has been put for Tata only. The reason why? Because the Tata has put one condition that Tata company has put one condition on the government that we are buying your loss making company. Anyways, Air India is in loss. Agreed or not? Please tell me. So Tata is saying that we are buying your loss making company provided you at least give us tax benefits. In the form of what? In the form of what? Please tell me. Carry forward of losses. Otherwise, why the hell we will take this liability from you? Okay. You cannot do that whenever you want you will take and whenever you want you will sell. It's not like that. Okay. There is a law in this country to compulsorily acquire anything. There is no law in this country to compulsorily tell. There is a law in this country to compulsorily acquire anything. But there is no law in this country to compulsorily what? Sell anything to anyone. Can government compulsorily sell anything to anyone? Please tell me.
No, sir.
No. So once upon a time in 1957, if you are aware, I don't know whether you are aware or not. Air India before 1957, it was in the hands of Tata. So the government of India compulsorily acquired. That is allowed. You can. But you cannot compulsorily sell again to Tata unless Tata tells you that I want to buy. Okay. So Tata put all these conditions and the government of India agreed to the condition. The government of India put these conditions as a what? As a benefit to Tata. Okay. So this point has come for Tata only. I think so once the Tata entire amalgamation will be completed in the next 5 years, they will remove this point also, I think so. Okay. Now, the next amendment is on page number 34.15. Please come to this page. And there is some amendment in the definition of original fund first of all. Under original fund, earlier there was only point A. Now there are 2 points which are added over here. What is the first point? It is an investment vehicle in which Abu Dhabi Investment Authority is direct or indirect sole shareholder or unit holder or beneficiary or interest holder, and such investment vehicle is wholly owned and controlled directly or indirectly by the Abu Dhabi Investment Authority or the government of Abu Dhabi. Now what do I mean by this? So there is some SPV, in Abu Dhabi. Now who is the sole shareholder? Abu Dhabi Investment Authority is the sole shareholder and it is controlled by Abu Dhabi Investment Authority or it is controlled by the government. Okay. So such kind of investment vehicle can also be called as original fund. This is the first amendment. Second amendment. Second amendment, even I don't know, because it is a fund which will be notified by central government. Okay, so the government will give a notification, and through a notification they will notify one particular fund. Okay, now who is that fund? That I am not aware of. Okay, that only time will say. So this is the first amendment under this section. The second amendment under this section is in the definition of relocation. Earlier, the time limit over here was last year, 2024 or 23. I don't remember the exact year. I think so it was 24. But now it has increased to 2025. Check please. Okay. This is the second time. This is the second amendment which is made over here. Okay. Third amendment is similar to what we have seen in AIF also. Earlier, the resultant fund was a fund which was registered as per the SEBI regulations. Now, resultant fund can also be a fund which is registered as per the IFSC regulations. Check. Like in AIF, there was an amendment now. AIF is something which is registered as per SEBI. Now it is also registered as per IFSC. Similarly, here also, now it is also registered as per what? IFSC. Check it please. Okay. Now, there is one more amendment which is made over here. Pay attention please. Now, to understand this amendment, I have made one small example to explain you this amendment. Pay attention on the board please. There is a public sector company over here who is having some interest in a joint venture. Okay, a public sector company is having some stake. Interest means a stake in a joint venture, 50%, 60%, 70%, whatever it is. Okay. Now, if you are transferring that interest, okay, if you are transferring that interest to a foreign government company, okay, so this PSU is now transferring this joint venture interest to a foreign government company, and in return, what are you getting? You are getting the shares of the foreign government company. So such transfer is what? Such transfer is exempt under the income tax law. Check under section 47(10). Okay, that is 47(20). By virtue of this amendment, any transfer of capital asset being an interest in a joint venture held by a public sector company. Who is holding the asset? Public sector company. What is the asset? Interest in the joint venture. In exchange of shares in a company incorporated outside India. You are exchanging with whom? With the shares of a company incorporated outside India by a foreign government. Okay. By whom? By a foreign government. Will not be treated as transfer. Okay. Now, another question will come to our mind, and that is, now we have shares. Earlier we had stake. Now we don't have stake. We have shares. What will be the cost of acquisition of the shares? Common sense. Cost of acquisition of shares will be the same as the cost of acquisition of the stake. It is as simple as that. For that, they have made another amendment in section 49(2)(ai). The cost of acquisition will be the same as the interest in the joint venture. Check it please. Okay. And one last amendment in this book, then we'll move on to book number 2. And that is in section 54 as well as in section 54F. In both the sections, they have made an amendment. What is an amendment? In 54, what do we do? In section 54, we sell our long-term residential house property and we buy another long-term residential house property, correct? Yes or no? And in 54F, what do we do? We sell all the long-term capital assets except residential house property and we buy another residential house property. Now, when you buy a residential, in both the sections, you are going to buy a residential house property. What you sell is different in both the sections, but what you buy is same in both the sections. Now, in both the sections, when you buy a residential house property, the government has put a cap over there. You cannot get an exemption of more than 10 crore rupees, maximum 10 crore. It means if you sell a house and if there is a long-term capital gain of 40 crore rupees, now, if you buy another house of 40 crore, not allowed, only 10 crore will be allowed, 30 crore will be taxable. Check it please. Very important amendment. Very, very, very. This has to be tested in your examination. It has to be tested. 100% will be tested by the ICI in the examination. Check it please. Very important amendment. Very, very, very important. So, you invest how much ever you want to invest, but you will not get exemption of more than 10 crore rupees. Okay. So now let's move on to the amendments which are there in your book 2, and in book 2 the first amendment is there in the chapter of taxation of dividends. Now what is the first amendment? Let's try to understand that. Pay attention please all of you, which is on the last page of this chapter, page number 47.6. There is one unit of IFSC which is engaged in leasing of aircraft. Okay. And there is another unit of IFSC which is also engaged in leasing of aircraft. So both the units are engaged in leasing of aircraft. Now if one unit gives dividend to another unit, both of them are same only. If one unit gives dividend to another unit, then that dividend is exempt in the hands of the recipient. Okay. This is what this provision is all about. Check it please over here. By virtue of this exemption, dividend income of a unit of any international financial service center primarily engaged in the business of leasing of aircraft. So the first unit is engaged in the leasing of aircraft and it is in IFSC. From a company being a unit of an IFSC, primarily again engaged in the business of leasing of aircraft, is not chargeable to tax. Okay, I hope it is clear. Now, the next amendment is there in the chapter of taxation of gift, and there are in fact two amendments over here in this chapter. The first amendment is in section 918. You might be knowing that if there is a resident in India, okay, and if the resident is giving some gift to a non-resident outside India, then it is taxable in the hands of the non-resident. Okay. Now, there is a enhancement of the scope of this section from this year onwards. That is from 1st April 2023. Now, if a resident gives gift not only to non-resident but also to not ordinary resident, then also it is taxable on or after 1st April 2023. So, what is the position now? The resident is giving money as a gift to two people. First, to non-resident or foreign company, that was already covered. And what is the amendment? Not ordinary resident also if he gives, that is also now taxable under the income tax law. Check it please. Okay, I hope it is clear to all of you. Right? So wherever the word non-resident is there, foreign company is there, you will also find not ordinary resident. Wherever the word non-resident is there, you will find out not ordinary resident also from 1st April 2023. One more amendment is there in this particular chapter, which is under section 5627B, which is only applicable to a closely held company. You might be knowing this section, what does it talks about? If you are a closely held company, if you issue shares, and if you issue shares at more than the market value, suppose the fair market value of the share is how much? 30 rupees. You are issuing, your issue price is more than that, 200. Therefore, 170 will be income from other source in the hands of the closely held company. But this provision was applicable only if the shareholder was resident. What about if the shareholder is non-resident? Then this section was not applicable. But from Finance Act 2023 onwards, this section is even applicable if the shareholder is what? If the shareholder is non-resident. Check it please. So now this provision is also applicable for non-resident shareholders. Check it. Now the next amendment is there in the provision of SEZ, which is a deduction under section 10AA. Now there are multiple amendments which has come over here. The first amendment is in the definition of export turnover, which is in the numerator of the equation. So in the definition of export turnover, what is the amendment? The amendment is you have to bring the money in India within 6 months. This was there earlier also, but now they have specifically clarified in the law. Earlier it was not there in the law, it was there in some CBDT circular. Some case laws were saying they are also taking reference of FEMA law, because in FEMA it is written that you have to bring back the money within 6 months. But now this is a part of the law now. So you have to bring the money to India within 6 months or within such extended period as the law may allow. Okay, check. So you have to bring the money to India within such extended period as the law may allow. Now, this is the first amendment which is made. Second, even if you don't bring the money in India, there is a sum deemed to be received in India concept. You have not brought the money to India, but if you do certain things, then it is deemed to be received in India only. So what shall I do? For that purpose, you are supposed to credit the amount to a separate account maintained by SSC with any bank outside India with the approval of RBI. Okay. What will be the best thing if you want the deduction? Bring the money to India within 6 months. That is by 30th of September. 23-24, 30th September 2024 should be the last date. Can I get an extension? Yes. If the competent authority would allow you, they can give you the extension also. You can take the extension also from the competent authority. Okay. Second possibility, if you don't want to bring the money to India, make a separate account outside India with an approval of RBI and credit all your proceeds to that account. Then it will be deemed to be received in India. Okay. It is deemed to be received. This is the second amendment. Third amendment. For example, you are not able to bring the money to India within time. So you will not get the deduction. Okay. You will not get the deduction. The deduction will be disallowed in the current year. But there is a separate rectification section which is brought by the government. Government says that whenever you will bring the money to India in future, don't worry, the AO will rectify your order within 4 years and will give you the deduction. Don't worry about it. Check please. 155.11a has been amended. So right now you have not brought the money. So the expenditure will be disallowed. So the profits will be disallowed. Profits will not be subject to deduction. But whenever you will bring that money to India, at that time, the AO will allow you that deduction and he will rectify your order of last year within 4 years. 155.11a has been amended to allow the AO to amend the assessment order later, where the export earning is realized in India after the permitted period. So you have realizing say after 2-3 years. So your order would have been passed earlier by disallowing that particular profit. But don't worry, the AO will allow you by rectifying your order within 4 years from the end of the previous year in which such income is received. So whenever that income will be received within 4 years from the end of that year, the AO will rectify your order. Don't worry about it. Okay. And one last amendment is due since many years, and that is if you want to claim the deduction under 10AA, then you have to file the ITR on time. If you don't file the ITR on time, we will not allow you the deduction under section 10AA. So if you want to claim the deduction under 10AA, file the income tax return within the due date mentioned under 139(1). Okay. This is what this provision is all about. Okay. So these are the amendments which are there under 10AA. Okay. Now, the next amendment is in the chapter of taxation of mutual fund, which is in the amendment is there in the TDS provision. Generally, if you make a payment to non-resident or foreign company for any payment with respect to mutual fund company, suppose if the mutual fund company is giving some dividends, etc., to the non-resident or foreign company, they have to deduct TDS at the rate of 20%. Okay. But if the non-resident gives us a TRC, okay, what he gives? He gives a TRC to us, condition number 1. And there is a DTAA between India and that country. If there is a DTAA between India and that country and the non-resident gives us a TRC, then in that case, we have to deduct TDS as per the rate of 20% or the rate prescribed in DTAA, whichever is lower. Condition C. If the non-resident has a DTAA, with non-resident is residing in a country with which India has a DTAA, and the non-resident is presenting a TRC, tax residency certificate of that country, then I have to deduct TDS at the rate of 20% or the DTAA rates, whichever is lower. Check it please. Okay. Now, there are some amendments which are made by Finance Act 2023. Over here, they have nothing to do with advance tax. They have, but it was not getting fitted anywhere else, so I fitted here. Okay. Now, I cannot make a chapter now for such small provisions, right? Yes. So you can say these are miscellaneous provisions. Okay. Out of which this provision is not relevant in today's time. This is an amendment which is made with respect to some concept which are not relevant in today's time. But yes, this is relevant, this is relevant, this is relevant. This is based on some settlement commission, etc. That commission is removed now by the government of India. Now, what is this exactly? Pay attention. I'll give you an example. Amendment Finance Act 23. Pay attention. Palani, are you listening? There is Mr. A over here, there is Mr. B over here. Mr. B is payer, Mr. A is payee. Okay. Now, Mr. A is a seller, Mr. B is a buyer. Okay, you can say like that. Now, in financial year 2023-24, Mr. A has shown income accrued 10 lakh rupees. Okay. and paid the tax. Okay? Is it clear?
Yes.
Now, next year, that is in previous year 24-25, the payer paid the money. The payer
Paid the money.
and deducted what?
TDS.
Deducted TDS and paid to government. Okay? But with respect to this income, assessee has already paid tax in last year, correct?
Sir, he has already paid tax, sir.
Therefore, now in previous year 23-24,
Okay.
the assessee can make an application. Can make what?
Application.
For what? Refund of TDS. Yes or no?
He can make application for refund of TDS.
Yes or no? Because last year he has already paid tax on that 10 lakh rupees.
Yes, sir. Understood, sir. Understood, sir.
Now this TDS will be useless now in the current year.
Sir.
So the government will give you what? Refund, and they will also give you interest. Because they are using their money na. They are using your money unnecessarily for a larger period of time. Yes?
Sir.
So they will pay you interest. Interest will be from? No. From date of application, from?
Date of application.
To grant of refund. To?
Grant of refund.
Palani, this is the Palani that I want in my lecture. Okay?
Okay, sir.
This is the Palani that I was expecting. Okay?
Okay, sir.
So, what is the entire funda of this particular discussion? The funda is, listen, you are offering income on what basis? But TDS is deducted in the?
Payment basis.
In next year. Okay?
Yes, sir.
Right?
Yes, sir.
So now you can make an application for refund. Okay. Now in the meanwhile, please tell me, is it possible that your assessment is done? Your intimation is passed? Tell me now.
Yes, sir.
So you can make an application to the AO to rectify your order also. Okay.
Yes, sir.
And he will rectify your order and he will grant you refund along with interest. Okay.
Yes, sir.
So now you can read this provision with me. Page number 51.4. Section 155.20 is applicable in case of an assessee who has reported income on what basis?
Accrual.
But tax is deducted by the payer of the income in the later financial year. Okay?
Okay.
In such a case, an application can be submitted by the concerned assessee to get what? The credit of the TDS. On such application, if the credit is allowed by the AO and the refund arises and the
Refund arises.
interest on refund, there is a possibility na, that refund is not arising. There is a possibility or not?
Yes, sir.
How? How?
Demand notice may be there.
No. There is a possibility that refund is not arising in the next year because next year the tax liability is much higher. So you can adjust that TDS against the tax liability, na?
Yes, sir.
Yes or no?
Yes, sir.
So refund is not coming. In case refund comes, it will be calculated from 1st October 2023 at the rate of 0.5% per month, comprised in the period from the date of such application to the date of grant of refund. Is it clear?
Yes, sir.
This provision is applicable from 1st October 2023. So the ultimate conclusion is what? You are supposed to make what? Tell me. Application. The question is by when I should make an application? Yes or no?
Yes, sir.
There has to be some last date now to make an application. Check. Such application can be made within 2 years from the end of the financial year in which the TDS is deducted. Are you clear? So you have to make an application within how much time? Within?
2 years from the end of the year.
In which the tax is deducted. In my example, tax is deducted in which year?
24-25.
So you can make an application till 31st March 2027, right?
Yes, sir.
To take a photograph of this, that's it. Is it clear?
Yes, sir. why should I make an application, sir?
You should make an application only if refund arises. Otherwise, don't make.
Because if the refund arises, that thing, sir.
That is only for charging interest.
Clear, clear.
Okay. That if there is a refund, they will pay you interest. If there is no refund, they will not pay you interest. Okay.
Yes, sir.
Now, there is another important amendment which they have made. Very dangerous amendment. In fact, they have made two amendments over here. Okay. Setting off of refund, this is one amendment, and then withholding of refund, that is second amendment. Now, what do I mean by this? Very dangerous provision. You will understand it by yourself only. Read. I don't have to say this. Self-explanatory it is. Where the refund becomes due under any provision of the Act. Okay? The AO, CIT, Principal CIT, Chief CIT, Principal Chief CIT may, in lieu of the payment of refund, set off the amount to be refunded against the sum remaining payable under the Act by that person to whom the refund is due. Say for example, previous year 23-24 intimation processed, refund due 5 lakhs. Okay. Okay, Palani.
Okay, sir.
But at the same time, previous year 22-23 demand outstanding is 7 lakh. How much?
7 lakh. 7 lakh.
So they will adjust this refund against this. Are you clear?
Understood, sir. Understood, sir.
And pay balance. Are you clear?
Yes, sir. They will assist against
They will adjust against your previous outstanding. It makes sense also, na?
Yes, sir. Yes, sir.
Because first they will give you a refund. Then they will come to you to recover the tax.
Yes, sir.
Rather than directly adjust, na yaar, why unnecessarily create all this havoc? Yes?
Yes, sir. Yes, sir.
Take the photograph, please.
Done, sir.
Okay?
Okay.
Now, what is the second amendment that they have made? Finance Act 2023, withholding of refund. What? What is this amendment? Pay attention. Suppose previous year 23-24, okay? You filed ITR. After that, your ITR was what? Process under 143(1). Okay? Suppose there is some refund due over here. 3 lakh rupees. In the meanwhile, before this only, the department began what? Your assessment, and they have sent you the scrutiny notice. What they have sent you?
The scrutiny notice.
Now the department feels that, the AO feels that giving refund will be detrimental to the department. Okay, giving what?
It will be detrimental to the department.
Because there can be huge tax liability to the assessee. There can be
Huge tax liability.
so he can withhold the refund. He can withhold the refund till what? Tell me. Logical date. Till when he will withhold?
Till the completion of assessment.
Yes, till assessment completion. Perfect. Clear? To withhold, he has to take some prior what? Approval from certain authorities. Okay, we'll see that. Okay.
Yes, sir.
You can take a photograph of this first and then we'll see.
Done, sir.
Now, read this.
but if I have been substituted with the difference of the new section relating set off and withholding of refunds in certain cases. Provision not even your set off of the refund against the outstanding liability where refund becomes due under any provisions of the act. The assistant officer, CIT, CCIT, CCIT, ECCIT may the payment of refund set off the amount to be refunded against the sum remaining payable by the person to whom the refund is.
Okay. Is it clear? Sure. So these are some important amendments. 2 marks question might come on this. Okay.
Okay, sir.
Now the next amendment is a very small amendment in the chapter of updated return. There is one sentence which has been striked off by the government. You come to the third page of this chapter. If you come to the third page, not the third, the fourth page of this chapter, that is the last page of this chapter, you will find out over here in how to compute interest under 234B where an earlier return is furnished. They have striked off these lines. Check it please. This was no more relevant, so they have removed this particular line. Apart from this, there is no other amendment in this chapter. Okay. Yes, one more amendment is there, which is with respect to time limit. And the amendment is, earlier we used to complete the assessment within 9 months from the end of the financial year in which the updated return was furnished. But now you have to pass the assessment order, complete the assessment within 12 months from the end of the financial year in which the return is furnished. So you might be knowing that all those who file an updated return, for them the time limit to complete the assessment is different, and all those who file the normal return, for them the time limit to complete the assessment is different. So for these people it was 9 months earlier, so it has been increased to 12 months now. Okay. Now there are no amendments in dividend and bonus stripping. Okay. Taxation of trust, there are many amendments. Some are big, some are small. I'll try to put all of them one by one. Don't worry about it. Okay. So we will do all the taxation of trust amendment now after this. Okay. Now there is one very important amendment which has come over here by Finance Act 2023. Now listen carefully. What SSC is doing? Shall I say? Shall I say? There is one trust, trust X or trust A. Okay. Who has earned an income of 10 lakh rupees. Okay. From this income, assessee will get how much donation, how much deduction? See here, Palani, 15%. 15% he will get, right? 1.5 lakhs. Okay. 8.5 lakhs. Now what assessee is doing? Assessee is giving donation. Is giving what?
Donation.
Of 8.5 lakhs. Okay.
Okay, sir.
So assessee's income will be 0, right?
0.
Correct? No. The donation is given to trust B. Which trust? There is trust B over here. How much donation trust B has received? 8.5 lakhs. Okay. Now trust B will get 15% exemption. Compute.
1.2%.
I'll just take complete. I'll take complete digit. Otherwise, it will be rounding off, right?
1 lakh 27,000.
This is 722,500. Okay. Now, what is trust B doing? See here, Palani. Shall I go ahead? Now, trust B is also giving donation of exactly 722,500, making it 0. Okay. Now, they are giving donation to C. There is trust C over here. How much donation trust C has got? Now, 722,500, they will get 15% exemption, correct? 1,08,375. This comes to 614,125, correct?
Correct, sir.
Now the trust C is doing what? Giving donation to trust D. 614,125. Okay. 0. Trust D. 614125. 15% exemption. 92,119. 5,22,006. Okay. Now see. See here now, please. Shall I say? Now, Trust D is actually making an application. Is doing what? Application of this amount for charitable purpose. Okay.
Okay.
Now, what is happening in this entire scenario? If you can make out. If you can make out of this, in this entire scene, what is happening? Listen, don't say anything. The income of 10 lakh rupees is there, correct? But eventually, only 5,22,000 rupees is getting used for the people. Correct or not? Out of 10 lakh income, only how much amount is getting used for the people? Only 5,22,000 rupees is getting used for the people. Almost 50% of the money is getting exempted. Yes or no? By making different layers. So this is what the assessee does. They have 4-5 trust friends. Okay. They have what? One will give to another, another will give to another, another will give to another, another will give to another, another. Like that. The entire object of the trust will be defeated. Yes or no? So Finance Act 2000 made an amendment now. Very important amendment. It is going to come in exam 100%. Without that, paper will not come. What is the amendment? The amendment says that from Finance Act 2023 onwards, whatever donation you give now, whatever, only 85% of that will be allowed. Fully will not be allowed. How much will be allowed? Now, if only 85% is allowed here, okay, then they have to apply the remaining 15% or not? Tell me na, don't do calculation, tell me logically na yaar. Yes? Here also 8.5 will come. If they will give whatever donation, then 15% they have to apply or not? Tell me. Very important amendment. Whatever donation is there, only how much will be allowed? Only 85% will be allowed. Read this first point with the amendment. So now pay attention, please, all of you. See here. The first thing that I'm going to discuss today is, I have told you in the last class that if you receive corpus donation, what?
Not taxable.
Then it is exempt, correct?
Yes, sir.
But it is exempt subject to
Certain condition.
some conditions, right? Do you remember that?
Yes, sir.
But we have not seen the condition in the last class. Okay, so today we are going to see the conditions. Not that easy to understand. Let me tell you very clearly. Come to page number 54.2, all of you.
Yes, sir.
And you can read this. Read this, waste your time, and then we will discuss. Okay? Rani. Read this, waste your time. And then we will discuss this point. Okay? Now, this corpus donation is exempt subject to some condition. This was added by Finance Act 2021. Sir, before that it was exempt unconditionally. Before that it was unconditionally, it was exempt. Unconditionally. No need to fulfill any condition. Okay. But now it is exempt subject to condition. Have you read? Now what does this paragraph wants to tell you? Listen carefully. Let me explain you. Let me give you an example. See here all of you. Then you can copy this example later on. This paragraph wants to tell us, suppose in previous year 23-24, a trust received rupees 10 crore as corpus donation. Okay. Now, if the trust invest this rupees 10 crore in the modes specified in section what? 11.5. Then rupees 10 crore will be what? Tell me. Exempt under section 11. 11 and 12. Okay. Rather, I will write the year. It will be exempt in the year 23-24. Is this clear? Vignesh, there is some disturbance. Some cars are going behind you. Say some disturbance, some cars are going behind you. Okay. So what is the condition to make it exempt? Be very careful when I am saying I have no energy today to repeat the things again, Palani. Okay. Okay, Palani?
Clear, sir.
Okay. So I received 10 crore corpus donation. What shall I do?
More specific.
Invest in the mode specified in 11.5. Your corporate donation will be exempt. Now listen carefully. Suppose the trust withdraws. The trust
Withdraws.
rupees 10 crore and make what? Application in previous year 24-25. Okay. Then this rupees 10 crore, this rupees
10 crore.
will not be allowed as,
Allowed as.
allowed as what? Application of income. Have you read this or not from your book? Please tell me. See the sequence of event. I received 10 crore corpus donation. What shall I do to make it exempt? I will invest in the mode specified in 11.5. It is exempt. Next year I will withdraw that particular money from 11.5. I will apply that money for the purpose of the trust. Not allowed as application. What? It will not be allowed as application. Okay. Shall I go ahead? Third point. Suppose previous year 25-26 total income is rupees 8 crore. Okay. How much it is? Now here you have to pay absolute attention. Now out of this income, Out of this, the trust deposits back rupees 5 crore to the corpus, that is 11.5 modes. Okay. So in 25-26, I would have earned some income from somewhere. Okay. Every year I will earn some or the other income. Yes or no? So out of the income of the current year, I am depositing back. I am again filling back my corpus. I am again filling back my 11.5 modes. Then rupees 5 crore will be allowed as what? Application of income. This is what it is written over there. Read it, please. Have you interpreted like this? Palani, see what I am doing. I received 10 crore. What shall I do? I will invest in 11.5 mode. I invested in 11.5 mode. What will happen? That will be exempt in the current year. In the next year, I withdraw that 10 crore. Correct? And I applied that 10 crore. Okay. Apply means I incur that as an expenditure. I might have bought land, building, something I might have bought out of that. Correct? Now, in this year, I will not get the what? Deduction. You can say I will not get the deduction. Simple words. Okay. Now, next year, what I did, next year I might have earned some income. So, out of that income, some money I have deposited back in my 11.5 modes. Okay. So, the moment you deposit back the money, it will be allowed as an application. Okay. So, the point is, it will not be allowed application on actual incurrence of the expense, but it will be allowed when you fill back your deposit. When you make your deposit again fill, that time it will be allowed as an application. Are you clear? It is not allowed because the logic over here, the department has not said any logic. Department does not say logic for why they are making anything taxable or why they are not making anything taxable. They do not say any logic. We perceive that and we understand from our side. The logic why it is not allowed as deduction over here is because you are applying an exempt income. Okay. So out of you are already claiming that as an exemption. Okay. Now applying will lead to double benefit to you. One time on receiving, one time on applying. It will be dual benefit. That's the reason it is not allowed. Now, why they are allowing as an application once again when I am depositing back? Okay. That will also be the question. The logic over here is because they want you to invest in government security. That's it. Okay. They want you to invest in what? That's the reason they are encouraging you deposit back in the government securities. We will allow you what? We'll allow you that as an application. Is it clear? Please tell me. Now, when this provision came in Finance Act 2021. Is it clear? Now, take a photograph of this, please. Very important provision it is. Because in this provision, now there is one amendment which came in Finance Act 2023. This is the position I have told you as per Finance Act 2021. Is it clear? Now, there is one more amendment which came in Finance Act 2021, which is a simple one. Okay. There is nothing to apply much. Read this. Simple provision, nothing great.
Understood, sir.
Now, please, if there is any of your friends who want to learn in English, recommend them our classes, first of all. Secondly, I have also launched one special batch of only full English. That too, only practical question batch. Only practical question. In that, only practical questions will be done. So there are many students who study in the industry, but they don't do question. They only study provision. Okay. They don't have sufficient practice of what? Of the question. So we have launched a batch. Okay. Which will be available in Hindi English and full English both. Okay. Obviously, all those questions which I'll be covering in that batch, that is the same thing which I have done it for you all. Okay. I'm not going to separately record anything. I'm going to cut from here only. Oh, have you read this? This is very simple now. Correct? See, Palani, Mr. Palani the Great. I have taken a loan of 10 crore. Okay. And with the help of that loan, I bought a building. I will not get the deduction. Clear? But when I will repay the loan, at that time I can take the deduction. This is what it wants to tell you, right? Correct? Now, with respect to both this provision, there is one clarificatory amendment which has come. Shall I say the clarificatory amendment? Finance Act with respect to corpus donation and with respect to this loan wala item. Okay. So, FA 23 has brought some clarificatory amendments here. Shall I say? Now pay attention please, all of you. Suppose this is previous year 2021. Okay. Now I received corpus donation of say 10 crore. Okay. Is it clear? Now, is it exempt? No, it is exempt without conditions. Because it was received before 2021. Correct? Right? Now, what assessee is doing, you know? They are playing with the game, playing game with the department. Check here. And old corpus donation is there, okay, which is anyways exempt or not. Now what they are doing, they are deliberating investing that in what? 11.5, okay. Say in previous year 21-22, okay. Then in previous year 22-23, they are what? Withdrawing and what? Applying, okay. And then in previous year 23-24, they are what? Again what? Depositing back. Now when they are again depositing back, they are applying the new amendment of Finance Act 21. What does it say? Finance Act 21 amendment says what? When you deposit back the corpus, it is allowed as an application or not? So, but the question is, this was already allowed as an exemption to you without any condition, yes or no? So, Finance Act 23 made a clarificatory amendment that if the corpus is received before 2021, if the corpus is, then you will not get any exemption for depositing back. Are you clear? Are you clear? Sure. This is the first amendment. Second amendment, listen. Second amendment, listen. There are a lot of things that we have to say over here. Pay attention, please. Second amendment. Before 2021, I took a loan. I took a loan of 10 crore I took. Okay? Before 21. I used that loan for the purpose of what? Buying building. Okay? Before 21, I took a loan and I bought a building. That building was allowed as an application earlier. Okay? It was allowed earlier. From 21 onwards, they have stopped this. From 21 onwards, they have said that no. When you buy a building or when you apply that money, it will not be allowed as application. When you repay the loan, it will be allowed as application. Okay? But before 21, it was not like that. You took a loan, you applied, you claimed the exemption. So what happened? Before 21, I took a loan. Before 21, I applied. Have I claimed that as an application or not? Now, after 21, I'm repaying. So after 21, when I'm repaying the loan, I'm again asking that as an application, because from 21 onwards on repayment, you get an application, right? But on this loan, you have already claimed that as an application now while incurring the expense. So how can you again claim what? Exemption on making a repayment of the loan? Not allowed. Okay. So these two cases, they have stopped. Check. Check. Understood?
Yes, sir.
Now, application out of what? Or loan or borrowing before? Shall not be allowed as application for charitable or religious purpose when such amount is or invested into corpus, or when the loan or borrowing is what? Repaid. I have discussed both of them together in one point only. Don't read ahead. Wait here. Now, so both these amendments are applicable from when? It is applicable from 21, not for people who have done all these things before 21. Are you clear? Now, in both these sections, the government has put one restriction. In both these provisions, now Finance Act 23 has put one restriction. The first restriction, which I have already told, if you have done the transaction before 21, now you cannot claim the exemption. Correct? Second, listen. When is in the first case, here, when is in the first case, when is the law allowing you the exemption?
Sir, when I deposit back into the 11
When I deposit back into the 11.5, correct?
sir.
And in the second case, when are they giving me the exemption? When I repay the loan. No, in both the case, is there any time limit to deposit back or repay?
No, sir. No, sir.
Is the law giving you any time limit? There is no time limit. Okay. So the assessee will deposit after 15 years. Who will keep the trail? Is it possible to keep the trail?
No, sir.
No, na? So now Finance Act 23 has made second amendment that you have to deposit back within 5 years. Check, please. Or else you will not get the exemption. Are you clear? Read this entire part. These amendments are gold amendments. Gold standard amendments. These are highly chance that they will come in exam. Are you clear? Is it clear? Sure. Both the amendments are sure.
Both amendments are sure.
Now, don't be under an impression that if you fulfill these conditions, whatever conditions I have told you, you will get an exemption. There are few more things that you have to fulfill always, which are given below. Out of that, lot of conditions we have already seen in the last lecture. Okay. Even if the aforesaid two conditions are satisfied, depositing back of the corpus or repayment of loan will not be considered as application unless the following additional requirements are satisfied at the time of what? Initial utilization of the corpus fund. First, such application should not be in the form of what? What? Corpus donation to another trust, because corpus donation is not allowed as an application. Do you remember that or not, Palani? Second, If the TDS is applicable, you have to deduct TDS, otherwise application is not allowed. You remember or not? If the payment is made to a person in a day in excess of 10,000, you have to deduct in 4 modes. Do you remember that or not? Then excess application is not allowed to carry forward and set off. Do you remember that or not? Then application is allowed on actual payment basis. Do you remember that or not? Now, fifth point you will not remember because you have not done it. So how will you remember? Okay. So that we will do today. Today we are going to do that. Okay. And the sixth point is very important. Circle it. Your application should be in India. Always in India, except in certain exceptional cases where CBDT will allow. See, if a charitable trust is made to help the people of Dubai, then there is no use now by Indian government to give exemption to you. Yes or no? Arey, the trust should be made for whose benefit? People of India, na. Otherwise, why we will give you exemption? Yes, clear? Yes, in certain cases they allow you in order to maintain international welfare. Okay. If they want to maintain some international welfare, say for example, there is some earthquake in some other country. Okay. So then they will allow you to apply the money outside India also. Okay. Because we want to maintain international welfare, yeah. Yes. Say we want to maintain international welfare with say Nepal because there is an earthquake over there. So we want to show our courtesy towards them. What? That we are helping you. Is it clear? Now, there is one small amendment which is made over here in Finance Act 2023. Shall I say? Now, Finance Act 2023 has a small amendment. Pay attention here. Now, that amendment I will explain here itself so that you understand in a better manner. See here. There is a problem in this particular law. There is a problem in the law, so the government has clarified that problem now. Now, what is the problem? See here. Say this is 23-24, okay? Now, every year, the SSC will file the return on under 139(1), okay? Now, the return will be filed under 139(1) on 31st of October 2024. Is it clear? Because audit is mandatory for trust people. If they want to claim exemption, audit is mandatory, and if audit is mandatory, they have to file the return in October only. Clear? Now, 1 month prior to that, okay, they have to do their what? Audit. Okay? And in audit, the CA has to fill a form. See here, the CA has to fill a form 10B, Form 10BB. What CA has to fill? Form 10BB. Okay. Now, in this form, listen, there is a practical issue over here. In this form, the SSC has to give the details of Form 9 and Form 9A and Form 10. Listen carefully. Understand the nature of the form. This form is the form of audit report. Which form it is? It is audit report form. Okay. In which the CA will report all the transaction, whether everything is properly done or not, etc. Okay. Now, what is Form 9A and Form 10? Yesterday I have told you. Form 9A is when you give the form to the AO because you have not received the money today. So you are saying that take Form 9A, I will apply in the year in which I receive it. Correct? And Form 10 is where you accumulate the fund for 5 years. Do you remember that? Now, the time limit for Form 9A and Form 10 is the due date of filing of return. What is the time limit? So, you can give the form to AO till the due date of filing of return. Okay. Now, the question is, there is a problem over here. The problem over here is, in this Form 10B and 10BB, the CA has to report these things. Okay. CA has to report these things in the form what? 10B and 10BB. Now, the form 10B and 10BB obviously has to be filed on 30th September. Correct or not? 1 month prior to the due date of filing of return. But you are giving the details, and in this form 10B and 10BB on 30th September, CA has to give the details of 9A and 10. CA has to mention the details of 9A and 10. Whether the money has been properly deposited in 11.5 or not, specified purpose is mentioned or not in the application. All these things CA has to report it. But the assessee is filing that form on 31st October. Whereas the CA has to file the report when? And in 30th September, CA has to mention those details. How will he mention? Or is it possible to mention or not? Therefore, the government has said that Form 9A and 9. Listen, are you listening? The Form 9A and Form 10 has to be filed at least 2 months prior to the due date of filing of return. It means Form 9A and Form 10 should be filed till which date? 31st August. Is it clear? Now the assessee will fill the form till 31st August. Correct? On 30th September, CA will take the details, will put the details and will fill his form properly. Is it clear? Read this provision, please. Have you read? Write down this example, it's also above. Are you clear? Shall we go ahead? Now, one small thing is there, not very important for exam. So I will address that fast and then I will go ahead with something important. There is one section 11.7. What does it say? Pay attention. Listen carefully now. This section says that if you are a trust, if you are a registered trust under section 12AA and 12AB, okay, then you cannot enjoy section 10 exemptions. Not allowed. Okay. What is not allowed to you? Section 10 exemptions are not allowed except few. Except few. Okay. So in section 10 there are 50 clauses, 10.1 to 10.50. None of them will be allowed to you if you are a trust, except few of them which will be allowed to you. Now which are those which are allowed? Let's read. As per 11.7, where a trust has been granted registration under 12AA or 12AB and the registration is in force in previous year, then the trust can't claim exemption under section 10 except 10.1. What is 10.1? Agriculture income. That will be what? Allowed as deduction. Then 1023C allowed. Now rest of them we don't know. Okay. We are going to learn about some of them. At least these two we are going to learn later on. Okay. 1046 is not there in the syllabus. But at least give us some idea, sir. What is it? It is again some government statutory bodies, etc. Kind of some government bodies here. Okay.
Okay, sir.
It is a kind of governmental bodies which are covered over here. So in all there are how many sections which are allowed to you? 5.
Oh,
5. 10 1 and the remaining 4. Okay. Now 10 1 is unconditionally allowed. Okay. Unconditionally. See here. See here, Palani and Vignesh. But for these 4 there is a condition. Shall I say? The condition is you cannot claim both together. If you are claiming 12 AB now, 12 AB, charitable trust you are exemption you are taking now, then you cannot claim these 4. Then you have to give up these 4. Okay. You cannot claim together both of them. You have an option. You can switch back from here to there to here to there as many times as you want. Listen carefully. Suppose I am a trust. Okay. I am registered under 12AB. Is it clear? Now, if I wish to claim exemption under 1023C. Okay. So I went to central government. I made an application. Okay. I got the approval. The moment I got the approval in 1023C, okay, this registration will become inoperative. Check. 12AA, 12AB registration will become inoperative.
oh, fine, sir.
Automatically it will become inoperative. Okay.
Okay, sir.
Now, in future, if I want to come back again, come back again where? 12AA, 12AB. Now, what is 12AA, 12AB? We are going to learn in the next 5 minutes. Okay. If I want to come back again in 12AA, 12AB, then I can come back. Then I have to what? I have to leave the exemption under 1023C. Are you clear? Please tell me. Check. So, moral of the story, these 4 exemptions are not unconditionally available simultaneously. But you have an option to switch in, switch out from here to there to here. Okay. Is it clear? Now, pay attention please. We are learning something important now. Pay attention. Something important practically. Academically, I don't know whether this is important or not. What I am going to teach you now. But practically, yes, it is extremely important. Shall I say? What do you feel since when this concept of trust and all is there? This exemption and all would be there. Trust exemption. The trust exemptions and all will be there since how many years? Since what?
100.
Yeah, a lot of years. Since the start of Income Tax Act, right?
Sir.
What do you feel that are how many trusts which are registered in this country? No idea, sir, but there might be a lot of trust. There might be many lakhs of trust, right? Who might be registered under the income tax law. Now, the first thing that you have to keep it in mind is that is a trust if they want to claim exemption under the income tax law. Then no matter in which law they are registered, we are not interested in that. Okay. There is a separate law by the name called as Trust Act. Which act?
Trust Act.
Trust Act. In that they have to register themselves. Okay. But only registering in Trust Act will not gain you exemption. Exemption is only available if you make application under the income tax law and get registered under the income tax law. Getting registered under the income tax law is the primary condition to claim exemption. Otherwise, you will not get exemption. Even if you are 100-year-old trust, or whether you are Tata Capital, Tata Cancer Hospital, Tata Sons, or whether you are anybody, you need to register yourself under the income tax law. Okay. You might have registered yourself under the trust laws. See, Charitable Trust and Religious Act. Can you see that?
Yes, sir. Charitable and religious trust act 1920.
Yes. So you might be registered here. You might be, but it's of no use unless you get registered where?
Income tax law.
In income tax law. Now, see here. All of you pay attention. See. Now, till 2020, the registration was obtained under section. See here now, Vignesh, please, yaar. Please, beta. Till 2020, the registration was obtained in section 12A and 12AA. Okay. A trust was registered under these sections. Is it clear? Tell me, please. Now, how shall I say this now? What I would like to say. Now, in 2020, the Finance Minister of India, Nirmala Tai, okay, our dearest Nirmala Tai, has put everybody on work. She said that now everybody is sitting idle, let's everybody work now. Okay. What kind of work, sir? Every trust. Now, I'll just tell you what used to happen before 2020. Okay. Before 2020, you need to make an application to the trust on a physical mode. Okay. You have to make an application to CIT in a physical mode. Physical application was there. Are you listening, Palani? Be active then, be attentive. Second thing before 2020 was, once you make an application and if you get registered, you are registered for lifetime. Okay. You are registered for what? Lifetime. These were the two highlighting points of earlier registration procedure. Physical application, once registered for lifetime. Yes, it can be cancelled in some reason. In some circumstance, the department can cancel your registration also because of some irregular activities. Okay, that was allowed. Now, in 2020, what she said, you know, that I am bringing a new concept. I am bringing a new registration process. I am bringing a new registration process. Now, what is there in the new registration process? Listen. In this new registration process, you are going to get registration for 5 years. How many years? Okay, I agree. That is fine. After 5 years, you have to reapply. You have to reapply. That is fine. Secondly, second amendment which they brought is, if you are a new registration trust, if you are a new trust, if you are a coming for registration for the first time, okay? Coming for registration for what?
First time.
For the first time. Then you will get only a provisional registration of 3 years. What you will get? Provisional registration for 3 years. After 3 years, we will assess your activity and then we will give you final registration. Are you clear? So initially we are going to give you what? A provisional registration for 3 years. Is it clear? After 3 years, we will assess your activity. We'll check your activity. And then we will give you registration for what? Complete 5 years. Okay? This is also fine. I am okay with it. Now what she said, listen. Everybody who is already registered under 12A and 12AA has to come again for registration. Everybody who is
come again for registration.
has to come again for registration. Till when, sir? Till when? Initially, she said that till 30th June 2020. Okay. Now, till 30th June 2020, I was not able to step out of my house also. How will I come to apply your form?
Sir.
Why?
Yes, sir.
COVID-19. I was thinking of my family, of my health, and you are telling me to register, re-register. You don't have any other work or what in life? I will leave aside everything and go for re-registration. Then 30th September, then 2021, then 2022. It got extended. Last it got extended till 30th September 2023. Till when? Now that is what it is mentioned in your study material. I don't know what has happened beyond that. Okay. Are you clear? So all existing trusts, they have put on work. Everybody has to work. We are working, so you also work. Okay. Everybody has to come back and re-register yourself. So now we are going to learn all these things under different circumstances. Shall we start? We are going to learn that by when you are supposed to make application. After you make the application, the government will give you registration in how many months. Okay. The government will give you registration for how many years. Okay. The government will give you exemption from which year. Okay. And tell me now.
Yes, sir.
First of all, understand the headings. Understand the different circumstances first of all. Okay. Shall I read? First, understand the columns. Don't read the provision. Wait. Please wait. Different entities. Second column is by when you should make an application. By when you should upload an application. Okay. Correct. Now the third column is after you upload, by when the government will grant you what? The fourth column tells you from which year you will enjoy exemption. Okay. And the fifth column is saying you for how many years you are going to enjoy. Okay.
Yeah, yes, sir.
Shall I go ahead?
Sir, nowadays it has become online, sir. Previously it was now it has become online.
Now it has become online. Okay. Shall I read? Now listen, be very careful. It's slightly tricky because it is involving some dates and all. Yeah. Otherwise, it's simple only. Shall I read? See here, Vignesh, please. If you are an existing trust is registered where? 12A, 12AA. All those are registered under 12A and 12AA before 31st March 2021. Okay. They should make an application till which date now? Is it clear? Now, if they make an application till 30th September, within 3 months on the end of this month, they will get the registration. Check. So if they make an application on 30th September, by when they will get the registration? They will get the registration from when? That is till December, correct? Till here, is it clear? Now what does third column says? Column says, don't see the provision. First understand the column. What does the third column says? Yes, from which year exemption will be available? You only tell me logically, from which year exemption should be available? From now or it should be available from earlier?
From earlier itself, sir.
From earlier itself, right? Because I am an old registered trust, yes?
Yes, sir.
From the AY from which such trust or institution was earlier granted registration. Correct? Now, obviously, you will get it registration for how many years? 5 years directly. Provisional registration is applicable for new people. Okay?
Correct, sir.
It's not for old people.
Yes,
For new people, why the government is giving provisional registration? Because you have just started the trust. We don't know whether what are you going to do. Yes or no? So we will give you provisional registration for 3 years. Is this first point clear to everyone? Is there any doubt? Sure? Now, in case of new trust, there are two possibilities created by Finance Act 2023. Earlier, there was only one possibility which was wrong. So now they have corrected their mistake by making two possibilities. Okay? Now, in case of new trust, see here. Wait. In case of new trust. Okay? Shall I say? Now, there can be two types of new trust. First, a trust which is opened 10 years back. Which started when? So it was doing good work. Okay? But they did not apply to registration ever. Okay? So they are coming today. Okay? So what will happen to them? And if a trust who have commenced their activity earlier, the second trust is who has commenced their activity only today. Okay? Let me give you some example through which you will understand. A trust whose Nariyal got break today. Inauguration happened today. Okay? Coconut you broke today. Why? Why today you broke? We are starting a new trust today, not business. Don't say business in this chapter. I'll kill you, Parani. This is not business chapter. Okay? You're a corrupt-minded person. You want to do business in trust? Huh? This is not a business, Parani. So, you have broken your coconut today. That is one possibility. Second possibility is you have already broken your inauguration 10 years back, but you have not registered under the income tax law so far. Correct? So let's see who is the first one. Where the activities of the trust or institution have not what? It means we are breaking Nariyal 10 years back or today? Today we are breaking the Nariyal. Nariyal means coconut. Okay. Now suppose you are breaking the Nariyal on, you are starting the activity. Shall I write here above? There is no space below. Shall I write above? Suppose you are starting your activity on 1st of October 2023. Okay. Is it clear? Now by when I should make an application? Read. Palani, if you are breaking the Nariyal on 1st October, by when you should make an application? Check.
1 month prior to the commencement of the previous year, 11 to the assessment year from which registration is started.
Okay, when is the previous year starting? In my example. 1st October 2023 is my previous year, correct? So you have to make an application 1 month prior to this, correct? Is it clear? Then within 1 month, the department will give you registration. Check. Very, very fast. Because there is nothing to check now. You are absolutely new. What will we check? Yes or no? We will check you after 3 years. After 3 years. Okay. Then you will get an exemption from the AY immediately following the FY in which the approval or registration of application is uploaded. So listen carefully. So when was the registration application uploaded? Tell me. 23-24, correct? Array application is uploaded in 23-24 na?
Yes, sir.
So you will enjoy exemption from AY 24-25, that is PY 23-24, correct?
Correct, sir.
That is from the same year itself, in short. in short it is same year only. Correct or not? Then they will give you registration for how many years? Only 3 years. Okay, only 3 years registration you are going to get. That to provisional, highlight that. It is not going to be a final registration for you. Is it clear? Now, there is another kind of new trust. What does it do? It is a trust which got started when?
Long back.
Long back. So they can make application anytime. Check. Whenever they wish to, from whenever they will apply, they will get exemption. Correct? Do you know why? What was the provision year earlier? I'll tell you. That's the reason amendment came. Do you know what was the provision earlier year?
Understood.
You understood. What I did not say, you understood my mind. Palani? Shall I tell you the provision which was there earlier? That's the reason. Na, that is, can you find this? That this is an amendment by Finance Act 23. Shall I say? Now, what was the provision earlier? You know, it was, see here, see. It was 1 month prior to the previous year. Okay. Or before commencement of activity, whichever is earlier. Before what? Suppose I have started my activity in 2013. Okay. And now I am coming to application. They are saying that go back to 2013 and apply 1 month before that. Why the hell they make such amendments? I don't understand. Still there is some mistake. I'll show you after some time. Wait. I'll show you. Still this is the mistake. I used to shout it out in the class again and again. That this is the mistake. This is the mistake. This is the mistake. I have also written in my Finance Act 2022 books. Now, fortunately, they have amended this. Now, this is correct. At any time, you can apply. Is this correct now? If you are an old trust, the Nariyal got broke 10 years back. So, they are not telling you to go 10 years back and apply 1 month before that. Okay. So, now they are saying that apply anytime. Okay. Within 6 months, we will give you registration. Okay. Now, you will get registration, and here very important point, see, you will get 5 years directly. No provisional registration. Okay. Why directly? Because you are already a trustee earlier. You are doing something. You are not registered. That's it. Correct. So provisional registration is only possible if you are an absolutely new trust. Okay. Are you clear? So how many categories we have done so far? 3. First one, all the existing trust. They have put everybody on work. Okay. Second, new trust. Nariyal now broken. New trust, Nariyal broken 10 years back. Okay. Now, there is some relaxation which is given by our great finance minister to us as a student. Okay. Read all the cases which we have read so far. Is there any case where you are getting exemption on a retrospective basis? That you are making application today, you will get exemption of the last 4 years. Read. For that, you have to read this column. This one. Because this column tells you the year from which exemption is available. Correct or not? Are Palani, correct or not? Is there any case where you are going to get retrospective exemption last 3 years, 4 years, 5 years? Tell me. Where? You are getting retrospective exemption. In 4th case, where?
The trust which is provisionally registered under section 28.
Hey, that is not retrospective, na. You have claimed exemption. You had a registration, na. When I say retrospective, it means is there any case where you are getting exemption even during the time when you are not registered? Tell me.
No, sir.
Is there any case in out of these 7 cases where you are getting exemption for that period also when you are not registered itself? Are you getting? No. Nowhere. It was available till last year. It was. There were 3 provisos for that. But now they deleted all the 3 provisos. Check. So if they deleted all the 3 provisos, means you are not going to get what? Now, I'll just give you an idea when it was applicable. See, just read the one of the proviso. You will understand. That in what case it was allowed. Suppose you got registered today. See now, you got registered when? But you are doing good work for the last 10 years. Okay. So the law says that if you got registered today, the AO will give you exemption for earlier year also. Provided your assessment of last year should be pending. Your assessment of last year should be pending and your objects should match. Whatever objects you are doing in your trust and whatever objects you were doing earlier, it should match. Check. Then trust can enjoy exemption for earlier also. Now they removed this proviso. Now they only brought this proviso. Huh? Arun Jaitley ji brought this proviso and Nirmala Sitharaman ji removed this. And last one is added by Finance Act 2023. What does it say? Have you uploaded an application for registration, Palani? Now that application contains false or incorrect information. You are not mentioning your object properly and all, right? So all these cases will be considered as what? Tell me. Specified violation, and if you are specified violation, then what will happen? Registration will be cancelled. CIT will pass an order cancelling your registration, correct? And one last thing is there in this chapter, which is as follows. Pay attention. One of the basic condition, see here, to claim exemption is you have to file the return. Okay. Without filing the return, you cannot claim exemption. So the question which was arised in front of the department was, which return? Which return? Which 139.1, 139.4, okay. Or even if I file the return under updated return under 139.8 would be fine. Arey, nowadays you can file return under 139.8 also, na updated return.
Yes, sir. Yes, sir.
The government said that we are talking about normal return, not updated return. Okay, check.
Okay,
If
sir.
you file a return in updated return, then you are not doing any kind of favor on us. Okay.
Okay, sir.
Updated return is not filed to claim exemption. Updated return is filed to pay tax. Yes or no?
Remember that, sir. Yes, sir.
So you have to file the return as per 139.1 or 139.4 maximum belated return. Is it clear?
Sir.
So this is an amendment made by Finance Act 2023. Check it please. Okay. Now one last thing is there over here. Pay attention please. Do you all know that? See here. Now, do you all know that all the trusts which were registered since long back under 12AA, they have to again make application till 30th September under 12AB?
Yes, sir.
Do you remember that or not? Tell me please.
Yes, sir.
Now, they are playing game with Government of India. They are playing what? A game with Government of India. See how. They want to go out of the trust. They want to go what?
Out of the trust.
Now they know that if they go out of the trust, then they have to pay exit tax, correct?
Yes, sir.
Yes? They no more want to continue as a trust. They know that they have to pay exit tax. So what are they doing? You know, they are deliberately not making application to the CBDT for re-registration.
Okay.
Now, if they are deliberately not making application for registration, okay, they have to make now by 30th September, correct? Which the government is extending since 2-3 years. Since 2020-21, they are extending, and they have extended till 30th September 2023. So the assessee is deliberately not making application. What will happen because of that? Tell me. They will no longer be a trust, and they will blame the government that we have not done any wrong activity.
No exit tax.
We have just not applied what? For the application. We have not done any wrong activity, nor our trust is dissolved. nor we are merged with any other entity. Okay,
Oh, sir.
right?
Yes, sir.
Nor we are changing our activities.
Activities. Yes,
So
sir.
Finance Act 23 made an amendment. Check. In such cases, it is deemed to be converted into a form not eligible for registration. What? It is deemed to be converted into a form not eligible for registration. Are you clear or not? Please tell me. Now, this is absolutely a new section freshly inserted by Finance Act 223 115 BAE. This is a copy paste section of 115 BAB. Copy paste of what, Palani? With some minor changes, which I want you all to read completely and tell me what are the changes between this section and 115 BAB. Okay, you have to read completely now for me. If you are done, let me know. Then we will do another. So tell me, what are the similarities? What are the differences between this section and 115 BAB? First of all, the date of commencement of setup and manufacturing has to be only 1 year, 23 to 24, correct? So between this period, you are supposed to set up and manufacture, correct? What is the second difference? Yes, there is a generation of electricity which is mentioned here, which was not mentioned in 115 BAB, correct? Did you find this did you find this difference or not? We play a game na in the childhood. Two photographs are given. Find the difference, right? You have to do that only. Rest all these are not covered here also. Cover? Clear? Business is not formed by etc etc. All these points are covered here also. Clear? All these deductions are not covered here also. ATJJAA is allowed. Clear? That is missing. That's a mistake. Please write down that. Okay? Mistake. It's just left out. Write down that. 13 is also not allowed. Only 3511 and 14 is allowed. Okay? Normal depreciation also 40%. Correct? AMT not applicable. Correct? Tax rates are also same. Correct? Surcharge also same. Cess also same. Everything is same. And this domestic transfer pricing, that we'll see after some time later. Okay? That we have left in 115 BAB also. Clear or not? Is it clear? That we have left in 115 BAB also or not? Now, when to exercise the option? That is in 23-24 itself, right? Can I withdraw the option? No, not possible. So it's a simple section, right? Copy paste, copy paste. Correct. Now there are some amendments in chapter 6A which I am dealing with one by one. There are 3 amendments in chapter 6A. One is absolutely new section 80CCH. Now what is 80CCH? Let me explain you that with the help of an example. The central government has opened a new scheme for Agniveer. Who is an Agniveer? An Agniveer is a person who joins Indian Army, Indian Air Force, Indian Navy, etc. for the purpose of serving the nation. Now for them, the government has said that you can be called as an Agniveer and the scheme will be called as Agnipath scheme. For them, the government has started with an Agnipath scheme in which we have to form Agniveer Corpus Fund. Now pay attention please. Now in this Corpus Fund, the central government will contribute. This will be called as employer contribution, just like PF. And Agniveer will also contribute. That will be employee contribution. Okay. Now both of them can contribute. Now whatever the employee is contributing, for that employee can claim deduction under what? 80CCH subsection 1. But there is a catch over here. This is available under only old regime, not under new regime. You might be knowing there is a new regime, there is an old regime. In new regime, there is a relaxation in tax rate, not available. Okay. So the employee contribution, whatever you contribute to the Agniveer Corpus Fund, say your salary is 10 lakh rupees. So you are contributing 2 lakh rupees. So 2 lakh you can claim as a deduction under 80CCH, but only under old regime, not under new regime. What about employer contribution? Employer contribution will be first considered as salary. And then from chapter 6A, you can claim under 80CCH subsection 2 entire contribution. Okay. And this is available for both regimes. Both regime available? Yes. For both the regimes it is available. Okay. So it is available. So here there is a benefit for employer contribution. It is available under both the regime. For employee contribution, it is only available under what? Under the old regime, not available under the new regime. If you want to take a photograph of this, you can take it. Then I will read the provision. Okay. Now I will read the provision. 80CCH has been inserted. Deduction under 80CCH will be applicable if the following conditions are satisfied. First, there is an individual who is enrolled in the Agnipath scheme. Okay. So you should be an individual who is enrolled under the central government Agnipath scheme. And you subscribe to the Agniveer Corpus Fund on or after 1st November 2022. Okay. Then under 80CCH, subsection 1, contribution by assessee will be deductible, but it is not available to a person who pays tax under the optional tax regime, not available under the new regime. Okay, it is only available under the old regime. What about this? This is the central government contribution. This is available also in the new regime. This is available to both of them. Okay, it's available to both the kind of assessee. I hope it is clear to all of you. Now coming to the second amendment, the second amendment is a removal of certain funds from ATG. Under ATG, there are a lot of different kind of funds for which if you give the donation, you will get deduction. Now the government has removed the entire Gandhi Parivar. You can check over here. Jawaharlal Nehru Memorial Fund is removed. Indira Gandhi Memorial Trust removed. Rajiv Gandhi Foundation removed. So in the first category, where you get 50% deduction without any restriction, fully allowed, subject to 50%. There are two types of deduction. Now. One is 50 and 100% without any restriction. One is 50 and 100% with 10% of adjusted total income. These are the two types of deductions, right? So here you are going to get the benefit. You are not going to get the benefit for these three funds anymore now from Finance Act 2023. Okay. And the third amendment which is there in this chapter is in the last section 80LA. Now, what is the amendment in 80LA? There is a change, there is a relaxation over here. In 80LA for scheduled bank and for foreign bank, what was the provision earlier? It was 100% deduction for the first 5 years and 50% for the next 5 years. Okay. Now that has been changed to 100% for all the 10 years. Check please. So from 6th year to 10th year, it was 50% earlier. But now for all the 10 years, it will be 100% deduction. Check it please. Okay. Now there are some amendments which are made, some small amendments which are made in non-resident taxation, but very, very, very important for exams. Now what are those small amendments? The very first amendment which is there over here is there in 115A. Come to section 115A. In 115A, you might be knowing that if under the third section, that is where the TDS is deducted under 194 LC, here is the amendment. In 194 LC, there is an amendment. Now pay absolute attention. Now you might be knowing that in 194 LC, pay attention. If a money is borrowed from outside India, condition number 1, and if it is borrowed by long-term bond or rupee denominated bond, condition number 2, and if it is borrowed between 1/4/2020 but before 1/7/2023, condition number 3, and if the bonds are listed on a recognized stock exchange in IFSC, condition number 4. So if a money is borrowed from outside India, money is borrowed by way of long-term bond or rupee denominated bond, it is borrowed between 1/4/2020 to 30th June 2023. And the fourth condition, the bonds are listed in a recognized stock exchange in IFSC, then the tax rate would be only 4%. Remember? Would be only 4%. Now this 4% has become, everything is same. This 4% has become 9% with effect from 1st July 2023. Check please. Check this and this. It is exactly same. It is just that where this provision ends, from there this provision starts. So this provision ends on 30th June and this starts from 1st July. So till 30th June 2023, it was 4%. From 1st July 2023, it is 9%. Check it please. This is a very, very small amendment. Okay. This is the first amendment which is there in 115A. There are multiple amendments in 115A. I am telling about all of them one by one. Have patience, please. Now, second amendment. Generally, the dividend income which is earned by non-resident or foreign company. If a non-resident invests in the shares of Reliance Industry and if it earns some dividend, it is taxable at 20%. But here also there is a further relaxation that if the non-resident is investing in an IFSC, where in an IFSC, from there if they are receiving dividend, then that will be subject to 10% tax. Check please. So if the non-resident is investing in non-IFSC units, non-IFSC, then 20% tax. In IFSC unit, then 10% tax. Check it please. I hope it is clear. So this is the second amendment which has been made over here. Third amendment is there in the tax rate of royalty and FTS. A royalty and FTS which is charged under 115A. Which royalty and FTS are charged in 115A? Where there is no PE and there is an agreement with central government which is approved by central government, right? There is an agreement and which is approved by central government. Then it is covered in 115A. So earlier the tax rate in 115A was 10% or DTAA whichever is lower. But now it has been increased to 20% or DTAA whichever is lower. Check please. 20%. So 10% has become what? It has become 20%. So this is a very small amendment. But in substance it is very big. Okay, check it please. Then the next amendment, I've already told you that for winning from online game, they have made a separate section which is chargeable at 30%. Yes, I hope you remember that. We have already done the TDS also. Where is the winning from online game TDS is deducted? It is deducted in a separate section 194BA. Okay. Then there are some amendments which are there in section 10. Let me talk about them one by one. Pay attention please. On page number 58.17. 10.4e, there is some addition in 10.4e. Earlier, what was exempt for non-resident? When they transfer a non-deliverable forward contract, point number 1. When they transfer an offshore derivative instrument or when they transfer over-the-counter derivatives, point number 3. So, what income comes out of transfer? The income which comes out of transfer is capital gains, right? So, capital gain income was exempt earlier, but now even a distribution of income will be exempt. Okay. Distribution of income means dividend and interest income. But this distribution of income is exempt only for offshore derivative instrument. It is not exempt for the other two party. Check. Other two contracts. I hope it is clear. So offshore derivative instruments, whether you sell, it is exempt. Whether you get some income out of it, that is also exempt. Okay. Now this is the first small amendment, not very important for exam. I don't think so. Okay. Next important amendment is this. 10.4G, there was one point. Now they have inserted one more point over there. What is that one point which was there earlier? Check. Any income received by a non-resident from portfolio of securities. So if a non-resident has a portfolio of securities in India, or financial product or fund managed or administered by any portfolio manager on behalf of such non-resident. So if a non-resident has a portfolio manager in India who is managing the portfolio on behalf of non-resident, whatever income he will earn, that will be exempt. Now, one more income, they have said that they will make it exempt. That is any other activity which the central government may notify. Now, I don't know which is that activity. This will be notified later. So whenever it will be notified, at that point of time, the world will come to know what exactly the law wants to tell you. Okay. One more amendment is there, 10.4H. I'll be coming to this in a while. Okay. I'll be coming to this in a while. I'll be talking about this at the end of the chapter. Okay. Before that, I'll speak about few more small amendments. Pay attention. The next amendment is in ADIA, that is 1023FE, where the Abu Dhabi Investment Authority invests in India and their certain incomes are exempt. Which incomes are exempt? Their dividend income is exempt, their interest income is exempt, their long-term capital gain income is exempt, and one more income they have added now, C, which is mentioned in 56.212. For that, we need to learn 56.212. Sir, where it is mentioned, this is a new amendment which is mentioned in the chapter of business trust. That is the chapter of REIT. So whenever we will do REIT now, you will come to know what exactly this sum is all about. Okay. Till then you will not understand what is this sum. This 56.212 is the dangerous amendment, the most dangerous amendment of Finance Act 2023. I can safely say the most dangerous out of all, 56.212. So therefore you have to be very careful when I will be speaking in the next chapter. Okay. So at that time, you can easily relate with this what exactly this income is all about. Okay. Now, apart from this, what else is the amendment? Yes, one or two more amendments are there in presumptive income. So in presumptive income in 44 triple B, 44 triple B as well as for 44 double B. For both there is a common amendment, and the amendment is if you follow 44 double B or triple B, you are not going to get any deduction of set off of UAD. UAD you cannot set off against that income, nor you can set off what? Brought forward loss against that income. You cannot set off UAD, you cannot set off brought forward loss against these two incomes. Okay. Against which income? Against 44 double B and 44 triple B. Whatever is the deemed profit, you have to offer that to tax. You cannot reduce UAD or brought forward loss out of that income. Okay. Check it please. Now the next section is absolutely a fresh section, absolutely new one. For the very first time came to India in Finance Act 2023. Okay, very simple, nothing great. Shall I read? You read and interpret yourself only. It's very simple. Now you explain this section to me. It's easy. So what have you understood out of this provision? Please tell me. The transferor is a non-resident first of all, correct? The other transferor is a unit of IFSC, right? Both of them are engaged in the business of leasing aircraft, right? So who is the assessee? Assessee is a non-resident or a unit of IFSC. Both of them are engaged in leasing of aircraft, right? Now what are they transferring? They are transferring equity shares of a domestic company which is again a unit of IFSC and which is again engaged in leasing of aircraft. Yes or no? So the shares which we are transferring, that is also of a company which is located in IFSC. Are you clear? Now whatever capital gains we are earning, that will be exempt for 10 years. Okay. Beginning with the previous year, AVA relevant to the PVA in which the domestic company has commenced operations. Okay. So for 10 years it is exempt. Is it clear? Now, if however the period of 10 AYs ends before 1st April 2034, exemption will be available for a period of 10 AY beginning with AY 24-25. Okay. What do I mean by this sentence? Please tell me.
Before that, it will start from, it will expire in 31st March 2025,
31st March 20?
25 assessment year.
Yes. Now, what do I mean by this paragraph? For that, we need to read completely. Is this clear to everyone? Who is the assessee? What the assessee is transferring? The SSC is a non-resident. The SSC is a unit of IFSC engaged in leasing of aircraft. What are they transferring? They are transferring equity shares of a domestic company who is again engaged in what? Leasing of aircraft. Okay. Now, if the above conditions are satisfied, the above mentioned capital gains will not be chargeable to tax for a period of 10 AY, beginning with the AY relevant to the PY in which the domestic company has commenced operations. Okay. So, if the domestic company has commenced operation in 2025, so from 2025, 10 years, we will get the benefit, right? Yes. If, however, the period of 10 AYs ends before 1st April 2034, then exemption will be available for a period of 10 AYs beginning with what? AY 24-25. They are trying to say that if your 10 years expires before this, okay, say for example your 10 years expires when, say in the year 2020, 2033 for example, okay, if your 10 year expired on 2030, 2033, so still you will get exemption will be available for a period of 10 years with the AY 24-25, okay. So they are just telling you the last date. This is the last date till when you can enjoy the exemption. You cannot enjoy the exemption after 1st April 2034. Okay. Indirectly, they are telling you one last cutoff date by which you can enjoy the exemption. Is it clear?
Sir, if it ends before 34, then I can enjoy until 25 now, sir.
Yes, you can enjoy till 20. Yes.
35.
Yes. If it ends before 34, exemption will be available with AY 24-25. It means you will enjoy from previous year 23, 24 onwards. Okay. You can enjoy from this year onwards. Now, there is one last thing over here, but this is something which is dangerous now. Now, this is something that many people have misunderstood. That many people have not understood the provision. Now, we need to do some deep thinking over here. Huh? Then only we will be able to appreciate this point. There are some amendments which are made in this chapter, significant. I have made some big examples to understand that. But before that, we need to do some homework. Okay. We need to do some kind of homework to understand this concept. I want you to read from here till here. Apart from this also, there are some amendments in capital gains also with respect to this. Okay, that also we need to understand. I will explain everything very clearly, don't worry. Okay. Okay. Let's not waste time, Palani, by reading it. Even if you read, you will not understand anything. That's very much sure. Okay. Now, pay attention, please. To explain this concept, I have to take some examples now. Pay attention. We need to do some kind of homework first. We are doing that homework now. Let's do the homework to understand this concept. Shall I? Here there is a business trust. This is a very, very, very beautiful amendment. Here there is a unit holder. Now, unit holder has given money to business trust, correct?
Correct, sir.
That money is used by business trust to give what?
Sir, business trust will invest in land and building, sir.
Yeah, land and building is one of the option. But the main objective is to give loan to SPV, right? Correct? Yes, some portion of that will also be invested in what? From where they will get what? Rental income, correct? From here they will get what? Interest or what? Dividends, correct? Now, all these incomes, that is rental, point number 1. Interest, point number 2. Dividend, point number 3. All these incomes are in some or the other way. In some or the other way, getting taxed either in the hands of business trust or either in the hands of what? Unit holder. Okay. Some incomes are getting taxed in the hands of business trust, some incomes are getting taxed in the hands of unit holder. Apart from this also business trust earns some other income, like if business trust earns some capital gains. Okay. LTCG under 112, STCG under 111A. Business trust will pay tax. Investor is exempt. Correct or not?
Correct, sir.
In some or the other way, they are going to pay tax. Now, there is one item on which nobody is paying tax. On one item. Now, listen carefully. That is not dividend. In dividend also, in some cases, you have to pay tax. Especially when the SPV follows what? 115BAA. Correct? If SPV opt for 115BAA, investor has to pay tax. Correct or not? Please tell me. So, first of all, we need to find out few things. Some homework has to be done. Okay? What is the homework? The rental income is exempt under which section? The rental income is exempt in the hands of business trust. Under which section? Okay, that we need to find out. That homework we have to do. The interest income is exempt in the hands of business trust. Under which section? Under which clause? Exactly. The dividend income is exempt under which section? Under which clause exactly? Are you clear? So that homework we are going to do first. Okay? Are you clear?
Clear.
Now pay attention please. For that we need to see these two sections. See on the board. 1023 FC and 1023 what? FCA. We will see these two sections first. Okay? Shall I see? So we need to see all these things first. We need to see we need to understand these aspects first. What are these things? What is 115 US subsection 2? Okay? Let us try to resolve this first. Shall I?
Okay, sir. 3 sections.
Now pay attention. Which section we are going to see first?
1023
FC and then FCA. Section 10. Ten 23 FC. See. What does 1023 FC cover? Any income of business trust. By way of what? Interest received or receivable from SPV. So FC covers what? Interest from SPV. Correct? We all know that that is exempt or not. Please tell me. Interest from SPV is exempt in the hands of business trust. We are just trying to find out the references for the same. Are you clear? Second, dividend received or receivable from SPV. Exempt or not? Business trust. So dividend and interest is mentioned where? Okay. So here can you write down 1023 FC covers what? Interest and dividend from where? SPV. Are you clear? Are you clear? Now what does 1023 FCA covers? Any income of business trust being a real estate investment trust by way of what? Your voice is not coming. By way of renting or leasing or letting out any real estate asset owned directly by such business trust. Okay. So FCA covers what? It covers rental income. Correct? Okay. Now, one more thing that we need to understand, what is 115 US subsection 2? Shall we see that also? We need to understand the references of all these sections to understand the amendment. 115
UA subsection 2.
This website is hopeless. 115 US subsection 2.
Yes, sir. 115 UA subsection 2.
What does it say? Subject to the provisions of 111A and 112. Okay.
Okay.
The total income of business trust shall be charged at maximum marginal rate. We are aware of that or not?
Yes, sir. Yes, sir. Other income.
Other income will be charged at what?
MMR.
MMR. Okay. Now listen. So this is talking about what?
Maximum other income, maximum marginal rate.
Other income. Taxed at MMR. Correct. Is it clear?
Clear.
Now, the government of India has brought a new section 56 to 12. Okay. What they have brought?
56 2 cross 12.
12 is applicable from AY 24-25. And what does it say? Still, it will take some time for you to understand. It's a dangerous provision. Just wait for some time. I'll explain you completely. Shall I read? Any sum specified, any specified sum, any
Specified sum.
received by unit holder. You see, by
Unit holder.
from business trust during the year with respect to a unit held by him at any time during the previous year shall be chargeable under section 56 to 10 to 12. Sorry. So you will ask now, what do I mean by the term what?
In 56, I mean specified sum.
Specified sum means what? They have defined specified sum below. Check. For the aforesaid purpose, it shall be computed in accordance with the given formula. The formula of specified sum is this: A minus B minus C. If it is negative, it will be taken as 0. Let's see what is A. Shall I see? A. A is aggregate of sum distributed by business trust with respect to such unit during the previous year or any earlier previous year or year to such unit holder who holds such unit on the date of distribution of sum, or to any other unit holder who held such unit at any time prior to the date of distribution, which is not point number 1, point number 2, which is not in the nature of these two items. Okay. So what does A cover? See here. Wait. If you want to read, you read it once A. Still, it will take some time for you to understand what does A, what does B, what does C covers.
Okay, sir.
Are you clear?
Okay, sir.
So just for the sake of understanding, right now understand. Logic you will understand in some time. What does A covers? A covers whatever the business trust has given you over the years. Correct? But not these items. Which items? Interest, dividend, rental income, other income, whatever is taxed earlier. Okay. If something is given to you over and above what is taxed, okay, that has to be considered over here. Now you will understand the logic of it in a while. Second, what is B? The amount at which the units was issued by business trust. What is C? Amount charged to tax under this section in earlier previous year. Okay, now this provision is bouncer. Okay, it has gone bouncer or not? Palani, tell me honestly. Yes, now don't worry, everything you will understand. Now there is one amendment they have made in section 48. What is section 48? Computation of capital gains. Okay.
Okay, sir.
Now, if I go to the computation of capital gains now, see, they have put some explanations over here. Section 48. See on the board. Listen. For removal of explanation 1, I am reading. Shall I read?
Yes, sir.
This is an explanation which is inserted in section 48, which talks about computation of capital gains. Okay. For removal of doubt, it is hereby clarified that the cost of acquisition of a unit of business trust shall be reduced and shall be deemed to have always been reduced by any sum received by unit holder from the business trust with respect to such unit which is not in the nature of income as referred to in 1023 FC. What is 1023 FC?
Sir, 1023 FP is interest and dividend.
Interest and dividend from SPV. Or 1023 FCA. What is 1023 FCA? Rental income from land and building. and which is not chargeable to tax under section 56 to 12 and under subsection 2 of section 115 UA. Okay. That much amount has to be reduced from your cost of acquisition. Now, what is the entire objective of bringing this provision? Let me tell you. The logic of, you will need to understand and appreciate the logic of this provision. The logic of this provision is as follows. Suppose I am a unit holder and I bought the units. I bought the units, say, at 100 rupees. How much? 100 rupees. Okay. Now, every year the company, the business trust would be giving me some money, right? In the form of what?
Business trust will give in the form of
Interest, dividend, right? Or in the form of, say, rental, in the form of other income, right?
Yes, sir.
Now, one thing we are missing out, we all are missing out over here is one thing. Have I given money to the business trust? Listen carefully. Is the business trust giving loan to the SPV? Is the SPV going to repay that loan to the business trust some or the other day? And if whenever that loan is repaid to the business trust, that loan should be repaid to me also. Is there any taxability for that amount? There is no taxability for that amount, correct? And to charge that amount also as tax, to charge repayment of debt as a tax, the government of India has brought this provision. Okay, now how to tax, that I will tell you. I am not explaining you how to tax. First, understand and appreciate the provision, why it has come. See, in some cases, business trust makes distribution to unit holders, which may be categorized into 4 different categories. Interest, dividend, rental income, repayment of debt. Correct? Repayment of debt. You have given money to the business trust. Business trust has given loan to the SPV. SPV repaid back. And business trust is also repaying you back that money. That money is not treated anywhere. Okay. Now, as explained above, interest, dividend, and rental income have been accorded a pass-through status at the level of business trust and are taxable in the hands of unit holders. Correct? However, in respect of distribution made by business trust to unit holders, which is shown as repayment of debt, nothing is taxable in the hands of business trust or unit holders. Okay. Therefore, to charge this, the government has made amendment at 2 places. One at IFOS and one at what? Capital gains. Now the question will arise. When should we go to capital gains? When should we go to IFOS? Okay, that question will arise or not? So for that purpose, we need to take one example. Okay. Now see here, I am taking one example over here. See on the board. Analysis of business trust amendment. Suppose an investor. This is the data of first 10 years. How many years? First 10-year data is given in front of you. Shall I read? Everything will understand, don't worry. Suppose an investor purchase unit of REIT at how much? At 200 rupees, we have purchased the units of the REIT. Clear? Now, every year, from year 1 to year 10, REIT paid what? Rupees 30 per year in the form of rental, interest from SPV and dividend. Okay? Tell me now, please. Now, again I am asking, at what price you have purchased the units? And every year the REIT is paying me what amount as interest, dividend and rental income, which is taxable somewhere? 30 rupees every year. Shall I go ahead? Now, from year 1 to year 10, REIT distribute rupees 180 total amount. This is not per year. Okay? In 10 years as debt repayment. Is it clear? So how much they have repaid me in the form of debt repayment? Rupees 180 in total. Is it clear? Now you have to revise these 3 points. What has happened here? Tell me. In year 1, you have purchased a unit of business trust for 200 rupees, correct? And now every year for 10 years, they are giving you 30 rupees in the form of interest, dividend, rental income, which is taxable in your hand, correct? In 10 years taking together, they have how much repaid you as debt? Rupees 180. Now, see here. Shall I go ahead? Now, Let's come to capital gain provision. Explanation 1. Explanation 1. For removal of doubt, it is hereby clarified that the cost of acquisition. What is the cost of acquisition? What is the cost of acquisition of units in my example? 200 rupees. The cost of acquisition of the unit of business trust. Okay. Shall be reduced. Shall be. And shall be deemed to have always been reduced by any amount, any sum received by unit holder from the business trust with respect to such unit. Okay. Shall I read? Which is not in the nature as referred to in clause 1023 FC. Okay. So what are you going to reduce? Which is not in the nature of 1023 FC. Okay. What does 1023 FC covers? Interest and dividend. So interest and dividend, will you reduce from the cost? No. Because the law says that which is not in the nature of 1023 FC. Correct? Or 1023 FCA. What does 1023 FCA says? So will you reduce the rental income? No. And which is not chargeable to tax under 56 to 10, 56 to 12 and under subsection 2 of section 115 UA. I want you to read this paragraph entirely once. Then only we will be able to understand and appreciate the provision.
Hereby clarify that the cost of acquisition of a unit of a business trust shall be reduced and shall be deemed to have always been reduced by any sum received by a unit holder from the business trust with respect to such unit, which is not in the nature of income as referred to in clause 23 FC or clause 23 FCA of section 10, and which is not chargeable tax under clause 12 or subsection 2 of section 56 and under subsection 2 of section 150 UA.
Have you read it?
Yes,
now we will understand this. Okay. You purchase the unit for how much? 200 rupees. How much you are getting as interest, dividend and rental every year? 30 rupees. Is it chargeable to tax under, is it exempt under 1023C or 1023 FCA? You are not going to reduce that. Okay. Now, whatever is not exempt, okay, that you are going to reduce. Now, this 180 rupees, okay, is it getting charged somewhere? This 180 rupees, is the law talking anything about this 180 rupees? No, this you will reduce from the cost of acquisition. This is what section 48 says. Are you able to understand? So this you will reduce from where? From the cost of acquisition. Now what will happen if you reduce this from cost of acquisition, Palani? Your cost will reduce by 180. And whenever you will sell this, can I say indirectly you will be charged for 180 rupees? Yes or no? So reduce this 180 rupees from the cost. Okay? Are you clear? Now we will come to 56 to 10. Okay? Capital gains will be chargeable in the year in which you will sell. Now 56 to 10 says what? Wait. 56 to 12, sorry, not 10. What is 56 to 12? Point number A. Tell me. Whatever sum is distributed to you, correct? But not in the nature of interest, FC, FCA, all these things will not come, correct? So, in short, in point number A, what will come in my example in the current year? Tell me. Tell me na logically, yaar. 180 will come, correct? Because in A, you are supposed to write down whatever you have received from the trust, but not in the nature of 1023 FC, FCA, and in the nature of what? 115 US subsection 2. It means it will be 180, correct? Now, what is point number B? What is point number B? At what price the unit was issued? 200. So 180 minus 200 will come to minus negative. Therefore, if it is negative, then you have to take it as 0, correct? Now, in C, in the first year will not come anything now. Yes, because nothing was charged in earlier year, correct or not? So, what is the treatment of this in the first year? Check. A, aggregate amount received other than rental, dividend, interest, and amount on which REIT pays MMR, correct? 180. Are you clear? Please tell me honestly. B is unit issued at 200 rupees, correct? And C is amount charged earlier, nil, correct? So it is coming to negative, so negative coming to 0, okay? Now this was the analysis of year 1 to year 10, okay? Now I am going in year, I am taking another example over here, okay? Shall I? See, Mr. X bought 1 unit of REIT at how much? 200 per unit. And selling it after 3 years at how much? 300 per unit. In open market, okay? Now during this period, REIT distributed rupees 20 as debt repayment. Okay? How much the REIT distributed as debt repayment? So whatever REIT has distributed as debt repayment, shall I reduce it from the cost of acquisition? So now your revised cost will come to 180 and therefore your capital gains will be 120. Is it clear? Sure? It is very simple. It is very simple. Whatever amount you have what? Received in the form of debt repayment, reduce it from the cost. Okay? Now, this was an independent example. Okay? Now, let's continue this example to year 11. Year what? Again, I am asking, how much money you have received in the form, at what price you have bought the units? How much you have received over the year in the form of debt repayment? No, in debt repayment. That much you will reduce from the cost. Okay. So now, how much is reduced from the cost so far? Now, how much is left in the cost? 20 rupees. Now, year 11. Suppose in year 11, REIT distributes rupees 30 as debt repayment. Okay. Are you clear? Now, suppose in the year 11, REIT distributes you 30 rupees. Now, can I say you don't have that much cost only now to reduce? You only have 20 rupees to reduce now, right? Therefore, rupees 20 will be reduced from cost of acquisition. Now, your cost will be 0. Whenever you will sell, your entire sale consideration will be capital gains now. Are you clear? And rupees 10 will be chargeable under what? IFOS. How? See, this is how it will be chargeable. Tell me, what was A? Tell me the formula. Aggregate sum distributed. How much was the aggregate sum distributed? Other than rental, dividend and interest. 210, correct? What is B? Price at which it was issued. And what is C? Amount charged earlier. Was anything charged earlier in earlier years? No. Therefore, 10 rupees will be specified income. 100% clear now? Now, shall I go to year 12? Year 12. You have to give me the answer. Suppose in year 12, REIT distributes 20 as debt repayment. Can you reduce anything from cost? No cost pending. What you will reduce, right? Direct IFOS now, correct? What is A? Total amount received other than rent, interest, dividend, etc., etc. How much? 230. Perfect. What is B? 200. Amount at which it was issued. What is C? 10 rupees was charged earlier. So what will be the answer? 20. Check. Is it 100% clear? So this is how you are going to treat this particular provision. I hope it is crystal clear to you. Crystal clear? So your logic is very simple. See, you are a unit holder. You have to think like this. Whatever debt repayment you receive, whatever, first you will reduce from where? Cost of acquisition. Okay? Yes, sir. And once the cost is not there, then you will reduce, then you will treat it as what? IFOS. This is what the entire objective of this provision is all about. Are you clear? So will you take the photograph of these examples now? Take it, please. Just a second. Now the capital gains amendment also I have addressed in this example only. Okay. So year 14, if I sell the units, what will be my cost? 0 rupees. Entire sale consideration capital gains. Correct? I'll just scroll little bit. Check. Just wait. I'll just remove this strike off. Done? Year 11. Year 12. Now small concept is there of bright line test. Now what is this bright line test exactly? Now this concept is not there in India, actually speaking. Now what happens in this concept, let me tell you. Bright line test. Now this concept is there in some other countries but not in India. Okay. Now what happens in this case is, suppose this is India and this is Japan, and there is Sony Japan over here, which is the parent, and this is Sony India, which is the subsidiary. Now what happens is, the Sony Japan gives the responsibility to Sony India. One of the most important reason why any company brings its subsidiary to another country is to establish its market in that country. Okay. So Sony wants to establish its market in India. That's the reason Sony Japan has opened a subsidiary in India. Okay. Now what happens in bright line test? If Sony India has to establish a market in India, then Sony India has to incur one expense by the name called as advertising, marketing and promotion expense. Okay. Because without all these things, it is not possible to establish the market, right? Advertisement is a very important source of establishing the market. So now, what is bright line test actually? Bright line test tells about that if this entity in India incurs excess of these expenditures, okay, too much advertising, marketing and promotion expense if they are doing in India, which is over and above routine expenses. Over and above what? Tell me. Routine expenses. Then the excess is what? Is disallowed as per the bright line test. Okay. It is what? Bright line test. Now this is a concept which has to be there in your taxation law. Now in the context of Indian income tax law, there is nothing like bright line test in India. Okay. This concept does not exist in India. But still the AO is borrowing this concept from international place, from international countries and applying that in India. So the Supreme Court of India in the case of Sony and also in the case of Bosch and Lomb has held that it is not justified to apply what? Bright line test in India in the absence of what? Any specific provision. Okay. So there has to be a proper machinery provision for the same. Machinery means there has to be proper computation provision to identify how much is routine, how much is non-routine. Okay. Now this transaction cannot be what? Disallowed in India. Read it please. In India, only an international transaction is subject to transfer pricing. And this transaction which Sony India is doing is not an international transaction. Because Sony India is doing transaction with a advertising agency. Okay. Which is a third party. And that too in India. So that cannot be subject to what? Disallowance. Okay. Now this bright line test Was not there in your syllabus, in the old syllabus. So this concept is brought by the ICI in India. Sorry, in the new syllabus. In the old syllabus, it was not there. But as far as this concept is considered, this concept does not prevail in India. Okay. Now the next amendment in the chapter of transfer pricing is on page number 61.17, a small amendment in section 94B, limitation of interest. You might be knowing that there are some exceptions in the borrower for limitation of interest, like if the borrower is bank, then 94B is not applicable. If the borrower is insurance company, then also 94B is not applicable. Similarly, one more kind of borrower is added over here. Bank not applicable. Insurance company not applicable. Similarly, certain NBFCs which will be notified by the central government, for them also this exception saves them. For them also the provision of 94B will not be applicable. Okay, I hope it is clear to all of you. Now the next amendment is in the definition of specified domestic transaction. You might be knowing that there are certain domestic transactions on which transfer pricing is applicable, in which they have inserted a newly inserted section 115 BAE. It is similar to 115 BAB only. You might be knowing we have already done this in 115 BAE also, that there is one cooperative society who is eligible for 115 BAE, who is enjoying 15% concessional tax rate, and there is another cooperative society who is not claiming 115 BAE. Now, this cooperative society will deliberately sell the goods at higher price. Suppose the fair market value is 1000 rupees. So, it will deliberately sell at what? It will deliberately sell at 1500. Why? Because anyways they are going to get concessional tax rate. So, whatever excess you are selling, that will be subject to transfer pricing, and that will be taxable, remember, directly at 30%. You will not get the relaxation over here. Here directly the tax rate would be how much? 30%. Okay, check it please. Now the next amendment is in the chapter of tonnage taxation, a very small amendment. Generally what happens, if you want to opt for a tonnage taxation, you can opt for it. It's not mandatory. You can opt for it. So what is the time limit for making an application? The time limit for making an application is within 3 months, within 3 months from the date of incorporation. Okay, or within at the time of incorporation you are not a qualifying company, because to claim to come under tonnage taxation you need to be a qualifying company, and to become a qualifying company there are certain conditions which are mentioned over here. Okay, you can check it over here. So at the time of application you are not a qualifying company. Okay, so by default you have to make an application within 3 months from the date of incorporation, but at the time of incorporation you are not a qualifying company, so you have been given another advantage, that you can make an application within 3 months from the date on which it becomes a qualifying company. So whenever you will become a qualifying company, within 3 months you can make an application. Okay, this is an option which is there with you. Okay, now the question over here is, suppose I am an assessee who is eligible to claim deduction under ATLA for 10 years. So I made a company for 10 years, I am claiming 100% deduction. So why will I come under tonnage taxation? Because anyways my profits are deductible 100% for 10 years. So for these people, the government has made a separate time limit for application. That is, for these people, the time limit to make an application will be within 3 months from the date on which the deduction ceases. So whenever the deduction, they are ceasing to claim deduction, whenever, from whichever date they are not liable, they are not eligible to claim the deduction, from that date within 3 months they can make an application. Check it please. Okay. Now the next provision is with respect to some exemption given to Sikkimese people. To whom? Now, there are some great income tax exemptions. Sikkimese people are not liable for what?
Not liable for income tax.
Are you aware of this?
Sir, you told husband doing business, wife doing business, that is for Goa, sir.
That was some other provision. Sikkimese individuals are absolutely not liable for income tax. Okay. Now, why? Why they are not liable for income tax? Let me tell you. Let me tell you why they are not liable. During the independence at 1947, if you are aware, initially Sikkim was not part of India. Sikkim was a separate country. Okay. Now Sikkim shares a border with India as well as China. Okay. So later on, Sikkim thought that let us be part of India rather than being an independent part. Sikkim has two options, three options in fact. Option one, go with China, which they don't want to. Option two, come with India. Option three, remain independent. Option one, go with China, which they don't want to. Option two, remain independent. They know that if they remain independent, China will occupy them. Okay. Some or the other way. by sending their military. Okay. So they went for option three. The Indian government said that be a part of India. They said that we are very poor people. If we become a part of India, you will charge income tax on us. We don't have much income. You will take taxes from us, from where we will pay. Okay. So the Indian government said that we will not take any income tax from you. Don't worry. Okay. Okay. You be a part of India. So on 26th of April 1975, they became part of India. Okay. Now, which incomes are exempt? Is that every income is exempt? Yes, almost. There are some amendments also made by Finance Act 2023. That I'll talk in a while. The following income which accrues or arises to a Sikkimese individual would be what?
Exempt from income tax.
Which income? Income from any source in the state of Sikkim is completely exempt. It means what? If I do a job in Sikkim, is it taxable?
No, sir.
If I do business in Sikkim, no. Capital gains in Sikkim, no. IFOS in Sikkim, no. HP in Sikkim, no. But it is exempt for which people? Sikkimese individual. Okay. You need to have a domicile of Sikkim. Domicile means a certificate of your presence in Sikkim. Okay, that you are born in Sikkim, etc., whatever it is. Okay. So, if a Sikkim person goes to Delhi and earns the income, is that also exempt?
No, sir.
No. Any source from Sikkim, not from Delhi. Second, which income is exempt? Dividend and interest on security also exempt. Check. Because dividend income and interest income is not state specific, na?
Yeah.
If I buy shares of Reliance Industry, is it state specific or what? Tell me. Property can be state specific, your job can be state specific, your business can be state specific, right? But dividend and interest cannot be state specific, na? So dividend income, interest income is what? On security is what? Now, how can we enjoy this benefit? Palani, how can you enjoy this benefit? You stay where? Mr. Palani Appan, who is a resident of what? Chennai. Now, can he enjoy this benefit? Tell me. The answer is no. Now, he wants to start a business in Sikkim, but he cannot enjoy this benefit, right? So, what Palani will do? Mr. Palani, after becoming a chartered accountant, immediately is flying to Sikkim. But he knows that if he goes over there and if he does a business from Sikkim, he is not eligible for exemption. Because for that, you need to be what? Sikkimese individual. And Palani is not a Sikkimese individual. So now he is a chartered accountant. He is well settled in life. So he is going to Sikkim and he is marrying. So he married what? A Sikkim woman. Correct? Now he is doing business in the name of her, of his what? Of his wife. So he is not doing business in his own name. He is doing business in the name of his wife. So tell me whether the wife will get the benefit or not. Please tell me. Yes, wife will get the benefit. But in Finance Act 2008, the government made an amendment that this exemption will not be available to a Sikkimese woman, that is to Palani's wife, who on or after 1st April 2008 marries a non-Sikkimese individual, that is to Palani. This benefit will not available to a Sikkimese woman. If they marry what? A non-Sikkimese individual, Chennai person, Mumbai person. Okay. But Finance Act 2023, Finance Act
2023
has restored this benefit. Check please. It means now Palani can go and marry or not? Palani, you are free now. Be happy. Okay. Now Palani can go safely marry and also save the tax. Right? Tell me now, please. Now, obviously, from 2008 it was not available. Na? So, from 2008 they have given the benefit. Okay. Not only that, all those who have not got the benefit na earlier, they can make an application for rectification also. Check. Suppose in 2015 somebody got married. So, would that person would have got the benefit? No. The Sikkimese woman would have lost the exemption, correct? Even that woman can make an application. Now, why they have done so? Why? What is the need for to do this? Maybe some election is going on over there and some political benefit they want to take. That's the reason they have done it. There is no other reason. Okay. Is it clear? Tell me please. Next one. So they have made three exemptions. Three amendments over here. First amendment is a Sikkimese woman marrying a non-Sikkimese individual on or after 1st April 2008 will get the benefit. Okay? Tell me please. Second, an individual who was domiciled in Sikkim on or before April 26, 1975. So there was a lot of doubt in people's mind that suppose if I was born in Sikkim in 1965, okay, so will I get the benefit or not? Some people were saying no. Why? Because Sikkim itself came into existence from 26th of April 1975. Okay. Because before that Sikkim was not a part of India only, na? So even to those people the government started giving benefit. Check. So even if you were domiciled, in Sikkim before April 26, 1975, still you will be eligible. Correct? And forget about you, even if your specified ancestors were domiciled, then also you will get the benefit. Don't worry. Even if your ancestors were domiciled in Sikkim now, before 1975, then also you can take the advantage of this section. Okay, so they have relaxed this section like anything. I don't know why. Shall I go ahead? Now, we all know that from this year onwards, the government has given a lot of role to a new officer by the name called as Joint Commissioner Appeal. Yes or no?
Yes, sir.
Now, definition of Joint Commissioner Appeal. 228 CA has been inserted to provide for definition of Joint Commissioner Appeal. Now, who will come under Joint Commissioner Appeal? Okay. Joint Commissioner Appeal means what, sir? So, the government has defined that Joint Commissioner Appeal means a person to be appointed as Joint Commissioner of Income Tax Appeal or Additional Commissioner of Income Tax Appeal, both will be considered as Joint Commissioner. Check. Okay. Joint Commissioner Appeal. Do you know that a new appellate authority has come or not from this year onward? Joint Commissioner Appeal. Right?
Yes, sir.
Check it please. So joint commissioner appeal will include joint commissioner also, and it will also include additional commissioner appeal. Okay. Next one, some received from Agniveer Corpus Fund. I have talked about this corpus fund earlier also. Agniveer. That is where the government of India is going to give jobs to people in Indian Army. Right? Do you remember that? Agniveer? Palani? So whatever money they will receive now from Agniveer Corpus Fund. Okay? Whatever money they will receive now on retirement, they will receive some money from the Agniveer Fund. Right? That shall be exempt from tax. Check. Is it clear? Is it clear?
Some received from the fund is also exempt.
So the government has brought this Agniveer Fund for the Indian Army people. So whatever contribution that army person will make and government will make, that will accumulate, and on retirement, whatever they will withdraw, it will be fully exempt. Are you clear? Now there are few sections which has been inserted by the government, absolutely new sections. Okay. Absolutely new sections. Shall we see? Not very important for exam, I don't think so. Exemption to income of developmental authorities. Okay. Whose incomes are getting exempt here? Development authorities. 1046A has been inserted to exempt any income arising to any body, authority, board, trust, commission, not being company which has been established or constituted by central or state act. So it is a body which is made by whom? Tell me. Central government or state government. It's an authority or it's a board or it's a trust or it's a commission to achieve something, right or not? So what is their achievement? What they want to achieve? They are making this body, they are making this board, they are making this authority with an objective of making what?
Housing accommodation.
Housing accommodation for people. Okay. For that purpose, they are making one authority. Okay. Or they are making this authority with an objective of improvement of cities, town, villages. Okay. Or they are making this authority or body or agency with an objective of regulating or developing any activity for the benefit of general public. Okay. Or they are making this authority or body or agency for regulating any matter for the benefit of general public arising out of object for which it has been created. So all these are governmental authorities only, which has been made with an objective of achieving certain public interest things. Yes or no?
Yes, sir.
So whatever income they will earn, that will be what? Tell me. Exempt. However, the exemption will be available only if the aforesaid body, authority, board, etc. is what? Notified by central government. Okay. Now, there was a similar section in the name of section 1046. So now that section will not be applicable and this new section will be applicable. Is it clear? So I don't think so. This is a very important provision academically as such. Okay. So there is one more section which has been made by the government. See here. Exemption to credit guarantee funds. Now what are credit guarantee funds? These are again certain companies and institutions which are made by the government only to finance small businesses. To finance what?
Small business.
You might be aware of something called as mudra loan, that the government is saying that we give mudra loan. Mudra means business. So government is giving mudra loans. Business loan to lot of small businesses. So whatever income they are earning out of that is what? Is exempt here under 1046B. Check. 1046B is a very recently newly inserted section. 1046B was inserted in AY 24-25 to provide exemption pertaining to any income accruing or arising to the following. National Credit Guarantee Trust Company. Being a company established and only financed by whom? Tell me, who gives the money to them? Central government. For operating what? Credit guarantee funds established and only financed by central government. Or a credit guarantee fund or a credit guarantee fund trust for micro, small and medium enterprises. Okay. So this entire objective of making this particular section is to give exemption to such funds which are financing what? The small businesses. Is it clear? Tell me.
Clear, sir. Clear, sir.
I hope it is clear. Now, the next one, I would like to give you one example before I teach you the next point. Now, in previous year 14-15, the government has brought one section by the number called as 36-117, which we have done in PGBP earlier. Let me tell you what was that section. That section was for cooperative society. Okay. So that section in cooperative society used to say that if you buy a sugar cane, you have to buy at a price less than equal to government approved price. Okay. This section we have done earlier in PGBP. You can go and check. Okay.
Yes, sir. Yes, sir.
So, yeah, to avoid black marketing, you should not pay more money. So why are they buying sugar cane? To manufacture sugar, okay, to produce sugar. So the government said that a cooperative society, if they want a deduction under PGBP, that is under section 36-117, they have to buy sugar cane at a price less than equal to government approved. Now, unfortunately, this section was applicable from 14-15, okay? From when it was applicable?
14-15.
What about the matter before 14-15? Okay. What about the
Matter before 14-15.
14-15? The AOs, the assessing officers are raising demand. Are raising what? Demand for what? For which year?
Years before 14-15.
Years before 14-15, because before 14-15 such deduction was not there only. Okay.
Okay, sir.
So the government has made an amendment in section 155 to give you relief from what? Tell me. From your past demand. Okay. Is it clear?
Yes, sir.
Now this relief is available to whom? Let's see. 155.19 has been inserted with effect from April 1st, 2023. 155.19 is applicable in case of a sugar mill cooperative, where any deduction in respect of expenditure incurred for purchase of sugar cane has been claimed by assessee, and such deduction has been what? Tell me. Disallowed by the AO. Yes or no? And the aforesaid disallowance is for previous year 14-15 or earlier year. Okay. So don't worry. Don't worry. So if you have claimed a deduction in 14-15 and earlier year, when this section was not there, this section was not there, you claim the deduction. Okay? Don't worry. You make an application to AO. Okay? And he will recompute your income of that year. Is it clear?
Yes, sir.
And he will allow you such deduction according to the provision of 36-117. Is it clear?
Clear.
And he will recompute your income within 4 years from the end of previous year 22-23. That is, he will recompute your income by 31st March 2027. Check it, please. So this section is brought to give relief to what? Cooperative society from their past demands. Okay. Check it, please. Now, one last thing is there over here. Pay attention, please. Then we'll go ahead with the next part. One last thing is what? Pay attention. Now, this section is brought with respect to what? Amalgamation. And what happens in case of amalgamation? Suppose there are two companies. One is A Limited, one is B Limited. And this is amalgamating company. And this is amalgamated company. Okay. Now, in amalgamation, what happens? The amalgamated company has to take a lot of things from amalgamating company. Correct? So, I am amalgamated company, you are amalgamating company. I have to take a lot of things from you. Like, I have to take your losses, I have to take your UAD, I have to take your assets, right? Now, what happens practically? The amalgamation is final or not? It is decided by court. It is decided by NCLT. Okay. Unless they pass an order, the amalgamation is not final. Okay. Now, what happens? Suppose, for example, We did amalgamation in what? 2000. Amalgamation we did in 2023-24. Amalgamation done. But NCLT order has not come. Court order has not come. Now the due date of filing of return is coming. 31st October 2024. Okay. So what will the amalgamated company do? Tell me. The order of court has not come with respect to amalgamation. What will they do? Tell me.
They have to file two separate returns, sir.
No, right now they have to file return as per what?
Without amalgamation.
Without amalgamation, you have to file the return. Correct?
Correct.
You have to file the return without amalgamation. You don't have any other option. Because the amalgamation may be rejected also by NCLT. Right?
Yes, sir. Yes, sir.
You cannot file return as per amalgamation. So file return as per without amalgamation. Now suppose after 6 months or after 10 months or after 1 year, say on 10th of July 2025, the court order comes. The court
Order comes.
that amalgamation is proper. Then how will I give the effect of this court order for this year? What will I do? Tell me. I cannot file a revised return. The time limit for revised return is gone.
Updated return.
Updated return is not possible for these cases. Yes or no?
Yes, sir.
Updated return cannot reduce your income, na?
That cannot be by
So in this case, my income can reduce also because I will take the benefit of losses UAD, right?
Yes, sir. Yes, sir.
What shall I do? So for that purpose, the government has brought this concept. Check. Section 170A is applicable if the following conditions are satisfied. Shall I read? There is a business reorganization. Business reorganization means reorganization of business involving there is an amalgamation or demerger or merger of one or more business. Okay? Say na.
Yes, sir.
Now, the entity to which the order given below applies has already submitted a return of income under 139 for any assessment year relevant to the previous year to which the order given below applies. Is it clear?
Here.
You have already filed the return. Now, after submission of the aforesaid return, the High Court Tribunal Adjudicating Authority has passed an order pertaining to what? Business reorganization. Okay? Then what shall I do? I cannot file a revised return, time limit is gone. I cannot file an updated return, not possible. Updated return cannot reduce your income. So do you remember that in the same problem has also come in advance ruling, in advance pricing agreement in transfer pricing. Do you remember that? In transfer pricing and advance pricing agreement, same problem was there that you have filed the return as per yourself, and then CBDT has signed the advance pricing agreement. Then you have to file a modified return within 3 months. Do you remember that? The same way you have to file a modified return here. Okay. What are you supposed to do? Check. It is similar to advance pricing agreement. If the aforesaid conditions are satisfied, the successor means who? Who is a successor in amalgamation here? Amalgamated company. Successor means amalgamated company. Can furnish modified return in form ITR-A pertaining to the period contained in the aforesaid order. The return of income in form ITR-A shall be furnished electronically under digital signature. Successor means resulting company, whether or not the company was in existence prior to such business reorganization. Now, what is the time limit for this? Tell me. The modified return can be submitted within 6 months from the end of the month in which the order of the High Court is issued. Okay. So, within 6 months, you have to file the modified return. Okay. Now, there are 3 possibilities which I have taught you in advance pricing agreement also. See now. What if the assessment is already done by the AO? Is it possible?
Assessment is done, already done by
Already done by the AO. Then the court, after that the court has passed the order. Tell me now. And is it possible or not?
possible.
Then what will you? Same issues we have done earlier. In that case, the AO will modify the return, modify the assessment. Don't worry. You do your job properly. What is your job? File the modified return within 6 months. He will change the assessment order. Okay. So all those possibilities are mentioned here. You can read it once if you want. Exactly. Copy of what? Advance pricing agreement. It is exactly similar. Check it, please. And one last thing which I've just put for the sake of your knowledge, that from this year onwards, the government has raised the securities transaction tax rates by some percentage. Check. For futures and options. Check. Okay. STT rates have been raised by some percentage for futures and options. Check it, please. Is it clear? Tell me, please. Now there is one amendment in SFT and reportable account. You might be knowing there are a lot of entities who are supposed to file SFT every year and reportable accounts every year, like banking companies, like post office, like Nidhi company, like cooperative banks, etc., like credit card companies, stock exchange. Now, there is one penalty which has been introduced by the government, subsection 2. Subsection 1 was there already, 271 FAA subsection 1 was there. But subsection 2 has also been introduced over here. Now what is subsection 2? Pay attention. That there is an inaccuracy in the SFT. In SFT, you are giving some inaccurate information. And that inaccurate information is due to by account holder. Because the account holder has given you wrong information, you have put a wrong information and the government has noticed that. Say I am a bank and there is an account holder. I am supposed to file an SFT. I gave a wrong information. But I gave a wrong information because the account holder gave me wrong information. So in that case, the government said me, I will be liable for penalty of 5,000 rupees, not the account holder. I will be liable for 5,000 rupees penalty. The government will take penalty from me. But the government has made one provision whereby they have said that I can recover that from the account holder's money. Check it, please. So that much money I can recover from whom? From the account holder's money. Now why they have done so? They cannot penalize each and every account holder now. That is not practically possible. So they are penalizing the company and they are saying that you recover it from the what? Account holder. Whatever penalty you have to pay to CBDT, recovered from the account holder. That's it. As simple as that. Okay, check it please.